So hi guys, uh, welcome to Economics for Finance Marathon, Paper 8, Part B, CA Inter Group 2. So in this, by the way, this marathon is being handled, this entire revision class is being handled by our Srestha faculty, Naga sir. You know, first let me tell about his specialty. Naga sir is a qualified chartered accountant somewhere in 2013 or in 14 around. He worked at a very big firm at Chennai. Later he moved to Abu Dhabi and worked there, and later he came back to India, and he's also one of the civils aspirant. So he has been has prepared for civil services examination, all that. So Naga sir is having very good command on the economics for finance, not just in terms of financial angle but also as a whole, macro level factors. Okay, at a macro level he's having very good knowledge of how the politics works, how economics works, everything else. So this Naga sir is taking economic subject at Srestha, and we are now giving the revision classes from him. You can see definitely many of you have faced this issue while listening to economics. You all might have understood the sentences, but not actually how they impact as a whole. I think you might have not got the good grip on the overall subject. But believe me, after watching this marathon, to best of my knowledge, you all will get a very good exposure over the affairs, the economic related affairs, all that. So totally 7 hours approximately this marathon video is going to be, and all the concepts are being discussed at a glance, and especially wherever critical topics is there, like resource allocation, resource reallocation. There are so many, I don't know, Keynes theory. Okay, there are so many topics where sir will decode the crux in that, the difficulty in that at a very easier level. So why late, continue. And by the way, you can also find our other marathons. We have uploaded, we are the first one from the South India, I can say, who uploaded a marathon lectures for all 8 subjects first. You can check any institute's YouTube channel or whatever. We are the one who brought up this idea of uploading all 8 subjects marathon for CA Inter. Already if you check paper 1, paper 2, paper 3, paper 4 already uploaded. Paper 2 part A is pending, paper 4 part A is pending, which is coming on the way. Paper 5 is coming on the way. Paper 6 already uploaded, paper 7 already uploaded, paper 8 part B now we are going to watch. Still after this, like, you simply go to CA Harsha YouTube channel. I think that is where you are watching this video right now. CA Harsha YouTube channel, open playlist. Inside that CA Inter May 2022, you'll find this playlist, marathon playlist. In that all 8 subjects recordings were already uploaded. Close to approximately 150 hours. Only revision classes of 150 hours we are providing free of cost. So why late? So continue watching this, the marathon, and whatever you're having feedback or whatever, you can put it as a comment below. Definitely you're going to enjoy, trust me. And you can even watch other subjects marathon which is already uploaded, like auditing. EASSM is already uploaded, FM is coming in another 2 or 3 days, advanced accounts is coming in another 2 or 3 days. Almost all 8 subjects we have uploaded in CA Inter. Share it to your friends to watch these marathon classes. Very useful revision classes. That's it. Have a nice time. Bye bye. And sir will continue, Naga sir will continue taking up the class. By the way, I forgot to mention one more thing, sorry. Sir, where can we download the material used in this marathon? The material used by Naga sir in this marathon, you can download it from our application. In Play Store, you have an application, Srestha for CA and CMA. There is an application, you can find this logo. Okay, download that app. In that main menu, there is a tab called Study Material option. Click on that. CA Inter, you will find material. Inside that, economics you open, you will find material, marathon material and normal, all that you will find. Okay, we have given main material. We gave even past examination questions material, RTP material. So we have given materials, you just download that. Okay, have a nice time. Carry on, continue watching the marathon. Thank you.
Hello students, very warm welcome. Welcome to the quick revision classes of Economics for Finance. We will be trying to cover the important concepts in economics for finance in 6 to 7 hours. The entire syllabus, we will be discussing the most important concepts and the concepts which are relevant for examinations. My name is Naga Garikapati. I am the faculty for economics for finance. So let us quickly see a bird's eye view. What are the chapters that are in economics for finance, and what is the weightage for the examination, and how this needs to be ideally covered. And we will discuss what are the materials that we have shared for regular class students. I'll give you a quick overview of all this. So economics for finance, we have four chapters. First one is determination of national income. Second, public finance. Third, money market. Fourth, international trade. And in that we have subunits. Total around 107 pages material. This is the main material. And along with this, we have shared with students the previous year question papers and the suggested answers. And we have discussed all of the previous year questions and suggested answers chapter wise, and emphasized and highlighted what are the important areas where examiner can pick questions and what could be the relevance and what are the peripheral areas based on the question that they asked which could come in next year examination. That is how the discussion on the previous year questions happened. Also we have covered next RTPs, revision test papers of all recent revision test papers we have covered. We have discussed it in detail. So overall, three different materials, and we have covered economics for finance main material, and we have previous year question bank, previous year questions and suggested answers. Next, revision test papers. After that, the fourth one is this. It is quick revision. How this quick revision spans out. So out of 6 to 7 hours session, we allocate the time and based on the weightage in examination, and we cover all the chapters and all the units as well, briefly wherever it is required in detail, and what could be the favorite area for examiners for asking questions. All right, so let's start. Right, before we start discussing the content, I just want to show how the examination paper looks like. This is the December 2021 examination paper, section B in paper 8. See, there are 4 questions, 7, 8, 9, 10. All right. So out of these, you need to write 3 questions from the rest. So first question is mandatory. Out of the remaining 4 questions, you need to write 3 questions. If you see the weightage or the way the questions are being framed, all questions are in the range of 2 to 5 marks. In the economics for finance till date, there is no question which has been asked for more than 5 marks. So that is something you need to remember. Why I'm telling this is the preparation pattern of student should be based on the way the questions are being asked. So you need to keep that in mind so that you will be able to judge when you're reading a particular concept, how far this question could come in the examination. You will be able to make that assessment only if you have a complete grip or overall grip over the way questions are being asked in the previous years. So always keep the previous year question paper handy, whichever subject that you are studying, especially economics for finance. Keep the question paper of previous year handy so that you will be able to refer and see how the questions are being framed from each chapter. So before we start, I started with the question paper because it is so important. So the theory subjects like economics for finance, which is mostly of theory, you have few problems questions, but those are just application oriented. We cannot say that there is too much of mathematical knowledge required to do all of this. So it's more of knowledge that you need to apply. So keeping that in mind, when you are preparing for the economics for finance, you need to understand where you need to study and where you need to leave. That is also important. You need to categorize the overall subject into A category, B category, and C category, or in the categories that you like. And based on previous year question papers, you can grade questions, concepts into A category, which are very, very important, where there is more than 60% short questions could come from that area, right? So that's how you need to grade it and then study. So let us jump into the concept subjects now, chapters now. So as I told in my classes, the ideal way, the ideal flow of chapters should not be first determination of national income. First should be public finance. All right. Second should be international trade. Third should be money market, and fourth should be determination of national income. Why I'm telling is determination of national income is slightly heavier when it comes to the concepts, and also it requires certain peripheral understanding of how the government functions, government finance functions. All these knowledge is important to understand the national income. So my preference, even I suggest to the students, is first study public finance. This is more important. It will give you an overall understanding of how the fiscal functions of government, and what are the ways that government handle the various finance activities. This understanding will give you a more easier understanding of determination of national income. All right. So now the next 2 hours or so we are going to cover public finance. All right. So I am going to refer the main material as well as the institute quick revision material, which is very lucid. And in fact, they have given pure out and out concepts in these 20 pages material. So I felt this material is really good for revision, quick revision. So I will be covering my concepts from quick revision material of institute only, and wherever required, we will be referring, in fact, the main material. All right. So let's start first with public finance. In that also, the first unit, fiscal functions and overview. What is fiscal functions on overview? And then we have market failure, government interventions to correct market failure, fiscal policy. So let us start with fiscal functions and overview unit. As we always, before we start anything, we should understand the meaning for the chapter or say unit. The word for public finance is slightly self-explanatory. Public finance is nothing but finances of public. So this happens in a economy, or say in a country or in a state, how this works, the functions, the finances management of public is basically is what public finance, which is done by the respective governments in state, the respective state government at the the respective central government do the functions, finance functions. The finance functions is what is public finance. So under that, we are discussing fiscal functions. So what is fiscal? Let us see the dictionary meaning of this. So what is the meaning of word fiscal? So just to give you a word meaning, relating to government revenue, especially taxes. Basically, from that you can understand fiscal functions means government functions related to revenues as well as expenditure, especially taxes, receipts and expenditure. We should not say revenue and expenditure, receipts and expenditure. So overview of this, why the government needs to do this, why the government needs to involve. the first and foremost question that we all need to ask, why the government has to get into the personal people lives. All right, people finances is a question. So as we have that question from so many ages, so why the government? What is the role of the government in an economic system? Say government functions, you say, is only providing security to the people, providing the social infrastructure. Is that alone, or say there are only these functions are restricted to the governments? So we have now we are in the world of capitalism. So here we say the role of government in businesses and the economic functions are minimal. All right, everything is left to the market forces. It means the private sector are the private individuals who are rational, who are going to perform all the economic functions. The government role is limited. So that has been the convention in the capitalistic economic system. In fact, overall now the world is in that capitalism has taken win over communism, if we say that. In those scenarios, we need to understand first what is the role of the government, right? What is the role of the government? First we need to understand what is the role of the government in an economy. Let us not talk about the social security, let us not talk about the security or physical security, let us not talk about the national issues. All that is aside. What is the role of government in an economy? We are not saying what is the role of government in a country. There are a lot of functions that government needs to do. What is the role of government in an economic system? In an economic system particular to the finance functions, what is the role? All right, so there have been so many economists who have explained this, in that the most important or notable people are Adam Smith and Richard Musgrave. These two people are notable economists who spoke on a role of governments in the finance functions. All right, so the traditional functions of state have been supplemented with the economic functions, also called fiscal functions. Traditional functions of the state is like providing education, health, providing security to the people, protecting the national integrity. All of these are traditional functions of the government. Along with it, there are certain economic functions / fiscal functions also required to be done by the governments. So the public finance is all about that. So the budgets, all of this are comes under all of these budgets and the expenditure bills, all these comes under finances, public finances. So what Adam Smith says, he's a supporter of minimal markets. Government should not involve in the business. Government should not involve too much in the economic operations. It should be left to the market forces. That's what Adam Smith says. But there is a catch. Society cannot produce all goods and services that its members desires to have. For example, things like public transport, railways, all these cannot be left entirely to the private sector, because the overall objective of the government is what? Public welfare. So sometimes if we leave all the economic functions to the public private sector, there will be a resource misallocation. All right, so society cannot produce all economic goods and services that it desires to have. Therefore economic system should exist to answer basic questions such as what to produce, how to produce, whom to produce, how much to produce. This is not completely be left to the private forces, but there is certain important function of the government is called resource allocation. It is called resource allocation. The importance of the government in areas like national defense, maintenance of justice, rule of law, all of these, providing electricity, police, water, all of these are, resource allocation function of the government. All right. So that is what Adam Smith said. There is a role for government in resource allocation. All right, that's about Adam Smith. He spoke about minimal markets, minimal government involvement in the economy, but he says there is certain activity that the government needs to perform that is called resource allocation. There is a role of government in resource allocation in a way what to produce, how to produce, for whom to produce, how much should to be produced. All this needs to be allocated or to be influenced by the government. There is a function for the government. That's about Adam Smith. Next, we spoke about Richard Musgrave. He has come up with, a comprehensive overview or understanding about what is the role of the governments in the economy. He divided the functions into three. He divided the government functions, economic functions into three. One, allocation function. Two, redistribution function. Three, stabilization function. All right. What is allocation function? Resource allocation function, which brings efficiency to the system. We will take up with an example later on. You just listen. Next, resource distribution or redistribution. This is to ensure equity and fairness. Equity and fairness means to ensure everyone gets their own share. That is called equity. Equality means everyone gets equal share. That is equality. But we are talking about equity. Equity means someone who's low getting more than someone who's on, who's rich. For them, the benefit that government do is little. But someone who's rich, the government is going to do more so that they both can come onto the same platform and then grow, right? So that is called equity. So there are three functions that government do: resource allocation, resource redistribution, and economic stabilization. Very important. Government do the allocation, it's fine. Government redistribute from 1% to other, 1% to other, from rich to poor, right? And then government also do certain stabilization functions. So these three are the functions. If you think about any work that government do in the economy, don't talk about in country, in the economy, in the country works of government, the economic functions of government is one of the subsets. So all the economic functions of the government, any function that government do will fit into one of these three. Resource allocation, which is to bring efficiency in the system. Resource redistribution, to bring equity and fairness to the system. And economic stabilization, to bring stability to the economic system. These three are the important functions of economic functions of the government. Let us discuss one by one. What is resource allocation? What is resource redistribution? And what is economic stabilization? Right. So first function of the government that we were talking about is resource allocation. So why the government needs to do the resource allocation? So what it means, resource allocation means, it refers to the way in which available factors of production, that is land, labor, capital, entrepreneurship, are allocated among various uses. So why the government needs to do that? Because sometimes if we leave it completely to the market, it means private sector, it will not be efficient. The allocation responsibility of the government involves appropriate corrective action when private markets fail to provide the right and desirable combination of goods and services. What it means? For example, take certain public goods like public transport providing at a cheaper rate, which will help poor people. Second, provide public parks, building public parks and not charging any money. These things, if we leave it to the market, why would the market people do this? I mean, private sector do this because there is not much of profits in it. So obviously, government cannot work for profits. So to ensure efficiency in the system, the private goods are not sufficiently provided in those cases, and government get into it and they do the resource allocation, right? For example, providing public transport. In example, in say RTC, Road Transport Corporation, is not is running buses in a very remote village. If we leave that to private sector will not operate there because it is not at all profitable. So in those cases, government will provide public transportation facility, provide the buses to that remote area, say remote village. Why they do? Because government do that for welfare of people, right? Not every time they can see the profit in it, right? So that is why government has to involve, government do certain functions, government collect money, so that resource allocation that government has, whatever resources that they have to spend on certain activities. You get it? So market is subject to certain malfunctionings, as I said. So that is why governments needs to do the resource allocation function. Why do markets fail to decide what goods to be produced and in what quantities? Various reasons. One, there is not perfect competition. Someone who's having monopoly, they exploit people and they charge more and they earn more. And this is a problem. So in those cases, government has to intervene and they do certain allocation functions or redistribution functions or stabilization functions. And sometimes markets typically fail to provide collective goods such as police, electricity, water. These cannot be left to entirely to the private sector. These are basic essentials. And there are certain externalities which cause things like pollution. All of these, if we leave completely to the market, they will do right, left, center, and they will not take care of the biodiversity, and they will not take care of the forests. All these problems will come. So that is why markets cannot be, we cannot leave everything, the production, allocation functions, resource allocation function entirely to the private sector, right? So why the government needs to do, we already discussed. All right. So we have briefly understood what is meant by resource allocation function. So how the government do this resource allocation function? So in the real world, allocation is both market determined and government determined. How government do this resource allocation function? Government can do in various ways. This is one important question that was asked in the previous year question. This is previous year question, by the way. Wherever I highlighted like this, it is a previous year question. So how government do this resource allocation function? Sometimes government do directly. For example, electricity. Government directly do this. It will not be leaving it to the private sector. Sometimes government influence the private allocation, their investments through incentives and disincentives. For example, giving tax concessions for certain works, say renewable energy like solar power generation companies. What would happen when that happens? Automatically, the efficiency will be increased in the system. Government influence through incentives, disincentive, and government influence allocation through its competition policies. For example, things like Competition Act, all of these are there to ensure that there is a competition in the market and buyers are not exploited. So government regulatory activities, sometimes direct regulatory activities like risk licensing, like pharma companies, you need to get the license and then only operate, and sometimes put certain legal and administrative frameworks and mixture of any of these techniques. All right, so that is how government do the resource allocation function. Government not directly do all the times, government do not involve directly all the times, like providing public transport to a rural area. Government do sometimes, government may not do sometimes. Government influence private sector allocation through incentives, disincentives, all right, through competition policies, through legal and administrative frameworks, through licensing requirements. Okay, so that is what the government resource allocation function. Let us summarize what we have studied. Why the government, what are the different functions of the economic functions of the government? Allocation function, redistribution function, stabilization function. In the allocation function, why the government needs to do allocation, we discussed there is imperfect competition in the market, and private sector don't do every time certain allocation of resources for certain areas where there is a not much of profit. All right, so government needs to do certain resource allocation function. How the government do? Directly involved in the production or distribution. Second, they influence directly or indirectly by incentivizing, disincentivizing. Next, they put certain legal administrative restrictions on the products, right? So that is how the government do the resource allocation function. Next, resource redistribution. As I mentioned earlier, it is to ensure equity and fairness. Next, we're going to talk about distribution or redistribution function. So what is redistribution function or distribution function? It aims at redistribution of income to ensure equity and fairness, to promote well-being of all section of people. That is what the job of the government, and is achieved through taxation, public expenditure, regulation, and preferential treatment of targeted population. Obviously, targeted population is nothing but weaker sections mostly. So the redistribution function, why the government needs to do. First, let me give you an example for redistribution function so that you will understand. For example, the income tax, taxing people who earn more with high percentage, having surcharges, earning people who are earning less, charging them less percentage of taxes. This is what is the typically what this is called. So basically, you're taking money from rich, more money. I mean, ideally, as per the book, from rich, more money you're taking, from middle class, less money, poor, you're not collecting any money. So with that money, you're going to spend on poor people, right? So this is what is nothing but redistribution, right? Collecting it from someone and redistributing to the downtrodden sections. All right. What are the objectives of this function? As we discussed, equitable distribution, providing equality in income, security for the people, and ensuring minimum standard of living for everyone. That is the objective of the government. So that is why government do certain redistribution functions. The taxation policies of government, especially the direct taxation policies of the government, and to an extent indirect taxes policies also, are redistribution functions of the government. Taxing rich high, taxing poor low, and using those tax proceeds for financing public services, especially for low income households. And providing reservations is a classic example of redistribution function. Regulation and manufacture of sale of certain products to ensure health and well-being of consumers is also a redistribution function. Special schemes for backward regions and vulnerable sections, like all the reservations, or say the PM Kisan, or say the other government schemes aiming at poor people or downtrodden sections, is all these all are redistribution functions. All right, I hope you got it. Why the government needs to do this? As we discussed, if it is left to the private sector, they will not do this. right? So though we speak more about market economy, all of this, but yeah, we cannot left it to private sector. So that is why we have a lot of imbalances, right? The rich poor divide is so much. The rich is becoming more richer, and richer, and the poor are becoming poor day by day. So to bridge that gap, government needs to do certain economic functions. Those functions are nothing but redistribution functions, taking out from rich or the people who are earning and sharing it with the people who are downtrodden or poor income or lower income sections of the people. This is nothing but resource redistribution function. All right, then we have resource stabilization function. Sorry, the stabilization functions. All right, what is the stabilization function? Next, what is resource what is stabilization function of the government? We discussed two: allocation function, redistribution function. What is stabilization function of the government? So as you might be knowing already, there is always like bad after good. Even in the economy, good after bad, it is a cycle. The economy, as you can see from this diagram, see, the economy, for some point, for some time, it grows, it reaches peak, and then after a point it'll start slow down due to various reasons or whatever, reasons, be it could be any other reason, wars, whatever. So generally, this is a general um, way the economy functions. Even the world economy functions, there'll be a peak and then there'll be a slowdown, and after that, all of a sudden there'll be a depression or trough, and then there will be a recovery, and then again it'll reach peak, and again it'll slow down, and it's a cycle like this. Okay, so like this curve, it is a cyclical thing. It keep on going up and down. So that is what is this is how the economy moves. So there is a role of the government whenever there is a slowdown in the economy, right? Unless if government not involved and taken sufficient actions, it will get into a deep depression. And deep depression, depression means negative growth. It means there is a negative GDP in the economy. So that is very dangerous. People will lose jobs and opportunities will not be there, and the poverty will increase, right? And crime rates will go high. So all these problems will come. So government has to make sure whenever there is certain fluctuations in the economy, they put certain efforts, which will ensure the economy bounce back and return to the normalcy. So for example, during the COVID, there is a slowdown, the markets were shut, and there is a slowdown. Government has taken certain steps for each industry, which would help or say help them in recovering, and reaching back to the normal stage before COVID levels across all the industries. Even for the individuals, private sector, there are various benefits that were offered under COVID, after COVID, right? So these are the functions. Whenever there are such hiccups, so the government take certain actions which will bring economy back, the pedal back into the place, right? So that is the reason government has to do certain stabilization functions. It could be through monetary or non-monetary, right? So business cycles are like a normal phenomenon, natural phenomena. It will go up, go down. So the stabilization function is concerned with performance of aggregate economy in terms of, most important thing, employment, output, price levels, international payments, balance of payments, right? Balance of payments, the rate of economic growth, all these five are very important. The stabilization function is concerned with all these five. Government stabilization, maybe through monetary policy, it is like changing the bank rates, making borrowings at cheaper rate available to the private sector, or through their taxation policies, fiscal policies, like reducing the taxes or increasing the taxes, or it could be anything, right? So monetary policy, as we know, we will be discussing more in the chapter 3. Monetary policy has a single objective of controlling the size of money supply in the economy through interest rates, increase, decrease, right? And fiscal policy stabilization aims to direct the actions of individuals and organizations by means of its expenditure and taxation decisions. I hope you got it. Employment, output levels, GDP increase rate, price levels, all of these, balance of payments, international payments, all of these are concerned with stabilization function. All right. During the recession, government increases its expenditure. This is very, very important. If you understand this line, you will understand a lot in the economics. Trust me. During the recession, what government do during the, inflation, or say good growth, what government do with respect to money supply and the monetary policies and fiscal policies? Monetary policies are concerned with money supply in the money economy, actual money supply in the economy. Fiscal policies are related to taxation policies. During the recession, government increase its expenditure. Why the government increase its expenditure? Very important. We're going to discuss it in detail in the next unit. But yeah, during recession, government increase its expenditure so that people will have more money in their hands, right? So that they will spend again, and it will again revolve in the economy, and cuts down taxes so that people will have more disposable income, right? And there will be an increase in demand so that automatically productions will go high. Quite opposite when there is high inflation. What government do? Government reduce the money supply in the economy by putting more taxes, or cutting down its expenditure, right? So this is how government do the stabilization functions. Very, very important. These lines are very important. If you understand what government do in the slowdown and what government do when there is high inflation, if you understand this, you would have understood like 10% of the concepts in the economics. Very important. These 4 lines, very important. Understand it. If you don't understand it, read it, reread it, reread it. Okay. So these are the 3 functions of the government as mentioned by the Richard Musgrave. So just to give you a summary, we discussed public finance, fiscal functions, an overview. What are the different functions of the government? Resource allocation function to ensure efficiency, resource redistribution function to ensure equity and fairness, and then economic stabilization function. All right. So these are the 3 ways government involve. The fiscal functions of the government can be divided into these three. What is this? What are those? Resource allocation, redistribution, and stabilization. These 3 are the functions of the government, fiscal functions of the government. Okay. So with this, we are through with chapter 2, unit 1. All right. So stabilization functions we discussed. So that's about chapter 2, unit 1. Now the next chapter that we have is next unit in chapter 2 is market failure. All right. Next unit in the chapter 2 is market failure. Let us understand what is market failure. All right. What is market failure? What is market failure? We discussed about the resource allocation function of the government. So why government needs to do when the private sector is doing everything? Why government needs to involve in the economic functions of the, of economy? We discussed already. There are certain inherent limitations if we leave everything to the private sector, right? When there is a problem that caused due to these imperfections in the market, that is called market failure. market failure with a simple example. All of a sudden, there is a price rise in the essential commodities. For example, vegetables, right? Why this is happening every year on year? Why this is happening? It is simple. There is certain misallocation of resources. The demand and supply, there is a mismatch. So when that is there, the buyers are more than the sellers. So when that scenario is there, the seller exploit the requirement and charge high prices, right? This is one classic case of market failure, right? This is nothing but misallocation of resources. So when when the prices are increased, what would happen? Poor people will not be able to buy all the basic essential commodities like vegetables, right? So this is a serious problem. So that is nothing but a market failure. Okay. So what is market failure? It is a situation in which free market, it means there is no government interference, leads to misallocation of society's scarce resources. Of course, we speak in the economics only about scarce resources. If there are abundant resources, we are not going to speak about it in the economics. Economics revolves around scarce resources, in the sense that there is either overproduction or underproduction. Not just underproduction, even could be overproduction. Sometimes, the farmers, the same farmers, when there is a bumper crop, they will have to sell their product at a throwaway prices, right? That is also a classic case of market failure. Why government has not acted? Why government has not taken the sufficient steps to give them the minimum support price, right? So that is also a market failure. It could be both extremes. It could be overproduction or underproduction. There could be complete fall in the price, or could be complete rise in the price. Both scenarios, this is nothing but a misallocation of society's scarce resources, right? Either underproduction or overproduction. These two important words, okay? Free market, misallocation of society's scarce resources, overproduction or underproduction of a good or service, leading to less than optimal outcome. Optimal outcome means the price, or say the product that is available to everyone at a right price, at a right place, at a right quantity, right? So that is optimal outcome. Wherever there is market failure, there is certain misallocation of society's scarce resources, which leads to overproduction or underproduction of goods or services and lead to a less than optimal outcome, right? Could be a negative outcome, right? Most of the times. So there are two aspects of market failure. Namely, as we know, why the market failure happens could be two reasons. Either demand is more than supply or supply is more than demand. When demand is more than supply, what would happen? Overproduction. When supply is more than demand, when supply is more than demand, it leads to overproduction. When demand is more than supply, it is an underproduction of resources which cause that scenario. So market failures could be divided into demand side market failures and supply side market failures. All right. Demand side market failures and supply side market failures, right? So what are the different types of market failures that can be, there in the economy? Demand side market failures are said to be when demand curves do not take into account fully willingness of customer. As we know, we discussed about all the vegetable example. And supply side market failures where there is more supply and less demand, right? So I'm not getting too deep into it since it is a revision class. Next, what are the different sources of market failure? Why do markets fail? What are the different reasons markets fail? Markets fail means not the entire market collapse. Market for vegetables, market for essential commodities like markets for electronics, it could be anything, the market, relevant market of a product. There are main 4 reasons if we divide why there is such a problem, market failure happen. Those problems or reasons can be divided into 4. Those are here. What are those? Market power. 1. That is nothing but monopoly. There are many things that we are consuming right now. We are in monopoly. We officially not in monopoly, but yeah, duopoly or oligopoly. It means either there are 2 service providers or maximum 3 service providers. So the market power, it means a particular person commanding more market in the economy, market for a particular product or service, will give him automatically market for example, say Flipkart, Amazon. Most of the times people, 80% of the times, buy either from these 2 places, right, or from the subsidiaries of these Flipkart or Amazon in e-commerce. So when this is a scenario, what is the situation after a point? After a point, they both will have complete control on it, and they will exploit it, and they will extract from people what they have lost all over these years by giving huge discounts, right? So this is nothing but market power. Next we have externalities. Very, very, very important. I can say this is a category, externalities. The classic example is things that are not actually factored in the cost of production is what is externality. Things like pollution are classic cases of externalities. These are the reasons why markets failure. Why when the pollution affects and the cost of this and the life cycle cost and the production, production that is lost due to the people becoming sick due to the pollution, these are all not factored in a product, the pricing, because there is no price that is assigned to a pollution that they cause other than the normal pollution tax and the impact on the public. So when this is not factored, the product that you're selling is at not yet right place, not right price. Those are externalities. Next we have public goods. These are sin of government. We would not say sin, but yeah, the government providing goods at a free of cost is also a reason for market failure. We will discuss briefly one by one again. And then we have something called incomplete information. Either buyer has having more information than the seller, or seller is having more information than the buyer. These are the scenarios where the markets fail. All right. So market failure could be due to these 4 main reasons: market power, externalities, public goods, incomplete information. You have to remember this, right? How do you remember this? What are the reasons? You need to have mnemonics. I already said once, try to create mnemonics. See, simple: Ministry of External Public Information. Ministry of External Public Information. I just gave you, for a second, I looked into it and then I started it with the mnemonic. Ministry. So you can, M. As you know, ministry, ministry, or you have 3 different ways to look into it. Ministry of External Affairs and Public Information. Ministry of External Affairs and Public Information. If you just remember like that, then M stands for market power, externalities, external, public means public goods, incomplete information. How silly the mnemonic could be. If you remember it, as long as you remember it, it's good. You're not going to write the mnemonic that you're going to remember, right? So you will use that to register in your memory, right? So whenever there are questions, right, simple 2 marks question: what are the causes of market failure? You need to write these: Ministry of External Public Affairs, public information, market failure, Externalities, public goods, incomplete information. All right. I discussed about briefly about market power, the monopoly thing, and then we will quickly see other things. Okay. Market power is nothing but monopoly power. They use it for their own advantage and earn unusual profits and put burden on the buyers or consumers, right? Then the next and the most important and the examiner's favorite is this externalities. Okay. Externalities is very famous. Very favorite topic for the examiner. Define externalities. What are the features of externalities? Last year question. What are the 4 possible types of externalities? Last year question. And I mean to say last year means previous year questions. Okay. So understand in detail what is externality. Okay. This is a straight line you need to remember. Externality is a cost or benefit of an economic activity experienced by an unrelated third party. If there is a transaction between two parties, say buyer and seller, but due to this transaction, some third party who has no relation to this has to pay some cost for it or had some benefit due to this transaction, that is called externality. All right. So externality is a cost or a benefit of an economic activity experienced by unrelated third party. Very important. Cost or benefit experienced by unrelated third party. Clear? Cost or benefit experienced by unrelated third party. The example of pollution that I gave, I will elaborate a bit. For example, there is a manufacturing plant, there is a cement manufacturing plant in a village. Due to the pollution that is created by the cement manufacturing plant, the locals there, their water and their soil has got so much of impact that their land has become so infertile, and the amount of efforts that they put in, but the returns that they get is not equivalent to someone who's earning say 100-200 kilometers away from that village. So the villagers here had certain cost due to this cement factory, right? That is loss of productivity, isn't it? The loss of productivity is the cost that is not factored in the cement price, because for them it is not related, right? It is not. This for cement manufacturing plant, it is not related. How much indirectly people suffered there is not factored in their costing. When we are studying costing, did we ever see the cost of pollution or cost damage that caused to unrelated third party? No, right? No. 99% of the times, those things will not come into the costings. So that is also a big cost, right? Which is it is borne by some unrelated third party. This is called externality. The unique feature of externality is that it is initiated and experienced not through the operation of price system, but outside the market. The example of pollution is the classic example, right? This is one last year question only. Define externalities means you need to write this. What are the features means you need to write this. Features. These are also called spillover effects, neighborhood effects, third party effects, or side effects. Externalities may be unidirectional or reciprocal at times. Externalities can be positive or negative. This is something you need to remember. Always don't think externalities are positive alone. For example, in an area, there is a fly or foot overbridge that was constructed. Or say in an area, government announced a tech park. What happens? Automatically, the people around that area, announced place, will become crorepati's, right? Their land value will jump, leaps and bounds. So what is this? Here, they have had positive impact, right? Even that is also externality. It is experienced by unrelated third party, someone who is there, near, who bought land. All of a sudden, government has started with the good intention, some tech park there, and all of a sudden the land values increases. Here, what happened? It impacted positively the locals, right? So this is also called positive externality. There are four types of externalities. One is negative production externality. Next, positive production externality. The one example that we gave is positive production externality. Negative consumption externalities. Positive consumption externalities. Negative consumption externalities is what about pollution, right? So negative production is pollution. Negative consumption, right? Negative consumption externalities, right? Negative production, negative consumption, positive production, positive consumption. These are four. The question is asked, what are the different four types of externalities? 3 marks question is asked in the previous years, right? So we know what is negative externality and what is positive externality. I am not getting too much into what is positive production externality and what is negative production externality. Please read and you will understand it easily, right? So this is the second reason of market failure. Okay. Next, public goods. Next, public goods. Next, we are talking about the reasons for market failure, right? We spoke about market power, externalities, now about public goods. This is very interesting and controversial, in fact. Public goods. What are the public goods? Public goods do not conform to the settings of market exchange and left to the market, and they will be produced at all, and all will be underproduced. This is because the price becomes zero. What is the problem with the public goods? What is the problem when we give things freely to the public? What is the problem when government is giving freely, say for example, electricity, free electricity to the farmers? I said it is controversial, but yeah, free electricity to the farmers. What is the problem here? Government incurs a lot of cost, but it is given at free of cost. When it is given at free of cost, no one will feel the value for it, right? Unless we pay, we don't feel value for it. So what happens due to the free electricity given? People overutilize it. That is called free rider problem. When you don't assign a value, people will not value it. They'll just switch on their motor for the whole night and they will leave it and they will come only in the morning. Let it be. They are not going to incur any cost, right? So that is the problem with the public goods, isn't it? So what this leads to? This leads to misallocation of resources. The power that we have wasted there, right, could have used it some other place, and we could have, achieved more productivity, right? So that's the problem with public goods. So as we are here, we need to also speak about private goods. We are talking about public goods. Question is asked last time. Difference between public goods and private goods. So what is the difference between public and private goods? Private goods are manufactured and sold by the private companies to satisfy consumer needs. Public goods are for the greater good of people, which are provided by the government or for use freely, right? Or at nominal cost. You get it? That's a public good. Provider is nature. For example, water, all this is nature provided. So that's why we don't value much. Manufacture, entrepreneurs, providers. So consumer equality, preference to, of course, people who have money. It is readily available to all equally, and it changes from person to person, vary, right? Quality, it remains constant. Public goods, it varies, the ability based on the ability to buy. It is a social choice. It is a consumer's decision, right? So these are the public goods. So the problem is these are for the facility and welfare of public in general at free of cost. Whereas private products, which are sold by private companies, they earn profits. So whenever we are buying a product, we buy it whether we need it or not. We evaluate it. What is our ability to pay? But when we are getting freely, we don't really think whether it is really required for us or not. Still, because they are giving us freely, we will take it, right? That's a problem that leads to market failure. So I already discussed about characteristics of private goods. So what are the disadvantages or problems with the public goods? Problem of free rider. Problem of free rider. Free rider we discussed. When given it free, people don't feel value for it and they just use it. And excessive production cost. A lot of times these are not done by the private companies because there are not much of profits, right? So what happens? There is so much of production cost. Government spends so much money to bring that available, to make it available for the public. There's so much production costs involved, right? Even for the electricity, for example, and people take it for granted. And obviously, all these reasons could lead to a market failure, right? Public goods create a market failure. You get it? These facilities or benefits are taken for granted and misused, not maintained by some people, since they have not paid for it, or they did not realize its value. This is a big problem in a country like India. We have a big free rider problem, isn't it? Yeah, that's about public goods, one of the reasons for market failure. The next one is incomplete information. Next one is incomplete information that we all must have experienced in our daily lives. You know, this particular thing. In fact, all these four, but this we must have experienced it live. What is the problem of not providing complete information by the private sector? Right. How the incomplete information leads to a market failure. As I said, we all must have experienced this. What happens? See, the information failure in country like India is widespread. So people are not able to take rational or informed decisions a lot of times when they are buying products. For example, sometimes by giving a misleading advertisement, people tend to buy certain goods. Sometimes by giving a false information about the product, for example, they would write on it purely organic. But in real scenario, there are many big companies who are doing business like this, who write it as purely organic, but in the real scenario, they have more chemicals than the other products that are in the market. But who is going to check that? By giving that false information on the product, they are misleading the customers and they are making people to buy their products, right? What this leads to? This leads to a market failure. How this leads to a market failure, I'll tell you. Someone who's doing a honest business, for them it will impact, right? Many times consumers are unable to quickly or cheaply find sufficient information on the best prices as well as quantity for different products. Sometimes they misunderstand the true costs or benefits of a product, right? This incomplete information issue can be divided into three. Keep the advertising thing in your mind as an example. How this incomplete information can lead to a market failure. We can divide this incomplete information into three different ways. One is asymmetric information, sharing asymmetric information. Second, adverse selection. Third, moral hazard. We're going to discuss all three. What is asymmetric information? Symmetric means, you know, right? Balanced. Asymmetric means imbalance. Between whom? Between the buyer and seller. Most of the times, the seller will know more than the buyer. So when that is the case, the seller will be at an advantage to exploit the buyer, right? Buyer don't know much of the information. This phenomenon is called very important, is called Lemon's problem. It is called Lemon's problem. This phenomenon is called Lemon's problem. The question is asked last time, what is Lemon's problem? Please explain with an example. The seller is having more information about a product. What it would lead to, seller would only disclose what attracts buyer, right? He will not disclose what discourages buyer to buy a product. This is one important source of market failure. So due to this, what happens? Low quality goods drive the market. Low quality goods will get the market share. Example for this, the classic example given is the second-hand market. The second-hand market of cars, especially. The cars, second-hand market, cars, generally the buyer or the seller knows much more than the buyer or the broker, whoever is there. Because he would know how many accidents this car met, and he would know, nobody know other than him, because if he's not going to a service center for getting it repaired, nowhere you will have a track. He got it done at local center, local mechanic. So then you will not be able to try. You get me the highest level of mechanic. A lot of times you will not be able to find faults in the cars, right? So what is the problem here? The buyer knows less information. There is no balance in the information. He will not be able to take an informed or say balanced decision. Buyer will not be able to take a decision. He might be thinking that it is coming at a cheap rate, but in fact, the original or the fair value of that car would have been less than that. This is called Lemon's problem. When there is a asymmetric information between the buyer and seller, that is called Lemon's problem. Okay, lemon. It's a kind of colloquial word, Lemon's problem in the economics. It is an important source of market failure a lot of times. What would happen due to this asymmetric information? Low quality goods drive the market, and high quality goods, they will not be able to sustain, though they are giving a right quality. People will not buy it because they look at it and say, wow, this car is coming at a cheaper rate. Why would I go for some good car in the first hand? So that's how this leads to a problem. Low quality goods drive the high quality goods out of the market. That is a bigger problem. That is nothing but an adverse selection. Adverse selection is a situation in which asymmetric information about quality eliminates high quality goods from the market. People, whoever is producing honestly, those products will incur losses, and they'll have to, those products will go out of the market, right? Used car market is one of the classic example that I gave. Next, even in this asymmetric information, the incomplete information. The third one is about moral hazard. It means people know it is wrong, but they do it. Because of their actions, it impacts the entire consumer group. The classic example is health insurance, right? Someone is taking health insurance and claiming bills right, left, center, sometimes even the fake bills. It is an opportunism. It is an opportunism. Opportunism means exploitation, exploiting the opportunity characterized by an informed person taking advantage of less informed person through an unobserved action. Simple. Example, the insured consumers are likely to take greater risks knowing that a claim will be paid for by the insurance company. The more one's costs are covered by the insurance company, the less a person cares whether the doctor charging excess or using inefficient, costly procedures in his healthcare. Because I have faced this personally. When you go to a hospital with a health card or say insurance, the bill that you're gonna get is generally 30 to 40% higher than your normal bill without insurance. If you go, why this happens? Most of the times these hospitals take advantage of your insurance policy because anyway this will be reimbursed by insurance company, right? So what these hospitals do, they'll give you even the medicine that is even not required sometimes, and which is not harmful most probably. You might have some side effects, but they'll keep you more than the required days in the hospital. All these things, knowing, the hospitals, because they have more information how the claim needs to be presented to get it accepted, and they will write so much this, that this person has this problem, that problem. We will not really care, right? Because anyway we are not paying from our pocket. We means uh, the patient, because it has been paid by the health insurance company. If that is the case, what happens? This is nothing but a moral hazard. Moral hazard means morally danger. What happens in the next year? That's how the health insurance premiums keep on increasing year on year. This causes insurance premiums to rise for everyone, not for him alone. Generally, the insurance premiums at the end of the year look into it, right? For each bracket, what is the amount that we are incurring? Based on that, they decide premium, right? So what happens? This insurance premiums becomes expensive, and sometimes some people will not be able to afford and buy these insurance policies. So this is like knowingly or unknowingly, unobserved by consumer, but the hospital who has more knowledge about this product, they'll use this as opportunity and they put more bills and they claim more insurance amount. This will lead to next year excess premium for everybody, not just you, right? That is called moral hazard. I hope you got the clarity. We studied. Let us quickly revise what we have studied. In the chapter 2, unit 2, market failure. What is market failure? We understood in the free market, misallocation of society's scarce resources. It could be overproduction or underproduction, which will lead to less than optimal outcome. And what are the major aspects of market failure? Demand side market failures, supply side market failures, right? And next, what are the major reasons of market failure? In detail, we discussed market power, externalities, public goods, incomplete information, Ministry of External Public Information. Okay, so that's how you need to study and summarize your understanding. Always you need to have a overview of a particular unit or a chapter so that you will be able to understand how the questions are being framed, right? So all this is very important for you, to have that overview of when you are going before the exam, you need to revise quickly all the areas. You just have to look into it so that you will feel confident. Okay, so use this material to look into your headings, subheadings, and then before going for the exam, ensure that you know something about everything. Okay, get it? That's about chapter 2, unit 2, market failure. The next chapter, next unit is unit 3. What are the government interventions to correct market failures? We are talking about public finance. So we talk more about government. market failures, what are the government interventions to correct all these problems that we are having in the market power, in the externalities, public goods space, and incomplete information given by the producers? How do we address, how do government intervene into this to correct these, market failure reasons? The next unit is government interventions to correct market failures. Okay. Next is government intervention. It is just a continuation of this unit. How the government intervene in each area, say market power, how government intervene. Say next, externalities, how government intervene. Next, public goods, how government intervene to correct the market failures. Next, incomplete information. What are the steps that government take to ensure people get the right information on the products or services? That's about it. We are going to discuss it now in the unit 3, government interventions to correct market failure. Could be direct or it could be indirect. We're going to discuss it now. Okay. What are the four different what are the different government interventions to correct market failures for those 4 reasons of market failures, which are market power, externalities, public goods, and incomplete information. Okay. Now, these 2 and 3 units are very important. So what are the government interventions? How the government intervene to minimize the market power? As you all must be knowing, how the government intervene to minimize the market power. So government do not encourage monopoly in any industry or market per se. So that is why we have various laws in place. For example, Competition Commission of India Act, Competition Act, which is very important, that nobody should involve in monopoly activities, wherein they kill the competitor and they acquire the entire stake and they do the business. They become monopoly in the market. For example, in the recent acquisition of Walmart, recent acquisition of Flipkart by the Walmart has led to a lot of scrutiny, whether it lead to a monopoly trade practice or not. So the government has certain restrictions in place to avoid these market powers, monopoly powers. So important one is Competition Act. Next, such legislations generally aim at prohibiting contracts, combinations, collusions among producers or traders. For example, you hear that cement companies are, unofficially forming as a cartel and increasing the prices, right? That is in a way, this is a contract that they all have come together and they colluded and they have all increased prices all at once. These all are prohibited. Some of the regulatory aspects which of the market failure tend to create and protect monopoly. That is a bigger problem. Sometimes the actions of government create new monopolies. Okay. So the major intervention of government in the market power is ensuring the right laws and regulations are in place. Next, externalities. What is the role of the government here? Correcting the externalities. How the government correct externalities? Decide and assign a price for each externality the producer is producing. For example, in the pollution case, government coming up with, based on the pollution that they generate, charging them, penalizing them, right? These all are ways through which government intervene and try to correct the externalities. All right. It can be 2 ways. One is direct controls It means they openly regulated certain things. And second is market based policies. It means incentivizing certain activities, disincentivizing or taxing certain activities. Okay, in that the most important one is, since we talk about externalities synonymous with pollution, important one is pollution tax. One method of ensuring internalization of negative externalities is imposing pollution tax, right? So this is one case where the ways in which government ensure and try to reduce the unaccounted externalities. But of course, there are certain problems in these pollution taxes. Those are other problems. And another way is cap and trade, putting certain cap on it. And whoever is having, balance, they can trade the pollution. For example, the pollution, the carbon credits, example, whoever is, all the, pollutants will be given certain credit. Okay, they need to buy it from the government. Say for producing say 3 tons of pollution, government will give them credits. They pay certain money. Say for 3 tons you need to pay 1 crore rupees, they pay. So whoever has not released that much of pollution, they can sell their uh, you know balance to another manufacturer or the other company who's in requirement. So it is in a way incentivizing and disincentivizing. There are problems in this also, right? And government interventions in cases of merit goods, they encourage merit goods and they discourage demerit goods. These all are the ways in which government intervene, and correct the market failure. In the form of in under the heading of externalities. Next, merit and demerit goods. That we have public goods case, right? So public goods case, government encourage use of public goods, and whatever competition comes for the public goods, they discourage. Government um, intervention in case of merit goods is example is governments can prohibit sometimes type of goods or activities, set standards, issue mandates, making others oblige, right? Government interventions in demerit goods is simple. They just put extreme, government enforce complete ban. For example, say electronic cigarettes, something like that. Regulatory controls, putting lot of restrictions. What happens due to these restrictions? You will not be able to do it easily. What are the government interventions in case of public goods? What is the problem with public goods? These are freely provided. So what government needs to do, certain goods are produced and consumed as public goods and service, despite the fact that they can be produced or consumed as private goods. Even private also can produce. But this is because if it is left to market only, you see healthcare can be left to private sector as well as, but if it is entirely left to the private sector, poor people will not be able to get, right? For example, maintenance, security at airports can be privatized to an extent, cannot be done completely. So those things government needs to ensure. Next, price interventions by increasing the taxes, all that also comes into it. So government, that is the way government address the issues of merit and demerit goods and try to maintain balance. The next is the fourth one. The fourth one, important one, is incomplete information. How the government face the problem to correct the information failure? Government has put lot of rules and regulations. For example, government makes it mandatory to label the products, especially the food products, what kind of contents that used and what is the veg or non-veg, or what is the ingredients that used. For example, disclosure requirements of SEBI to provide accurate information. Government giving certain public, sharing information with public. Regulations on advertisements, there are so many restrictions on the advertisements also. If someone put false advertisement, misleading advertisement, you can sue the particular company, right? What are the government interventions to equitable distribution, right? So intervention do happen for correcting information failure to ensure it is distributed among all the weaker sections also. But there will be a scenario where government itself will fail doing this. Intervention sometimes are completely ineffective. As we know, government itself has a lot of inefficiencies. A lot of times they take actions at late, it more of firefighting measures, not before it becomes a serious problem, right? So these all are the issues with the government. All right. All right. So these are the problems with government. So government sometimes will not be able to completely correct the market failures. Okay. With this, we are through with chapter 2, unit 3. We have covered it overall. Okay. Let us quickly see the revision material. Government interventions to correct market failure. We discussed minimize market power, correcting the externalities, merit and demerit goods, how to encourage merit goods and discourage demerit goods, correcting the information failure, ensuring equitable distribution, for example, among rich, poor, women and men, right? And kids, all this equitable distribution, right? So government interventions could be direct and could be indirect. As a buyer or procurement, for example, in case of farmers, they buy on their own, right? As a supplier, sometimes providing certain essential information. Indirect ways, changing the tax structures, putting certain regulations. It can be direct or it can be indirect. Okay. There's certain important thing that I need to discuss. Common access resources. It was asked in the last year. Common access resources are special class of impure public goods which are non-excludable, as people cannot be excluded from using them. These are rival in nature and their consumption lessens the benefit available for others. For example, fisheries, forests, backwaters. These all are common access resources, things that are available to everyone. But if someone uses it, the next generation or next generations will not be able to have that benefit. Those are called common access resources. It means these are non-excludable, means you can't selectively give access to one person and not to other person. So obviously the issue with common access resources, this it has to be used rationally. Okay. The free rider problem, as I discussed, free rider is a person who benefits from something without expending effort or paying for it, right? Incomplete information, asymmetric information, adverse selection, moral hazard, all are given in a small box. So keep that very very important. So keep revising it. Okay. Next we have chapter 2, unit 4, that is fiscal policy. Chapter 2, unit 4 is fiscal policy. Fiscal policy. What is fiscal policy? We discussed already fiscal functions. Fiscal functions are nothing but government actions related to revenue, receipts, and expenditure, right? So fiscal policy revolves around that, the policies of government related to their receipts and expenditure. All right. So this is about fiscal policy. Right. So fiscal policy, unit 4, fiscal policy. What is fiscal policy? Why the government has to take policy decisions related to economy is the question here. Fiscal, we know the meaning, the functions of a government related to the receipts and expenditure, especially the taxation policies. So the why the government has to involves too much into the fiscal policies of the government. For example, in certain countries there is no tax. There are few countries where there is no tax. Government has certain businesses, they function in that. So the fiscal policies of a government is of so important in the current economic world, though it is fully dominated by the private sector. But the policies of government, the fiscal policies of government has so much of importance to achieve certain socio-economical objectives. certain socio and social and economic objectives. There is a significance, huge significance for government's taxation policies and government's expenditure policies, government, various schemes. It was, in fact, till 1930s in all the, say West countries like US, Europe, they all believed in absolute capitalism. It means they have advocated for complete private sector. It means let the private sector decide what to produce, how to produce, how much to produce. Government, you just take care of other traditional, aspects of the governance. Don't enter into the economics or finance matters, right? Be it in the taxation or be it in, you don't involve too much into it. There is a limited role for the government, because till 1930s people, most of the developed countries believed in the concept of laissez-faire approach. It is some Greek or Latin word. Laissez-faire approach means let the market decide. Laissez-faire means let the market decide what to produce, whom to produce, how much to produce. Let the market decide. Government, please stay away from it. That used to be the policy. But in 1930s, world has faced the, world's, the Great Depression, it used to be called. The stock market has fallen for more than for 40% or 50% in a single day. So the Great Depression that has, shaken the world in 1930s. So that's when people have again thought there is, proactive and important role of the government in the economy. There is a very important role for the government in an economy. They are uh, required to take, shots. They are very important. Government is important to take certain decisions to achieve certain socio-economic objectives, right? So fiscal policy typically involves use of government spending, taxation, and borrowing for what? To influence both the pattern of economic activity and level of growth of aggregate demand, output, and employment. These are the like four I's, right? To influence the economic activity, growth, demand for goods, right? Growth of demand, output, and employment. These are very important, right, for any economy. So these are the decisions of the government. Fiscal policy typically involves the government spending, taxation, the changes in these and borrowings to influence both pattern of economic activity and level of aggregate demand, output, and employment. What are the objectives of the government? What are the objectives of the fiscal policy of the government? What are the major objectives? It can be put it in three: equity, sustainability, growth. Equity means ensuring poor are getting access to various, services, products. Stability, and there is a growth, ESG. These are the main objectives. What are the most common objectives? Employment, price stability, economic development, equitable distribution of income and wealth. So anything can be fit into these three. For this, how the government influence the economic activity, right? So we were talking till now about what is the fiscal policy, what is the objective of fiscal policy. Now, how the government influence and ensure the objectives are achieved. So that it can be divided in the government actions or the things, fiscal policy actions can be divided into two. One is automatic stabilizers, and another one is discretionary fiscal policies. Basically, automatic stabilizers, and these are non-automatic. These are discretionary. The actions of government's fiscal policy actions will have the impact in the economy. What is automatic stabilizers? Government program that automatically tends to reduce fluctuation in GDP is called automatic stabilizer. Like any program of government, try to automatically gets adjusted, in the fluctuations is called automatic stabilizers. All right. So just to give you an overview, we discussed objectives of fiscal policy. Then we are discussing about automatic stabilizers versus discretionary fiscal policy. Okay. So what are the automatic stabilizers? Let's see with an example. So what are those automatic stabilizers? Automatic stabilizers, in simple terms, things that are already existing in place, which will have a compensating impact. For example, for example, personal income tax that we have. Whenever there is a slowdown, suppose whenever there is a personal income tax, be it corporate income tax, whenever there is a slowdown, income of people reduces either due to job losses or there are no increments. So what happens due to that? The progressive structure that we have, based on the amount of money that you earn, you will be taxed, right? So if you are earning less, your disposable income will be generally more. So if you are earning more, your taxation rates are more. So when there is a slowdown, automatically the things like direct tax that gets changed, right? When there is slowdown, generally the direct tax receipts also reduces, right? So what happens due to this? There will be more money in hands of people, right? There will be more money in hands of people. When the disposable income is high, then they will be able to spend, right? For example, someone who's coming in, say 50 lakhs and above bracket, someone who's coming below 50 lakhs and 50 lakhs bracket. Say if you are someone earning more than 50 lakhs, they have to pay surcharge, say surcharge of 10%. But due to the slowdown, the businesses are not going well, their income is less than 50 lakhs. What happens? The income tax charge is less. So automatically, we are talking about one person, but imagine over a country, the overall dispensable money available with public will be high whenever there is a slowdown because of the reduction in tax collections. Disposable income at hands of people will be high. So this is kind of stabilizer, right? So automatic stabilizer. What happens when there is high inflation? Similarly, when there is high inflation, or what happens when there is economy expanding and employment is increasing? With progressive system, what happens? We collect more taxes from the people. This leaves with lower disposable income in the hands of people, and thus there is a decline in the consumption, therefore the aggregate demand. So that will keep everything in control. You get it? So that's what about automatic stabilizer, right? So those are called automatic stabilizers. The other one that we have is discretionary fiscal policy measures. Discretionary fiscal policy measures are nothing but actions that are taken by the government intentionally at that moment to correct the slowdown in the economy or to correct the inflation in the economy. For example, the example for the discretionary policy, government may directly as well as indirectly influence. For example, GDP is consumption expenditure, investment expenditure, government expenditure, and net imports and exports. So government can influence in any of these factors, right? Government can change consumption expenditure, government can change investment and expenditure, government expenditure through their policies, right? Even the exports, right? Suppose during the COVID, or there is a slowdown in the economy. So what government has done, government has reduced the tax rates during that period. Our government has given certain incentives to certain industries. So what are these? These are trigger point. COVID is a trigger point. Due to that, government has taken certain actions which will have influence on the GDP per se, which will have influence on it, and it will lead to any of these. It will lead to, it will ensure the government achieve their objectives of fiscal policy, which are equity, sustainability, and growth, like price stability, getting full employment, economic development, income distribution, equitable distribution. All right. So it can be any way. They can do it directly or indirectly, right? So we all know GDP is the value of all final goods and services produced in economy during a given period. So the right side of equation shows different sources of aggregate spending on demand. So government can influence in any ways. They change the net, rules for exports, rules for imports, through which they can play, right? So to achieve the above objects, whatever they do to achieve these objectives, all right, those are discretionary fiscal policies. So what are those different types of fiscal policies that are with the government? All right, what are those different types of fiscal policies that are there with the government? Majorly, those can be divided into four. One, government expenditure. Next, taxes. Third, government debt. Fourth, budget. Expenditure, taxes, debt, budget. Four. These three we will remember: expenditure, taxes, basically receipts and expenditure. Receipts are in the form of taxes and borrowings, expenditure, and additionally budget, the planning that they do. So these are the four instruments through which, these are the discretionary fiscal policies through which government influence various things in the economy. All right. First one is government expenditure. Very important. Trust me, if you understand this, I told you some time back, there are four lines. Those you need to understand it properly to understand like 10 to 20% of the economics or the public finance chapter. So here, government expenditure as an instrument of fiscal policy. How the government expenditure works as an instrument of fiscal policy to correct the market issues, right? So how the government expenditure work as an instrument of fiscal policy, right? How the government expenditure work as an instrument of fiscal policy. It is the most important instrument, fiscal policy, which influence and ensure the fiscal policy objectives of equity, sustainability, and growth are achieved. The required objectives are achieved. How the government expenditure act as a objective to achieve instrument of fiscal policy. So public expenditure are income generating and include all types of government expenditure, such as capital expenditure on public works, for example, building roads, and relief expenditure like in people in distress, giving them, and subsidy payments for farmers or industrialists, transfer payments like giving certain old age pensions, all of this, and other social security. Social security will be benefits, old age pensions, all of this. So the government expenditure broadly can be divided into three. One, current expenditure. It is nothing but day-to-day expenditure that is required for the government, salaries, or say the admin expenses or other costs that are incurred by the government departments. Next, capital expenditure, which we all know, which are in the form of investments made by the government, which are in the form of investments made by the government, which are planning to be yielding benefits in the long run. Those are like infrastructure, building roads, power plants, or say, irrigation projects, all of these. These are capital expenditure. Next, we have transfer payments like government spending, which doesn't contribute to GDP. It is like payments to all the, say, PM Kisan, all of these are transfer payments. How this happens? So we know, I'll take an example of COVID. During a recession, what government do? Government's fiscal deficit, or it means the the expenditure spent by the government more than their revenue is almost like touched 4% during the COVID. It is like high. Why government do that? When there is a slowdown, why government will have high fiscal deficit? It means they spend more. I'll give you an example, or this is very, very important. Try and understand this. When there is a slowdown, government spend more on the projects, be it current expenditure, capital expenditure, transfer payments. Government do this more rather than when there is a good growth in the economy. The amount that government spend on these three will be more when there is a slowdown. Why? Because unless you give it to public money, how there will be a growth? If there is a money in hands of people, then they will buy the products that they need, right? If they buy the products, then the producers can produce goods, right? That is a cycle. Say, producer has to produce the goods, but for which the there should be a demand for the product. For the demand of product, people should have money, right, in their hands. So if this has to happen, someone has to pumps money into the system, and there is a slowdown. What happens? Private investments generally go back. So private companies, they don't invest when the when the sentiment is not good. When there is a slowdown, they defer their huge investment decisions. For example, a car manufacturing company, they wanted to set up a plant in a particular state, but when there is a slowdown, they think and they defer their plan because there is not much of demand right now for cars, considering the slowdown, and people are not having too much of incomes. So let's defer it for another 2 or 3 years. What happens? Already there is a slowdown and there is a fall in employment and the investments are not coming. All this will lead to another problem, and it will lead to a recession. So to avoid that damage, what government do? Government take up more road projects, for example. So what happens? More money will be given to the contractors. Contractors will give to their employees, the workers. So the money will flow, right? So what happens due to this? There will be a there will be money in hands of people, so that there will be a demand for goods, isn't it? So that's how the cycle works. So when there is a recession, government takes fresh wave of public works for a simple reason, is to ensure there is a money in hands of people. All right. Apart from direct effect, there is also indirect effect in the form of money multiplier. We all know. So if we just do one work, that keeps multiplying, right? So the extent of spending by people depends on their marginal propensity to consume, how much they can really consume it, right? So this kind of putting money in hands of public, right? During the times of slowdown or depression, very important. It can be divided into two types. The way money is put in hands of people, injecting money into the public, can be divided into two types. One is called pump priming. One is called pump priming. Another one is called compensatory spending. Another one is called compensatory spending. Very important question is asked. Question is asked previous year. Question is asked on pump priming and compensatory spending. What is the difference? So by the word itself, pump priming, it means it is just one shot injection of money into the depressed economy. What is the objective? Government do at once. For example, government giving all farmers, increasing the under PM Kisan, Instead of giving 6,000 rupees, they started giving 12,000 rupees, right? They wanted to inject more money in the hands of people. Okay. So it is a one shot injection into the depressed economy with the aim of boosting business confidence, of course, business confidence and encouraging private investments. It is a temporary fiscal stimulus to set off the multiplier process. It is temporary for one shot. Say, for example, to help you in understanding this, say in a particular industry, say car manufacturing, all of a sudden there is a slowdown. So say in 2019, 2020 earlier, government has come up with so many incentives for them, right? One of it is, I know government has not injected money, but government has directly injecting money. For example, government took up more projects, as one shot. Government has taken up very big project and they've started working on it during the slowdown. What happens? There'll be more money in the hands of public. The objective is temporary injection of purchasing power into the economy. So the objective is to increase the purchasing power of the people. Okay. This is just one of, it is not done again and again every year or every month. So it is one short thing. When these scenarios, when the pump priming happens, for example, during the COVID also, people discussed about helicopter money, nothing but giving more money to the people. In what way is okay secondary, either you are distributing it or in other way. So this generally happens during post war, when there is a war in a country. So people and the businesses would have been already um, you know damaged. So to ensure they get it, so government put money in the hands of public so that they demand for the products, and then they'll be able to rise the output in the industrial output. Okay. So that is called pump priming. You need to remember is one shot injection of government expenditure. Okay, one shot injection of government expenditure. What is compensatory spending? Okay, that's fine. Pump priming is fine. What is compensatory spending? It is also similar to pump priming, but this has an objective, compensatory spending. Due to the slowdown, say private sector is not investing. Okay, private sector is not investing. So what government do? How much are, for example, year on year there is a say 1 lakh crore investment in public housing year on year. Okay, public housing means constructing houses. Now due to COVID, for 2020 the housing output has reduced by 1 lakh, say expected to be reduced by 1 lakh. What government did, or I'm giving an hypothetical scenario, government is investing 1 lakh crores into the public housing projects. For example, there are certain stalled projects, giving them long term loans of 1 lakh crores. The objective here is to compensate the deficiency in the private investment. Whatever deficiency is there in the current year of 1 lakh crores, I'm just compensating that. Okay, only to that extent. That is called compensatory spending. That is also difference between pump priming is one shot injection to ensure to increase it purchasing power, and compensatory spending is the obvious objectives to compensate the deficiency in the private investment coming. Okay, that's about expenditure as an instrument of fiscal policy. Next we'll discuss about taxes, government debt and budgets. How the taxes as an instrument of fiscal policy for the government? It is very straightforward. Taxes are a very prime weapon for the government. taxes form most important source of revenue for governments. Okay, taxes form most important source of revenue, right? For any government. So tax is an instrument of fiscal policy. It works. So because when there is a recession and depreciation, tax policies are aimed at encouraging private consumption. So when there is a slowdown already, you cannot burden people with high taxes. So obviously, government reduce during those times taxes to ensure there is more money in private sector or private individuals so that they can spend it, put it back into the economy and invest it. General reduction in income taxes leaves higher disposable income with people and inducing higher consumption. Low corporate taxes increase prospects of profits for businesses and promote future investment. So you all need to understand for all these four how government change or how the government play when there is a slowdown or recession or when there is high growth. So government acts differently in these two scenarios. When there is slowdown, government acts differently, and quite opposite, government act when there is high growth. Okay, so you need to remember for each instrument how the government act when there is a slowdown and when there is growth. So that's how you need to learn these four. Next, we have government debt. So when the government takes more debt, when there is a slowdown, when government takes less debt, when there is high growth, isn't it? Because to fund all the expenditure, government has to take more debt, right? Get it? A rational policy of public borrowing and debt repayment is a potent weapon to fight the inflation and deflation. Okay, public debt can be internal or external. In case of market loans, government issues treasury bills. For example, there is high growth in the economy and there is high inflation. What government do? Government issues treasury bills and bonds to the public saying we will pay you more than fixed deposit interest rate. So what happens? Automatically people subscribe to those government securities. When that happens, liquidity in the market will be taken out. The money liquidity, monetary liquidity will be taken out by the government so that there will not be too much of money in hands of public. Okay, that's how government can play with the debt. All right. Next, budget as an instrument of fiscal policy. The budget is simply the statement of revenues and other sources and expenditure. So budgets reflect what the government thinking is. The balanced budgets happens when expenditure and revenue is equals. Budget deficit happens when the government expenditure in a year is greater than tax revenue. This is generally happens when there is when there is a slowdown or recession. Budget surplus reduces the national debt. So budget surplus reduces government debt, increases savings and reduces interest rates, which is quite hypothetical scenario. Most of the times budget surplus is not possible. Most of the times either you'll have balanced budget. Most of the times in countries like India or even say for that matter US, we have budget deficits. What the governments earn and their expenditure is way higher than what they earn. There are certain restrictions how much they can, but yes, generally we run in budget deficits. Even all states go with budget deficits year on year. Even some certain healthy states also who are having financially decent caliber. What are the different types of fiscal policy? Fiscal policies, are we already discussed briefly. Two types. One is expansionary fiscal policy. Very important questions are asked. Expansionary fiscal policy, and second one is contractionary fiscal policy. Expansionary fiscal policy and contractionary fiscal policy. Whatever that we discussed above, when there is an inflation and when there is a slowdown, how it happens. So when is the expansionary fiscal policy um, is implemented by the government, and when the contractionary fiscal policies are implemented by the government, we need to discuss. I'll explain this with this simple graph. Okay. Assume there is a slowdown. So government needs to combat this slowdown or recession. What government needs to do? I'll give you an example. This line, apologies, this has to be here. This is the original demand in an economy. Okay, this is AD1. I am sorry, I need to. Yeah, this is AD1. This line, right? This line is AD1. At GDP of Y1, here is where there is introduction. Sorry, where there is intersection. And this is there's a problem. Okay, anyways, so this is supply line. Okay, so this is where demand and supply met. So due to this, this is SAS1 line. Okay, let me show this also. This is SAS1 line. It's supply line. Okay, these two met here. This P1 has to be here, and this P3 has to be here. My bad, material got it wrongly. Please correct it. So price at P1 and GDP at Y1, right? And price at P1. This is the current scenario of a slowdown. Government, through their various expansionary fiscal policy measures like reducing taxes, increasing government expenditure, right? So, for example, these ways they had put more money into the hands of public. This, due to these measures, the GDP has increased from Y1 to Y2. Due to this, the AD1 curve moved from AD1 to AD2. It means the demand for consumer goods and services has increased. It moved from here to here as there is increase in the GDP. Okay, due to the government actions, the curve moved from here to here, AD2. Similarly, when there is an increase in demand, automatically producers start producing it. Of course, there is an increase in supply. This dotted line is what is supply line, SAS2. Unbelievable. I'm extremely sorry. This is a complete mess in this. In fact, this has to be SAS1. This has to be SAS1. SAS1. And that's why it is at here, right? Oh, no. It's correct only. This is SAS1. My bad. Just undo. Yeah, this is the original supply line. Now, due to the increase in the demand for products, the supply line moved here. This dotted line. Okay, this dotted line. Look at this dotted line. Look at this dotted line. Ideally, it has to be here. There is some issue with the presentation. Let me just show you from another place. It has a problem in this. Okay, wait a second. I hope I have here. There is how the expansion of fiscal policy and contraction of fiscal policy works. I'll just show you. Yeah, it is here. Thank God, it is here. So can we just go with this? I'll explain it to you how the expansion of fiscal policy works and how the contraction of fiscal policy works from the first. See, this is the Y1. This is Y1. And say this is the current demand, AD1. AD1 is here. And there is current supply of products, SAS1, where demand and supply meets here. This point is what is your price levels, average price levels of in the economy, and Y1 is here. So now, as there is a slowdown and people are facing some issues, so what government do? They either through borrowings or reducing the taxes by increasing the disposable income, they put more money in the hands of public, due to which the demand curve moved from AD1 to AD2. The demand curve moved from AD1 to AD2. As the result of this, the supply curve also moved from SAS1 to SAS2. Okay, the supply curve is also moved from SAS1 to SAS2. So what happens due to this? Due to this, what happens? The GDP also increases from Y1 to Y2. Okay, so when the GDP also increased, what it would result into? The Y1 also changed from Y1 to, so see, the objective of growth is achieved, right? The objective of growth is achieved. The SAS2, the price levels are maintained. So the price levels are maintained here, and the growth is achieved. So GDP has increased. So the expansionary fiscal policies are used to address recession and general problem of unemployment in the business cycle scenario, right? So expansionary fiscal policies are nothing but are aimed at increasing the aggregate production, all right, creating full employment. The recession sets in within a period of declining real income, as we all know. So with aggregate demand fall short of aggregate supply, it results in unemployment, labor shortage, especially labor. The government has to intervene through their expansionary fiscal policies. As I explained, government either reducing the debt, reducing the taxes by increasing the money in the hands of people, or by government directly spending more money and giving money in the hands of people, through which the curve moves here. So this is the expansionary fiscal policy, expanding the economy. That is called expansionary fiscal policy. When government do that, when there is a slowdown in the economy. All right. Next, we talk about contractionary fiscal policy, which is quite opposite to expansionary fiscal policy. Contractionary fiscal policies are scenarios where there is a high growth and there is high inflation. It is a deliberate policy of the government. It is a deliberate policy of the government apply to curtail aggregate demand and consequently the level of economic activity. Why government has to do this? Growth in the economy is good, right? Why the government has to do this? Why government has to, intentionally reduce the growth rates or keep it deliberately curtail the demand for the goods? There is a logic for it. As we studied, as a general saying, anything that is inorganic or unsustainable growth is dangerous for the economy. If there is inorganic or unsustainable growth is there, later at some point it will be falling at the same pace at which it has grown. So that is why it was always good for any economy to go with a right pace. You cannot take all of a sudden jump. So that is why when there is a sudden jumps like this happens, what happens? There will be a high level of inflation. As people have a lot of money, they keep spending, and the demand will be more and supply will be less, right? So decrease in government spending in the contractionary fiscal policy measures, one of it is reducing the government spending so that money will not be in the hands of people. Increase the taxes, combination of both increasing spending and decreasing taxes. Sorry, increasing taxes and decreasing government spending. Okay. So contractionary fiscal policies are aimed at combating inflation. And what are the fiscal policy aims for the long-term economic growth is also discussed. You guys can look into it. Next, fiscal policy for reduction in inequalities of income and wealth. That is very important. Why all these government is doing everything, right? The objective is to ensure that even the weak person gets some benefits, economic benefits. So the major aim of government's fiscal policy is to serve, or say to ensure, right, all the sections of people are benefited. How this can be achieved? The fiscal policy can be a way to reduce inequalities in the income of people and wealth. As we know, one is the taxation system that we have. You must be thinking why they're taxing so much on the rich, but it is required. Indirect taxes can be differential. A carefully planned policy of public expenditure helps in redistributing incomes. For example, poverty alleviation programs like Mahatma Gandhi Rural MG NAREGA, providing certain mandatory employment for the rural people, free or subsidized medical care, infrastructure provision, all these long-term, things that are done with the long-term orientation, this expenditure that are spent on a long-term orientation. For example, strengthening human capital, how that can be done by giving a right education for these. So the fiscal policies object can be used as a policy for reduction in inequalities of income and wealth. What are the limitations in our fiscal policy? For every government activities, there are certain limitations. One, they act late. There are lags, decision lag, implementation lag, and the impact lag also. A lot of times after that effect is settled down, government realizes, wakes up and take decisions. So which will give zero, benefits. In fact, will give a problems. Timing is very bad. A lot of times government react late. Most of the times they react, not proactive. It is practically difficult to reduce government spending on various items sometimes. Okay. So these are various, limitations with the fiscal policy. Please go through it. These are very common stuff. Next concept that I have is crowding out. What is crowding out? Very important question is asked in the previous year. So as we discussed in the compensatory spending, government spending sometimes substitute the private spending. And when this happens very often, what happens? Government spending on aggregate demand would be smaller than what it should be. Crowding out effect is a negative effect of fiscal policy. Through fiscal policy actions, for example, in the compensatory spending, in a particular industry, government has invested so much. What happens? This creates a panic in the private sector. The private sector will not invest into it. For example, government is providing free computers to students. So now the laptop manufacturers or the computer manufacturers, they don't manufacture for students because anyway government is doing it on their own, right? Why should we invest and we don't get much money? Because government is giving it throwaway prices to the people. So this is a dangerous scenario. This is a problem also. When government increases its spending by borrowing from loanable funds from market, the demand for loans increases and the interest rates go up. So when the government borrows more money, what happens? Consequentially, there will be a demand for money. Government also requiring and private also requiring, and interest rates will go high. These will create a, private sector is very sensitive to interest rates, and so private spending is discouraged. Sometimes, moreover, during recession phases, government would be able to borrow from market without increasing the interest rates. These all are the ways that private sector stop investing due to the government initiatives. That is called crowding out effect. Very, 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 very important. With this, we are done with chapter 4, unit 4, fiscal policy. So let us quickly summarize what we have studied in the fiscal policy. Fiscal policy is why government needs to involve in the fiscal policy functions. What are the objectives of fiscal policy? We studied what is the automatic stabilizers and discretionary fiscal policy. Last year, previous year question. And there are so many previous year questions from this. And what is the government expenditure as an instrument of fiscal policy? We discussed here pump priming and compensatory spending. This is also previous year question. And how taxes can be used as an instrument of fiscal policy, and how public debt and how budget as an instrument of fiscal policy. What is expansionary fiscal policy? What is contractionary fiscal policy? All right. So all these are very, 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 very important. I can say chapter 4, unit 4 is very, very important. Please read very much carefully, and it is very important. I'm sure you will have 5 to 8 marks question, or with this understanding, you can write 10 marks. Fiscal policy, understanding how the government functions. With that understanding, you can answer questions easily. All right. With this, chapter 2, unit 4 is done. So chapter 2, public finance, is completed with this. After chapter 2, public finance, let us look into the chapter 4, international trade. I am skipping chapter 3. We will be covering later after chapter 4, international trade. All right. So the chapter 4 is weightage wise is very, very important chapter, international trade, and it is very live subject. In fact, the content in the chapter 4 and questions were asked from this chapter out of 40 marks previous or July 2021, 25 marks questions were asked just from this international trade alone. So you can understand how important this chapter is. Compared to other chapters, it is slightly bulky, as you have 5 units. In fact, 5 units. Nowhere else you have 5 units. In the international trade, we have 5 units. One is theories of international trade. Second, instruments of trade policy. Third, trade negotiations. Fourth, exchange rate and its economic effects. Fifth, international capital movements. So these 5 units, each one, in fact, all are important. So let us cover one by one. First unit in the chapter 4 is theories of international trade, right? So what are the different theories of international trade? First of all, what is international trade? What is international trade? We all know what is trade. Trade is nothing but exchange of goods and services, or transaction with, exchange of goods and services, goods as well as resources between two people. If it happens between two different countries, people, it is international trade. If it happens between or among people within country, that is internal trade. The same thing happens with people out of the country, that is called international trade. There's a difference between internal trade and international trade. All right. International trade involves multiple currencies. Important thing, in the international trade is it involves multiple currencies. It involves multiple currencies. Get it? So that's about the meaning of international trade. Let us see in the revision, as a revision material. International trade is the exchange of goods and services as well as resources between countries and involves greater complexity compared to internal trade. It is complex compared to internal trade. Of course, why it is complex? Because it involves multiple currencies, transactions in multiple currencies. For example, the transactions not just happen in Indian rupees as transaction happened out of country. There the currency is different, and we have certain benchmark currency like dollar. So most of the times dollar will become a benchmark currency. We transact in dollars, right? So that is how international trade meaning is explained. So international trade is simple as exchange of goods and services between countries, right? As well as resources, goods, services, resources between countries. It involves transactions in multiple currencies. There is no need to take an example. Simple, any product that we export, any product that we import, all of these part of international trade. It involves foreign currency exchange. All right. It has a greater complexity as it involves heterogeneity of customers, currencies, legal systems, documentation, restrictions in the form of taxes, regulations, duties, tariffs, quotas, trade barriers. All of these will come into a picture with respect to international trade. So why we all need to do international trade? What is the requirement? Why can't we do internally only alone? Why do we, the if you know the entire concept of this colonialism, some countries occupying other countries, how it all started? It was earlier not there, right? So the concept of colonialism, new age colonialism, the British occupying so many Southeast Asian countries, how this all happened? It all happened, or say the origin for this is trade. India is a resource rich country. So they had come here for trade. They were not having initially any interest to rule the country. But later on, to ensure their trade is proper or unhindered, they have started administering the countries well. The main purpose of their administration is to ensure that their trade, their businesses, run properly. The required raw materials can be obtained, and various other precious metals can be obtained from India, resource from India at a cheaper rates, like cotton, gold, diamonds, all of it. So that's the significance of international trade. International trade has created new age, administrative systems for world. So that it is so important, so important. First of all, let us discuss various theories around international trade. First of all, why we need to do international trade? What are the arguments in favor of liberal trade? So after, if you remember, after our independence, with our experiences, countries like India, we were very averse. In fact, we had lot of restrictions for any international trade, especially with respect to imports. If we want to buy any product from out of country, you are done. The taxes will be more than 60%, 70%. Some cases, it is even 200%, because of our previous experiences from 1700 to 1940 with Britishers. So there can be good as well as bad with international trade. What are the pros? what are those arguments in favor of international trade? What are those arguments in favor of international trade? And as well as what are those arguments against international trade? We cannot say, international trade is good, or we cannot say international trade is completely bad for the country. There are countries like, even in the current generation, countries like China are having a significant stake in the world economy, world's politics, just because of their trade power. The way they do exports, 25% of the total manufacturing in the world happens from China. So they control a lot. So how they got that power is because of their trade, international trade, right? So once upon a time, China used to be along with us, but now they moved way ahead from us in 45 to 50 years. At the time of independence, we both are on the same, stage in terms of economic power. All right, fine. So now that is a pro about the supporting international trade. So we cannot say outrightly this is good or this is bad. There are arguments support of international trade, there are arguments against international trade. You can write so many. For example, here we have given 13 supporting, against we have given 8, right? So let us see briefly what are those arguments. Here you have in a summarization form. So I'll pick it up from here. So what are those arguments in favor of international trade? First, contributes to economic growth and rising incomes, undoubtedly. If you are doing it, especially you are selling it, a country as a country, you're doing more exports, it contributes to economic growth and rising income levels. Enlarges manufacturing capabilities. Of course, when there are requirement outside of the country, the demand is there, more than from your country people out of country. Of course, your manufacturing capabilities will increase. Automatically, you will bring more technologies into it. You will have economies of scale. Economies of scale, right? If you product 100 units, the cost of production per unit, say 10 rupees. But if you produce 1000 units, the cost of production comes down per unit from 10 rupees to 8 rupees. That has achieved due to the bulkness. We all know this. In a hotel, if they are selling only, say, 10 plates of idli, what happens? Their cost is generally high. But there is fixed cost and there is variable cost. So the fixed costs are fixed irrespective of how much you serve. So in those cases, you will have economies of scale, ensures benefits from economies of large scale production. That's what I spoke just now. Enhances competitiveness. Competitiveness will come. You will be competing with products, internationally, not just locally. And profitability by adoption of cost reducing technology. So once this happens, once you have a competitor, you will always be on toes. So in a class, if you have a competitor, if the first ranker will always be on toes. He though he know everything, he'll read it, he will revise it, because there could be a chance if he's getting less than 2 or 3 marks, definitely other person is going to take that rank. So when you have that competition, you keep exploring for new technologies, cost reducing methods, right? Deployment of productive resources. Of course, you will have more productive resources. Domestic monopolies. You'll have, companies which are, controlling the world from your country. Cost effective resourcing of inputs, components internationally. You will source it from the best of the best place. When you are doing the international trade, you will import from best of the best place. Innovative products at low prices, of course, creation of jobs, reduction in poverty. These are standard, rising standard of livelihood, increasing overall demand for goods and services. See, you can write so many. You can just write If you think about arguments favor of international trade, you can write everything about the goods in elevation of poverty, increasing employment levels, increasing the output, GDP, overall increase in the productive base, increase in the standards, innovative products, new technologies, what not. You can write when you talk about arguments in favor of international trade. Next, what are those arguments against international trade? What are those arguments against international trade? Of course, there are good and there is bad as well. So what are those arguments against international trade? First one, economic exploitation. See, this is typically what happened during the colonialism. So the weaker countries will obviously surrender their market to the developed countries like the developed countries like US. So the markets of India will be flooded with the goods of other countries. For say relatively weaker countries, they don't have the manufacturing capabilities. What happens? The countries, if we open our trade, if we open our boundaries for international trade till 1991, until we got liberalization, privatization, and globalization, due to some issue, we have opened up our markets for the world. In fact, before that, our trade is so low. International trade is very less. Once we opened all different sectors of the economy for for foreign entities, foreign players, the international trade, the business have started improving it, right? So that's one positive thing, and the negative thing is the dependence. Suppose, for example, the COVID-19 at one place hit, impacted the whole world. Why economies are not self-sustainable? If a COVID virus came up in China, the entire world is shaken, right? Because there is so much of say raw material like pharmaceuticals, the active pharmaceutical ingredients, APIs, which are only available for certain medicine in China. Because of the trade restrictions that we had, what happened? The world is dependent on China. So we don't have those active pharmaceutical raw material to manufacture certain drugs. Get it? So that's how the problem with the international trade. When we are overly doing it, there is so much of dependence. So when one some hit on economy due to say Lehman Brothers collapse in 2008, one bank in US, it impacted the whole world. Recession, the whole world faced the recession. You get it? That much dependent we all are. It wasn't the case earlier. Then exhaustion of natural resources. When you open, people use the natural resources like coal, oil, all of this may result in consumerism. Yes, of course, consumerism is what defining now all of us. Inflation levels go high. The welfare of people, though it shows, but it disregards the welfare of people. The only rich will become richer, right? Rivalries and risks in trade associated with change in government's policies and participating countries. Unnecessarily, trade wars do happen, due to this international trade. You get it? So these are the arguments against international trade. I hope it is clear. You have arguments in favor, arguments against. You cannot say this is good, that is bad. If someone asks you, is international trade is good, you cannot say good or bad with a absolute answer. There are good as well as bad. Next, what are the important theories? What are the different theories of international trade? Important theories of international trade. We have different theories of international trade. All right, different theories. over the period of from 1900s, 1800s, all these theories have come up. What these theories are telling about international trade. First one is mercantilist view of international trade. Mercantilist view of international trade. It is also called commercialism. Also called commercialism. What this mercantilist view of international trade is explaining what this theorem is saying, right? Next, we have the theory of absolute advantage. We all know Adam Smith. It is given by absolute advantage. What is the advantage of international trade? Next, we have theory of comparative advantage. It is given by David Ricardo. Next, we have Heckscher-Owen theory of trade. Next, we have factor price equalization theorem. And then we have new trade theories, which is developed in recent times. So we have 1, 2, 3, 4, 5. These two are very important. Heckscher-Owen theory and factor price equalization theory. These two have been asked already in the examination. So we have 3. As the theories goes, the perspective about international trade changes. Why? Because the theorems, whenever those are given by the economists, they would most of the times consider the situation, circumstances at their time, right? So that's how they come up with different theories. So the first one is mercantilist view of international trade. Let us discuss mercantilist view. Right. What is mercantilism? Mercantilist view of international trade. As I said, these theories were given in those time periods. So if you see the mercantilist view says any country, they should advocate maximizing exports. This is given by some of the West scientists, so West economists. So that is why they will say this before this colonization time. Mercantilism advocated maximizing exports, like you export as much as possible. For what? In order to bring more precious metals. In order to bring more precious metals, do as much as exports possible and bring all precious metals like gold, diamonds, all of it, and minimize your imports. You don't import any goods. So the state should do, mercantilist view says, the state should put so much of high tariffs on the imports, discourage imports, but they should encourage exports and collect precious metals. You get it? So that is the mercantilist view. As I said, it came in some 1800s. So that's how it is. That time, the currency was not so famous. So they're talking about more about precious metals. So this rare question could come because this is almost outdated stuff. Mercantilist view of international trade. Next we have theories of absolute advantage. What is the theory of absolute advantage? That is given by Adam Smith. It is like late 18th century. Adam Smith, what he says, the absolute cost advantage theory. It is absolute advantage means absolute cost advantage theory. Because he says we need to do exports, we need to do international trade, but due to this, a country will specialize in the production and export of certain commodities in which it has an absolute cost advantage. Adam Smith says you produce and export, sell products that you have absolute cost advantage. It means you will be the only country who can export a particular product at a cheap rate. For example, if you think every country will have certain products, for example, China, electronics, Korea, electronics. So they have in certain products absolute advantage, cost advantage. So they'll be able to sell it at a cheaper or economical prices compared to any other country. In those cases, he says you produce only those products and export those commodities where you have absolute cost advantage. Okay, For example, here for 1 hour of labor, say for 1 hour of a person, we can produce wheat 6 lots in, say, India, country A, country B, China. So in 1 hour, we can produce six lots. China can produce 1 lot. Whereas in cloth, India can only produce 5 yards, but China can produce 4 yards. China can produce 5 yards. So just by looking at it, who has absolute cost advantage in wheat? Country A, right? They're able to produce 6. So their per unit cost is less. Whereas in cloth, China is having absolute advantage. So what Adam Smith says, boss, you sell India, you sell wheat to China. China, you sell cloth to India, right? That's how you leverage your resources. The theory of absolute cost advantage, that's how it works. You get it? Next, we have theories of comparative advantage. It is given by David Ricardo. Next, theory of comparative advantage given by Ricardo. It is an extension of absolute advantage, but here the comparative advantage says, the nation should specialize in certain products and they should not get into certain products where they have highest level of advantage, absolute advantage. They should product that product, and they should import another product. In the example that we have here, wheat and cloth, so you should see per hour what is the absolute cost, and where it has a relative advantage in terms of wheat and cloth. If you see per hour cost, where you have complete comparative advantage, assume the efforts that you put in cloth is completely shifted to wheat for country A. Then how many, for 1 hour you can produce 12 lots of wheat, right? 12 lots you can produce. So similarly for cloth, so if the cloth is not produced by country A, even the country A's requirement is produced by country B, what happens? 10 yards of cloth can be produced by the country B, right? So what it says is, nations should specialize in a production and export of the commodity in which its absolute disadvantage is smaller. It means its absolute advantage is higher. If you say absolute disadvantage is smaller, it means absolute advantage is higher. And import the commodity in which its absolute disadvantage is greater. It means this absolute advantage is lesser, that you should import. It is an extension of absolute advantage theory. Comparative advantage theory is an extension of absolute advantage theory. Just go through it, you will understand with the example here. In the interest of time, I'm not getting in too detailed into it, so certainly you will understand. It is self-explanatory if you read, and even if you look into the class that we discussed here, or class we had on this. Next we have, in fact, you can even refer to the, I would say, YouTube for better explanation of theory of absolute advantage and theory of comparative advantage. You have wonderful explanation for 5 to 10 minutes each theorem. Okay. Next, we have Harsha-Rohin theory of trade. Harsha-Rohin theory of trade is also referred to as factor endowment theory. And this is very important. This is called modern theory of trade also. Harsha-Rohin theory of trade. It is given by Harsha-Rohin, right? So factor endowments. Basically, factor endowments are nothing but the factors, overall availability of usable resources, both natural, man-made, for any production, say for any production, say pharma industry. So you need certain bare minimum raw materials, which is available in certain countries. Whereas in certain countries, it is not available due to the climatic reasons or due to the soil or various issues, it is not available. Factor endowment is nothing but overall availability of usable resources, including both natural and man-made, only two most important factors. We have factors of production, land, labor, capital, entrepreneurship, right? But here, labor and capital is taken into the account. Other two is not really given importance. According to this theory, this is also called modern theory, it is just a case of inter-regional trade. Just consider international trade also just like an inter-regional trade. It's just between one state to another state type. So different regions have different strengths in terms of natural resources or talent, man-made talent, right? Human talent. So different goods have different production functions. Each region is suitable for a certain kind of goods, right? So in those scenarios, some regions are not suitable due to scarcity. So immediate cause of interregional trade is that goods can be bought in cheaper in terms of money than it can be produced at home. Suppose a country which is, which is specialized in certain product, if they produce that and export to us, we don't waste our efforts and energy into the same product which we produce at higher cost per unit, right? So the cause of difference in the relative price of goods is a difference amount of factor endowments like capital and labor between two countries. So these two play important role. What are those factors of production? Labor and capital. Theory states a country's exports depends on its resource endowment, how much the resources are with them abundantly. If a country is capital abundant like USA, it will produce capital intensive products like large machineries, all of it relatively cheaper than any other country because they have required capital. First and foremost, they have required capital. Second, they have required human talent. So they'll be able to produce at a cheaper rate, right? So a country like USA is capital abundant. Country like India, we are labor abundant. We have human talent. We are good in our services, not in manufacturing. So that we are exporters of software. So why we were able to do this? Because we have huge human talent. We have people here, right? So that's how. So you countries like USA should focus on the capital intensive. Countries like India should focus on labor intensive because of the factor endowment, the strengths that we have. So it establishes that a country needs to specialize and export a commodity whose production requires intensive use of its abundant resources. You should not waste your resources, right? So basic assumption Harsha theory is that two countries share their same production technology, that markets are perfectly competitive. Okay, so you have next after Harsha theory, factor price equalization theorem. It's a small thing. Factor price equalization theorem. It is an extension of Harsha theory only. It states that international trade equalizes factor prices between the trading nations. Therefore, with free trade, wages and returns on capital will converge across the country. So with free trade, what happens? So one thing available at another country, we consider it as our own. So if they are more competitively producing, we'll just factor that, and the factor prices are equally looked into. If the capital is available in, say, in US, you will get that done in US. If labor is available in India, you will get that done in India. Okay, that's about factor price equalization theorem. Next, we have new trade theory. This is the latest entrance. Considering the rising proportion of world trade of developing or in the most bigger developed countries or bigger developing countries like BRIC countries, Brazil, Russia, India, China, South Africa, right? These countries constitute more than 50% of the world trade. According to this, there are two concepts. Those are very important. Even the new trade theory is very important. How do we do that? What are the key concepts that give advantages to countries that export goods? There are two, how they benefit from the exports. One is economies of scale. Second, network effects. New trade theory says economies of scale will help. As I explained, reduction in the per unit cost of production. A firm produces more products, its cost per unit keep going down. So if the firm serves domestic as well as foreign markets, it can reap the benefit of large scale production. Network effects are the way next one is network effects. The way one person's value of good or service is affected by the value of that good or service to others. The value of a product or service enhanced as number of individuals using it increases. So as number of, see, the same product can be used in multiple ways. Say, in the medicinal thing, some people can use in a particular drug, some countries use that in for a particular drug. So this will give wide utility for that product when you do the exports. These are called network effects. So the same product can be used differently by different people. This is also called bandwagon effect. If question has come, what is bandwagon effect? You need to write about the network effects. Economies of scale is simple. Network effects is the utility of a product varies. The consumer can use the same product in different ways in different countries, right? So that's about new trade theory, right? New trade theory is giving, you achieve due to through international trade economies of scale and network effects, which will positively impact the economy and the country. That's about different theories of international trade. Unit 1, different theories of international trade. Please go through. Next, we have Unit 2, the instruments of trade policy. The instruments of trade policy. Unit 2 is the instruments of trade policy. What are the different instruments that are available with countries? So like fiscal policy, there is also trade policy for every country in respect of the economic, controlling the exports, imports, how do help domestic market, how do you protect the domestic market? So countries resort into different measures, right? So those are those can be summed up as trade policies of the countries. India has different trade policy, China has a different trade policy, US has a different trade policy. What are the different instruments of trade policy available? We speak more about from the Indian context, but even at the worldwide, it's similar. All right. So what are the different instruments that we have, in the trade policy? It is obvious that, fair competition does not always exist. It's not that always perfect competition is going to be there. So severe dislocation of many domestic firms happens. So individuals and organizations continue to pressurize our government, right? Trade bodies and regulatory authorities continue to restrict imports to artificially boost up the size of the exports. Any country, how developed the country is, even US put a lot of restrictions on the imports that they bring in. So every country, though there is a World Trade Organization which advocates for free trade, still there are a lot of entry barriers for the products in different countries in different ways. So the policy of country, trade policy of a country explains how the particular country is open. It also tells about the maturity of the country and the life cycle of the country, at which stage they are in. Someone who got recently independence from colonialized countries, like some of the African countries, still don't allow much of foreign products. So it all depends. So the trade policy of the government determines that. So we have different instruments of trade policy with the government. So we'll discuss those one by one. Trade policy, just briefly, we'll discuss what is trade policy. Trade policy covers all instruments that governments may use promote or restrict imports and exports. To promote or restrict imports and exports. Trade policy also includes approach taken by countries in trade negotiations. When there is negotiation between two countries, the approach of the country will be, understood from their trade policy, how they are charging on imports, how they are charging on exports. All these will give certain idea. The instruments of trade policy that countries typically use to restrict imports or to encourage exports can be broadly classified into two. One, price related measures. Second, non price measures. Price related measures are like tariffs. Non price related measures are like non tariffs. These are direct, increasing the taxes. Non tariff measures are indirectly putting a restrictions, or encouraging non tariff measures. Then there are certain export related measures for exporters. All right. So the instruments of trade policy can be divided into tariffs, non tariffs, export related measures. We'll discuss one by one. What is tariff? Okay. What is tariff? So what is tariff? Tariffs, as we said, these are price measures. It is in simple form is customs duty. It is defined as a financial charge, right? A percentage on the value or on the products in the form of tax imposed at a border on goods going from one custom territory to other. Going from one custom territory to other. Tariffs are the most visible and universally used trade measures. Tariffs are the most visible and universally used trade measures. So the tariffs, as we discussed, is an important weapon for the governments to restrict imports a lot of times by putting heavy customs duty on it, right? So customs duties are nothing but tariffs. What are different types of import tariffs that are there? There are so many. But important, I'll discuss two. One is specific tariff, and another one is ad valorem tariff. What is specific tariff? Question is asked in the last year about this. You can be asked to explain what is mixed tariff, what is compound tariff, what is specific tariff, what is ad valorem tariff. These are nothing but different types of customs duties. Okay. So specific tariff in simple terms is imposed a fixed monetary tax per unit of good. Per unit of good. It means for each product of mobile phone imported from America, it will be charged 2000 rupees. That is called specific tariff. What is ad valorem tariff? Ad valorem tariff is, it is levied as a constant percentage on the value of unit. It is simply levied on value of the unit. In specific tariff, we don't look into the value of a product. We simply, define, or the custom authorities, the government define a particular value on the unit of product, irrespective of value, irrespective of the value on each item. They say per kg this much, or per unit this much tax you need to pay. That is called specific tariff. What is ad valorem tariff? It is levied as constant percentage of monetary value of unit of import goods. It is specified as 5% customs duty or 10% customs duty. That is called ad valorem tariff. Then there are various other tariffs: mixed tariff, compound tariff, technical tariff, tariff rate quotas, most favored nations, variable tariffs, preferential tariffs, bound tariffs, escalated tariff, prohibitive tariff, import subsidies. You need to know all of this. Yeah, it's very important. So you at least these three, very important, I would say. Specific tariff, ad valorem tariff, mixed tariff. Mixed tariff is, in simple terms, it is used, both specific and ad valorem. That is called mixed tariff. Mixed tariff is simply duty on cotton is 5% ad valorem or 3000 per ton, whichever is higher. Whatever is beneficial for the government, that will be charged. It could be particular percentage, or it could be a particular value on each ton. So whichever is higher, no, that will be your tariff. So that is called mixed tariff. Here, it could be either this or that, but both are defined. So that is called mixed tariff. Compound tariff scenario is combination of both tariffs. Here, either this or that, you will be charging at the end in mixed tariff. But in compound tariff, you will have both. How it can be done? Combination of the tariff calculated on the basis of both the value of the good and unit of measure of the imported goods. It is generally calculated by adding specific duty to an ad valorem duty. Simply, they will say for product of mobile phone, 2000 rupees plus not R plus 18% on the product value. Certain specific duty is there and ad valorem tariff is there. So both combined is used. That is called compound tariff. And there are various different ones. And in that, we'll discuss what was given, what was asked in the last previous year questions. The important one last time asked in one of the previous years is bound tariff. What is bound tariff? Bound tariff is binding agreement, basically binding agreement. Bound tariff is tariff which WTO member countries are there, right? India is also member country, binds itself with a legal commitment not to rise above certain level. For example, on the agricultural commodities, I will not charge more than 10% of the customs duty. So that's how you have certain limit, right? That is called bound tariff. Then you have applied tariff, escalated tariff. You have to study all of these, okay? I'm not covering it in the interest of time, but you have to do it. Next, we have tariffs as a response to trade negotiations. Important. Whatever I'm saying important, those are a category. It means it asked in the previous years. Tariffs as a response to trade distortions. Tariffs as a response to trade distortions. Distortions means disturbances. These are tariffs imposed on the products which are disturbing the domestic trade, right? So those are called tariffs as response to trade distortions. Importantly, we have two. One is called anti-dumping duty. Another one is called countervailing duty. These are kind of customs duties only. On the imports, these two are charged. All right. Anti-dumping duty and countervailing duty. What is anti-dumping duty? What is anti-dumping duty? See, in real scenarios, a lot of times to capture the market for a particular product, certain foreign companies engage in unfair trade practices, like selling it throwaway prices, selling it less than the cost of production, less than their cost of production. Why they do that? To obtain the market share first, right? So to engage in unfair trade practices, which are trade distorting in nature and adverse the interest of the domestic firms. What happens due to this? The competition will be moved out, right? So the affected importing countries, upon confirmation of distortion, so suppose Chinese, they are dumping a lot of goods in India, all cheaper products. As due to this, it is impacting the domestic manufacturing industry. So it is so much that their prices cannot be affordable by the domestic manufacturers. Why they are doing that? Because to achieve the market share, to drive the competitors out of the market. So in those scenarios, government do a retaliatory measures, take retaliatory measures on those products, on those exporters who's engaging in such unfair trade practices. These policies also called trigger price mechanisms. These policies also called trigger price mechanisms. In that we have two types. One is anti-dumping duty. Another one is countervailing duty. Anti-dumping duty, countervailing duty. What is anti-dumping duty? First of all, you understand dumping. Dumping means loading, offloading everything. Dumping occurs when manufacturers sell goods in foreign country below the sale prices in their domestic market. You get it? Below the sale prices in the domestic market. For example, a phone in China, the same phone is costing 22,000 rupees. But the same exporter selling the same phone in India at 18,000 rupees. How is that possible? Objective is they're involved in unfair trade practice that is also called predatory pricing practice. Dumping is an international price discrimination favoring buyers of exports, but in fact, the exporters deliberately lose money in order to harm the domestic producers. Okay, so in those cases, what the government do? Anti-dumping duty, government charge. These are measures to offset the effects of dumping. What government do? Okay, their product is 22,000. Now, along with my customs duty, I will add that, additionally, difference between 22,000 and 18,000, that 4,000 extra you pay as anti-dumping duty. India imposed a lot of times on Chinese products. India imposed anti-dumping duty on color-coated or pre-painted flat steel products imported from China. Sometimes on jute products from Bangladesh and Nepal also, India imposed. These are called anti-dumping duty. You get it? You will see it even in your other subjects also. Customs duty. So when the customs duty is there, it can be divided. Sometimes you'll have anti-dumping duty, you will have countervailing duty. So you understood? This is to avoid predatory trade practicing, and when the products are sold below the sales price in the respective domestic markets in the exported country. So in those cases, government do charge extra tax on duty on those products. That is called anti-dumping duty. Next, we have countervailing duty. Countervailing duties are tariffs that aim to offset artificially low prices charged by exporters who enjoy export subsidies. Suppose for exports, governments give a lot of subsidies because exports are good for country. So when they enjoy, say, for example, tax concessions, all of it, obviously their cost of production is low due to the subsidies that they received in the main country. Say Chinese products, the subsidies given by Chinese government, they enjoy that. Due to that, they don't pay too much of taxes there, and there is no export tax. What happens? The cost of production is generally low. So all the subsidies that the particular product enjoyed, it will be charged by India back to them when they are importing a product. Okay, there in your country, you have got the benefit of, say, per product 10 rupees. I am going to charge you here in the form of countervailing duty. That is called countervailing duty. Example, India imposed 12.5% countervailing duty on jewelry imports from Asia, because there these jewelries are enjoying the export benefits. Okay, so that is why India imposed 12.5. Objective is what? Basically restricting the imports from other countries who are having undue benefits in their home countries. You get it? So these are all called these two different duties are called tariffs as response to trade distortions. Tariffs as response to trade distortions. Get it? So that's how it works. So what are the effects of tariffs on international trade? Of course, it creates entry barriers, a lot of issues, creates obstacles to trade, reduce the prospect of market access, increase government revenues, protect domestic industries, increase consumption of domestic goods. The major objective a lot of times is this: increase consumption of domestic goods and make imported goods more expensive, increase the domestic manufacturing. Next, we have non-tariff measures. What are non-tariff measures? Non-tariff measures are not price related, but they also put certain restrictions, but not in the form of tax or duty, in the form of policy measures, like with respect to quality or quantity, these things, other than ordinary customs tariff that can potentially have an economic impact on the international trade in goods, changing quantities traded or prices or both. All right. So those are non-tariff measures. So what are the non-tariff measures? What are the non-tariff measures that we have? Different types of non-tariff measures. Mostly we speak from the Indian context. So what are the different types of non-tariff measures that we have? Non-tariff measures, can be divided into two types. One is technical measures. Other one is non-technical measures. So non-tariff measures, as we discussed, are not straight effect of tax. Basically, the effect or the restrictions or the policy measures are on the quantity traded or prices or both. So it could be both. So these can be divided into non-tariff measures. Tariff, we all know. So non-tariff means not a direct impact on the tax, but yeah, there are things like technical measures. For example, you are importing a food, you will set standards like only this quality of food can be imported into India or to the US. So those kind of restrictions, we should not say restrictions, or the technical measures are certain items are prohibited. So national security related, those are prohibited. So certain items are clearly defined what should be imported and what not should be brought in. Even if you are bringing, if you are importing, there are certain standards defined so that all the cheap quality products will not come into the country. Those measures are called technical measures. And then we have non-technical measures also. We will see one by one what are the different types of technical measures and what are the different types of non-technical measures also that we have. All right. So let's see with an examples. We see here technical measures. Very standard example is uh, sanitary and phytosanitary measures. Like if you are bringing a particular product, it has to be sanitized. There are certain standards specified. The product has to be sanitized in that manner, applied to protect human, animal or plant life from risks arising from addition, pests, contaminants, toxins or disease causing organisms. So always whenever they define certain, for example, if you are importing say agricultural varieties, they put certain restrictions. Customs authorities put certain technical restrictions, like it should be sanitized in this way only, then only it will be allowed to import. And we have various others. For example, technical barriers to trade, basically mandatory standards that are defined. If you are doing like design or labeling or marking or packaging, it could be anything. So these countries use to protect their consumers and prevent their natural resources. For example, complying with food laws, complying with quality standards, complying with industrial standards, all these having certain certifications, all of these are kind of technical barriers. Not a layman can do this. So these kind of measures are also called different types of non-tariff measures. Import quotas. Sometimes quota is given, you should not import beyond this. Those are called import quotas. These are kind of non-technical. These two are technical. Next we have non-technical, in that quotas, importantly, it's like you define certain physical quantity, beyond that you cannot import. And then price control measures, imposing taxes on charges, licensing requirements. Countries putting a lot of restrictions. Sometimes it is required, sometimes not required, but in a way discouraging imports. Financial measures, right? Cost of foreign exchange, measures affecting the competition, all of these. Certain non-tariff measures, right? All these are various non-tariff measures are there. Technical measures we discussed. Technical are two types. phytosanitary technical barriers to trade, and then these all non-tariff import quotas, price control measures, financial measures, measures affecting competition, government procedure procurement policies, trade related investment measures, distribution restrictions. Certain products should not be distributed in so and so channels way. So that is also thing. Like rules of origin, this is very important. You question could come here, it hasn't come yet till now. Rules of origin are the criteria needed by the government of importing countries to determine the national source of a product. Lot of times, products that we get are originally originated in China. What Chinese do, they send it to say Malaysia or Thailand, and they import from there to India, and they put it as a product of Thailand. Why? To avoid certain obstacles. So for that, government has come up with a mandatory requirement to declare where the product has originally origined, right? So that based on that, you will be able to understand. So putting restrictions like rules of origin, embargoes. Embargo, we know. Embargo is total ban imposed by the government. Okay. So these are different types of non-technical measures in that, you know, in the non-tariff measures. These are non-technical measures. Okay. Technical measures are two major important ones: sanitary and phytosanitary measures, and technical barriers to trade. Hope you got it. So that's how the different types of tariffs, non-tariff measures are. Then we have certain export related measures. Generally, these are positives. Exports are always good for the country. So countries, encourage exports. Any country encourage exports. Sometimes in exceptional cases, when there is a shortage in the country, for example, onion shortage. So what they do, country for temporarily they ban exports. Very rarely this happens when there is a certain items ban due to shortage. Generally, otherwise, exports are encouraged. Exports bring a lot of foreign currency and a lot of value to a country's trade. So, and sometimes to discourage, people put export tax also, right? Export tax. Export tax is collected on exported good and may be either specific or ad valorem. Sometimes export subsidies, incentives, a lot of times these were given by the governments to encourage exports. There is something very important in the export related measures, that is voluntary export restraints. This has been asked in the last year. This question was asked in the last year. Voluntary export restraints. What is voluntary export restraints? One of the export related measures, that is, it is a type of informal quota. You remember we discussed about quotas, import quotas, right? Import quotas briefly. Similarly, what the exporters do, voluntarily, they don't export a product. Why? Because they've already done a lot. But if they cross beyond a particular point, it will definitely create irritation for the government of a particular importing country. For example, all the exporters of Chinese steel products, they all will have certain informal quota. It means they will decide, say, after say 10,000 tons, let's not import products to India. Why? Because this will create irritation to the local manufacturers, and the local manufacturers will complain to the government, and the government will put retaliatory tariffs on them. Things like anti-dumping duty, or say countervailing duty, or various other tariffs, they will put it back. So what the exporters do, they sense it, and they all agree to appease, I mean to say, impress the importing country, and to avoid effects of possible retaliatory trade restraints that may be imposed by the importer. It could be even total ban also. So to avoid all of this, exporters, all of them would come together and they don't export products after a particular limit. So that is called voluntarily export restraints. Nobody asked them, no government has asked them, but all the exporters come together and do this to avoid retaliatory tariffs from the importing country. So voluntary export restraints may arise when the importing competing industries seek protection from the surge of imports from country. So when they seek protection from the government, certainly it will be a total problem for them. So to avoid that, exporters act smart. They put certain unofficial quota. Beyond that, they don't export goods to the country, to certain countries, so that they will not have any extra tariffs charges that they need to pay. Okay, so with this we are through with unit 2. Let us quickly summarize what we have studied in the unit 2. In the unit 2 we have studied the instruments of trade policy. What are the different instruments of trade policy that are available with the government? Tariffs, non-tariff measures, and export-related measures. Tariff is kind of tax or customs duty which is levied on the product directly. There are different types of tariffs. We discussed specific tariff, ad valorem tariff, and various other tariffs like mixed tariffs and all. Then we have things like retaliatory tariffs. Suppose anti-dumping duty, countervailing duty. Anti-dumping duty is in a scenario where the sale price of the product is in fact cheaper in the exporting country from where the product has come. There the value is higher than what price they are selling in imported country. So in those scenarios, the objective of the exporter is to achieve the market share, to gain the complete market share. So to avoid damage to the domestic industries, what the government do, they put anti-dumping duty. Anti-dumping duty, what happens? So okay, there is a difference in the price in your original country and here. In fact, you are selling here cheaper. So let me put extra tax on you so that the price matches. So that is called anti-dumping duty. Then we discussed countervailing duty. What are the effects of tariffs we discussed? Then we discussed different non-tariff measures. In non-tariff measures, we have two types. One is technical measures and another one is non-technical measures. Technical measures are sanitary and photosanitary and putting barriers on trade, technical barriers to trade, like asking certain quality only can be doing, labeling, marketing, all of this. Okay. Then different non-tariff measures also are there. Then we have export related measures. Important one, voluntary export restraints. It is an unofficial quota administered by the exporters to avoid retaliatory tariffs of the importing country. Okay. You get it. So that's the one very important, the instruments of trade policy. That we are through with unit 2. Now in the chapter 4, next unit is trade negotiations. Trade negotiations. Chapter 4, unit 3 is trade negotiations. All right. So what is trade negotiation? What are the trade negotiations means? So every country, the trade negotiations happens between different countries, right? So for example, trade negotiations between India and Australia. So here it is a complex process. So you cannot have a single blanket agreement for giving market access of India to all the Australian companies, right? So there are certain restrictions that we need to have. But objective for having those restrictions, why we are not providing blanket access to the Indian market for all the Australian companies, even the Indian companies are not asking for, cannot ask for blanket access, like complete access of Australian market. There are certain issues that, there are conflicting objectives. For example, in country like India, agriculture is very sensitive topic, say sensitive market, where you cannot allow foreigners, you cannot grant access of the agri products completely to the foreigners. So we have a conflicting objectives. But for example, in the case of Australia, they are ready to give their complete access for the agri products, agri market in Australia. But just because they are giving, we cannot give in India, right? Because here there are so many small farmers work in the agriculture, and there are certain complex chain of things that happens, and there are so many subsidies, and you cannot imagine the kind of complexities that we have in agriculture. India has so many complexities, different states have different policies. So it is very difficult for Indian government to enter into a contract with Australian government to give them a complete market access for the agriculture, though Australian government is ready to give, right? So it is a complex process, it is an interactive process, they have to discuss so much, and they have two different competing objectives, right? Conflicting interests, right? Example, classic case is this: one is asking, bargaining for market access. If we reduce the tariffs, they will also reduce the tariffs, but others want protection and for the domestic industry. The country like India would ask, you can't export any product of agriculture to the, from Australia to India. So different, say, um, different objectives, each country, their growth, their life cycle, and the products that are available, their competitive advantages, everything is different, right? So you cannot have a simple memorandum of understanding, just like how we do for normal transaction. You want a product and you just enter into an agreement or purchase order and then get it. So trade negotiations is a complex process. It runs on for years. Sometimes it would take more than 8 9 10 years also. So trade negotiations is very tough thing. It is all about negotiation skills also, a lot of times, right? So international trade happens through these trade negotiations. All right. So what are the different types of trade negotiations that can be classified? There are different types of trade negotiations. How we can classify those trade negotiations, right? So those can be, trade negotiations can be under which umbrella you can do the trade negotiation. Basically, one is RTA, regional trade agreements, regional trade agreements, and other one is GATT, which was there before, General Agreement on Trade and Tariff. It was there before WTO. Now we have another umbrella and important one, which is also slightly successful, and that is World Trade Organization. So in these three different, all the trade negotiations can be classified under this. World Trade Organization negotiations are multilateral. Regional trade agreements can be different types. Regional trade agreements means within the region, say within the Southeast Asia. Southeast Asia means, just Google it, all the Southeast Asian countries, all the, Singapore, Malaysia, all these, or, all the South Asian countries means India, China, below the Afghanistan and Pakistan, all of these. So regional trade agreements happens between either country or within the region. Regional trade agreements are defined as grouping of countries which are formed with the objective of reducing barriers to trade. Of course, the objective of any of these is to reduce the barriers to trade between the member countries. So to reduce the barriers to trade between member countries. Trade negotiations result in different types of agreements. Of course, we will discuss those briefly. All right. What are the different types of regional trade agreements? Regional trade agreements, as we said, it is within the region, between two countries or within one area, right? So that's called regional trade agreements, the agreements between two countries or within a set of group of countries. Okay, unilateral, let's see few of it. What are the different types of agreements? Unilateral trade agreements, under which importing country, generally this happens with developed countries like US, offer certain trade incentives in order to encourage small and developing and underdeveloped countries to engage in international activities. For example, generalized system of preferences by USA, GSP. Recently USA removed India from this. So basically, to encourage medium developing and underdeveloped countries, countries like USA give incentives for exports also. If something we send to that country, they either reduce their taxes compare with other countries. This is called unilateral trade agreement. Like USA on their own gave some benefits. Bilateral means the example that I gave, Australia and say India recently entered into an agreement. So that's agreement between two countries or two regions. Regional preferential trade agreements, example, global system of trade preferences among developing countries. Trading blocks, very important. Examples, Arab League, European Free Trade Union, all of these. Free trade area and important common market in the regional trade agreements. Important one is common market. So common markets are generally, it is a kind of custom union where you treat different countries as one market. There are no taxes, there is no external extra charges, there are no barriers between those countries. That's called common market. That is like a closed set of trading agreement. European Union and ASEAN are the most popular. European Union is a common market. Someone who's making goods in one European Union country and selling to another European country will not attract any extra charges, right? So that's called common market. So similar to that, then we have, after regional trade agreements, GATT. That's called General Agreement on Trade and Tariffs. General Agreements on Trade and Tariffs. GATT was actually in existence till 1994. It is right before the World Trade Organization was formed. So, multilateral negotiations, like different multilateral negotiations, among many countries are held through this general agreement on trade and tariff. What should be the trade rules, how this has to happen, all of this are discussed under this GATT, General Agreement on Trade and Tariffs. In fact, this GATT is later reason for better coordination or better organization at the world stage for the trade. So they all felt, all the GATT members, in fact, adding some more members, they formed World Trade Organization. World Trade Organization was formed in 1994. At the last round of Uruguay round, GATT Uruguay round 1986 and to 94, this is formed. This has effectively replaced GATT. World Trade Organization is a one of the international organization for trade negotiations. All right. So then WTO replaced GATT. You understand? Now the GATT is not in existence. Okay. GATT is not in existence. GATT lost its relevance due to various reasons. Even that question is not so important as it is past tense. Then the birth of World Trade Organization. So important now, what is the World Trade Organization and how the members are and what are the objectives, what are the structure and guiding principles of WTO. All of this are important, right? What is the principal objective of World Trade Organization? It is very simple. to facilitate the flow of international trade. Very important. They facilitate the flow of international trade. How? SFFP. Smoothly, freely, fairly, predictably. SFFP. Smoothly, freely, fairly, predictably. The principal objective or the existence of World Trade Organization is to ensure that. I know it is like a vision statement. So the objective of World Trade Organization is to facilitate, all right, to facilitate the flow of international trade smoothly, freely, fairly, and predictably. All right. So this is the principal objective. You need to remember this properly. And question has been asked earlier. And how does the WTO functions? What are the main functions of World Trade Organization? First, it acts as a forum for trade negotiations among member governments, administering the trade agreements, reviewing the trade policies, cooperating with other international organizations, and assisting developing countries in trade policy issues through technical assistance and training programs. Basically, it is just like a United Nations for world peace. This is an organization for world trade. All right. This organization would help countries in forming the agreements, world trade agreements, helping them technically for especially developing countries and developed countries, facilitating the, negotiations, administering the trade agreements. So that's how they do the function, operate. So right now, WTO has almost 117 countries. Sorry, 164 members, 164 members, out of which 117 are developing countries, which contributes to almost 95% of the world trade. Technically, 90% of the countries, or would say 95% of the world trade, countries are members of World Trade Organization. You can understand how big the organization is and how serious organization it is in the arena of world trade. All right. So the World Trade Organization has certain successes, and what are their major guiding principles? Question is asked here also. What are the major guiding principles of World Trade Organization? As we discussed earlier, trade without discrimination, most favored nation treatment, national treatment principle, treating all the countries as your own, people, free trade, predictability in the trade, unusual changes in the trade regulation should not happen, general prohibitions on the quantitative restrictions, greater competitiveness, encourage the competitiveness, tariffs as a legitimate measures for protection. So here, just because we are members of World Trade Organization and World Trade Organization pitches for, trade smoothly, fairly, predictably, does that mean countries should not have tariffs? Countries should not protect their local domestic manufacturers? The answer is no. Countries can levy tariffs, but those should be reasonable, legitimate, and it should be reasonable for protecting the domestic industries. Of course, just because the WTO, the main objective is to ensure free trade, doesn't mean that the member countries should not charge any tariffs, but they can charge, but it should be predictable, and it should encourage competitiveness, and it is a legitimate measure for protecting the domestic industry, and transparency in the decision making, and slowly liberalizing it. It means they should have a plan to liberalize it. Right now, say on certain product they're charging say 20%, by when they will reduce. So not all the times they keep on increasing the tariffs, right? So progressive liberalization, giving market access to other countries, transparent, effective, and verifiable dispute resolution, dispute settlement mechanism, very, very important. A lot of times trade leads to disputes, right? Trade disputes are very common. The guiding principles of WTO says countries should have transparent, effective, and verifiable dispute settlement mechanism. All right. So there are various agreements under WTO that member countries have entered into. Most of the member countries, maybe not all 190 countries are part of all these agreements, but most of the countries are part of it. Examples like agriculture, textiles and clothing, technical barriers to trade, trims, and intellectual properties, trips, all those important agreements. There are many agreements, intellectual property rights agreement. These are very important. So there are different agreements that are entered under WTO. WTO is reasonably successful. WTO brought the world trade certain rule-based trade. It brought certain rules and it pitched for, say, fairness in the world trade. Developed countries should be protected. Sorry, developing countries should be protected, and they should encourage world trade. See, all this is good. So WTO is reasonably successful also. Let us quickly see how WTO functions. What is the structure of the WTO? The structure of the WTO, there is a ministerial conference and there is general council. Ministerial council is like a legislative, like assembly. General council is an executive body. Under that, there are 3: dispute settlement board, director general, trade policy review body. So briefly, that's how the WTO is. So WTO has entered into various agreements, complex areas, example, agriculture, application of sanitary and phytosanitary measures, anti-dumping duty agreements. Like, we know the meaning, so you can understand what kind of agreements these are. Those are anti-dumping duty agreement means to ensure that people should not get into such measures. Then entries related to rule of origin. There are various agreements, but as there is a success, also there are certain limitations. This question is important. What are the concerns with the functioning of the World Trade Organization? This is very important. What are the concerns that are there? And slowly the World Trade Organization is also losing relevance, considering the dynamics of world order right now. Because there are different member countries are involved and the conflicting objectives are there. Getting all of them onto one table and cracking a deal or cracking an agreement is not an easy task, right? So the process of multilateral negotiations on trade liberalization is very, very slow. It takes years and years. So this is obviously giving a problem. So countries, as a result, what they do, they enter with 2-3 important countries as a regional agreements, bypassing the World Trade Organization. Say, suppose India wants to enter into an agreement with Australia. So India and Australia will come, sit together, and they come into a agreement. So that's how it is working. So the process of the negotiation process is very slow under WTO, and there is a complex network of regional agreements. This brings a lot of problems. See, the countries within 2-3 countries or within block of the countries, they have some regional agreements. So now disturbing those and entering an agreement with WTO, some countries will not be happy to get into those things, right? So those are the problem. And recent rounds are not accepted by the member countries. And negligible trade liberalization, in fact, despite we have WTO, still there are so many member countries who don't follow the WTO guidance. They do their own, they charge or they levy higher tariffs. For that matter, even India, we charge on various products. While multilateral efforts have efficiently reduced tariffs on industrial goods, the achievement in liberalizing trade in agriculture, textiles, and apparel has been negligible. Certain areas, the efforts of WTO is in fact literally negligible, right? And there is a problem, like many agreements, this WTO a lot of times is showing biasness towards developed countries. So that is why developing countries have raised certain issues. You know, real expansion of trade in three key areas of agriculture, textiles, and services is very dismissal. And a lot of times, least developed countries find themselves disproportionately disadvantaged whenever they enter into these kind of agreements. So WTO is what? Obviously, pitching for, say, free trade, right? So when there is a free trade, what happens? The powerful person will be able to sell more to the powerless person, or say the developed country will be able to sell more and they'll be able to extract more advantage from underdeveloping or developed, underdeveloped or developing countries, right? So always this is a bigger problem for underdeveloped and developing countries. And there is a problem also. The recent Doha round that happened, that was into trouble. So the concerns are there. WTO is, we cannot say that it is, extremely successful organization. They have their own problems, bureaucracy, delays, and increased interregionalism. Regionalism means 4 or 5 countries coming as, you know, as a trade bloc, and they themselves forming an agreement, bypassing all the WTOs. All these are the problems with functioning of the WTO, or the challenges for a success of World Trade Organization. All right. So that's about trade negotiations. In the trade negotiations, quickly let us revise. We have different types of trade negotiations. Why trade negotiations is complex, we understood. Regional trade agreements, GATT, WTO. All right, these are the three different types are there. Our WTO is formed from the GATT only. All right, regional trade agreements are different. Regional agreements within the countries, within a block of countries or within 2-3 countries, those are called regional trade agreements. Different types of regional trade agreements we discussed. All right, then we discussed about GATT, and then WTO, very important. What are the concerns of WTO and what are the guiding principles of WTO we discussed. Okay. Now, what is next? We are done with unit 3 in the chapter 4. Now we have unit 4. This is also very interesting. That is exchange rate and its economic effects. We know the exchange rate impact on the recently we had this in the Indian currency fallen, the rupee against United States dollar. What happens? So when you have a lot of imports, what is the impact and how this lead to a lot of economics, problems? All that we will discuss. Exchange rate and its economic effects. So in this, we'll discuss about the different exchange rate regimes in the world and what is change in exchange rates and devaluation, depreciation. The difference between devaluation of currency and depreciation of currency we'll discuss. All right, let us take a jump into it. What is the first exchange rate or foreign exchange rate? Both are same. So what is exchange rate? What is exchange rate? Exchange rate refers to money determined in a currency other than the domestic currency. Suppose you have, say, 10 lakh rupees. So now, if it is expressed in dollars, the conversion rate that you used is what is exchange rate in simple terms, right? Money denominated in a currency other than the domestic currency. All right. So your 10 lakhs express, say $15,000. If it is expressed like that, the conversion rate that we used is simply the exchange rate, right? So we all know what is exchange rate. So how do you express the exchange rate? There are two ways to express. One is direct quote and the other one is indirect quote. All right. Suppose if we say $1 is equals to 77 rupees. That is direct quote. $1 is equals to 77 rupees. You remember this thumb rule. $1 is equals to 77. Always we mention in that way. We don't remember generally 1 rupee is equals to how many dollars. So when it is expressed with foreign currency as a base or one unit, it is called direct quote. $1 is equals to 66 US dollar. It is direct quote. Indirect quote is quite opposite to this. 1 rupee is equals to how many dollars? 1 rupee is equals to how many dollars? Is simply indirect quote. You can quote in both ways, right? Then we have something called cross rate. Suppose there are two pairs of currency with one currency being common between two pairs. How do you explain? The rate between Y and Z, which is derived from the given rates of another set of two pairs of currency, is called cross rates. For example, it says the euro rate, or say the currency of Afghanistan is determined based on the average exchange rate of India and Pakistan. If it is said like that, how are you arriving the Pakistan's exchange rate? You are looking at another two rates, right? So that is called cross rate. So next we have, what are the different types of exchange rate regimes in the world? There are different types of exchange rate regimes in the world, especially two types. One is floating exchange rate regime. Second one, fixed exchange rate regime. I'll speak first about fixed exchange rate regime. I'll speak first about fixed exchange rate regime. Also, it is referred as pegged exchange rate regime. All right. So what is fixed exchange rate regime? I'll take Indian context as an example. So as you know, if you see one, dollar and rupee, one day you will see at 75, and after 1 week, sometimes you will see at 77, and at some other time you will see at, in future, say after 6 months, it may become even 80. $1 is equals to 80 rupees. Is it fixed? No, right? It is not fixed. It is floating. It is volatile. So quite opposite to this is fixed. Suppose, assume hypothetically, as on 1st January 2021, $1 is equals to 65 rupees. And even today, suppose in 2022, $1 is equals to same price of what is there at 1st January 2021. If that is the scenario, that is called fixed exchange rate. It means there is no exchange loss. When you are making accounts also, there is no exchange loss in your books. Like you buy products at the same exchange rate and you sell products also at the same exchange rate. So that is called fixed exchange rate, and it is also called pegged exchange rate. Is an exchange rate regime under which country's government announces or issues a decree or a law what its currencies will be worth in terms of another currency or a basket of currencies such as gold. I'll give you an example for this. The example for this is a lot of Middle East countries like United Arab Emirates, Saudi Arabia, they all pegged their exchange rate with United States dollar, USD. So now if I say 1 AED, 1 Arab Emirate dirham is, is equals to 3.6, sorry, 1 US dollar is equals to 3.67 Arab Emirate dirhams. This is the same rate for last 3-4 years. So then you can understand. That is called fixed exchange rate. But not everyone follow this. There are certain problems to follow that fixed exchange rate. So now I'll just come back quickly to understand what is floating exchange rate. Now, what is not fixed exchange rate is obviously the floating exchange rate. This is completely left to the market forces. There are dealers who want foreign currency. There is a demand and supply. There is someone who want foreign currency, someone they wanted to give out the foreign currency. So the way the transactions happens at the market determines the exchange rate. You get it? The way transactions happens at the market, say the currency market, determines the exchange rate. The equilibrium value of exchange rate of a country's currency is market determined in the floating exchange rate regime. So a lot of developed countries, or some of the countries, most of the countries in fact, the demand and supply relative to the other currencies determines the exchange rate. Why the exchange rate is changing is because of the demand and supply changes. All right, just like any commodity, say why the onion prices go up and come down, similar to that, even the exchange rate regime also works based on that only. What is the demand, what is supply? So based on that, the exchange rate keep on varying in the floating exchange rate regime. Which regime to pick up is generally determined by the respective government of a country, or could be the central bank. The floating exchange rate allows a government to pursue its own independent monetary policy, and there is no need for market interventions or maintenance of reserves. But volatile exchange rate generates a lot of uncertainty in the market, that we know. Countries like USA, New Zealand, Sweden, these all come under floating exchange rate. All right. Even India comes under floating exchange rate, but RBI do involve at times. We are flexible, but at times whenever there is a unusual fluctuation, RBI do certain functions to manage the foreign currency rate. So that's why we cannot completely say India is a floating exchange rate regime, but definitely we are not a fixed exchange rate regime also. We come in middle. All right. So floating exchange rate regime, purely the rate is determined by the market. Fixed exchange rate regime, government issues a law saying this is the exchange rate, and they enter into an agreement with the respective country's central bank to peg the exchange value. All right. But here, the work of central bank is so much for the fixed exchange rate, because it is not left to the market forces. So when they fixed a price, they need to ensure even if any transactions happens in the market, the market prices should not be different from the fixed exchange rate. Say, for example, government asked all people, say all the petrol, government asked all the states to sell at one single rate, assume hypothetically. But if that rate is not, is fair, what happens? There is something called black market. So generally, the black market will be there. So a lot of times this ration and all, government tell one price to sell, but the dealers, some of the dealers, they sell at some other price. Why that happens? Because The same thing in the open market, can be sold at a higher price. Similar to that, even in the exchange rate also, the central bank of the country who have pegged their exchange rate needs to work very hard. They need to be on their toes to ensure that the market rate, even if there is no black market existed parallelly, and the exchange rate is either less or more than the pegged exchange rate. So that's why central bank has to maintain huge reserves to impact the demand and supply in the market, and to ensure the prices are similar, the pegged exchange rate and even the market exchange rate. All right. Central bank may implement soft peg policy under which the exchange rate is generally determined by the market, or a hard peg wherein central bank sets a fixed and unchanging value for the exchange rate. We are talking about hard peg. I told you, right? It is not varying. Sometimes they go for soft peg. It means they'll give certain band. Say $1 can be between 70 to 77. If anywhere in between these, it is fine. So that is called soft peg policy. So fixed exchange rate avoids currency fluctuations, of course. It will bring certain predictability for the trade also. And the central bank but has to maintain adequate reserves and always be ready to intervene in the forex market. This is the biggest thing. Central bank should always be ready. All right. But the benefits are there. There are no fluctuations and the investors will be ready, and trade will be, there will be some predictability, right? That's about fixed exchange rate regime and floating exchange rate regime. All right. So what are the advantages of fixed exchange rate regime? We discussed just now. Quickly we'll see, as this is asked in the previous, whatever I highlighted like this is asked in the previous years. What are the advantages of fixed exchange rate regime? It avoids currency fluctuations, very important. We Indians know the pain of currency fluctuation. Fixed exchange rate system imposes discipline and likely to generate less levels of inflation, right? And the government can encourage trade and investment as it is stability. And it also brings credibility to the country's monetary policy. Someone could peg their currency means they bring credibility, right? So people can trust that country, investing in that country. What are the advantages of floating exchange rate regime? Simple one, central bank need not get into daily, you know, activities in the foreign currency. Government can pursue its own independent monetary policy. They don't need to spend too much of their efforts and money for the forex policy. Floating exchange rate regime allows exchange rate to be used as a policy tool. Central bank is not required to maintain huge forex reserves because they don't need to, influence the market. Let the market decide what is the exchange rate, right? Cool. The next one is, what is the difference between nominal exchange rate and the real exchange rate? What is the difference between nominal exchange rate and real exchange rate? Nominal exchange rate is simple. Till now, whatever we are discussing is nominal exchange rate. It states how much of one, how much of money can be traded for you, 1 unit of another currency, and prices are constant. Whereas real exchange rate, which incorporates changes in a price in a better measure. So I'll just tell you with an example, real exchange rate, real effective real exchange rate, how this works. Assume a basket of, say, 5 apples in India you bought for 100 rupees. If you buy same, I am giving with one example only, 100 rupees, 5 apples, it means each apple 20 rupees. And you are in US, if you try buy 5 apples there, assume it is costing you $5. $5. It means each apple is costing you $1. Whereas in India, each apple is costing you 20 rupees, right? So obviously, when we exchange, One apple, $1. Here is 20 rupees. So $1 is equals to 20 rupees. This exchange rate is called real exchange rate. You get it? So real exchange rate, which incorporates changes in a prices, is a better measure. How many of good or service in one country can be traded for one of that good or service in foreign country? The example of apples that I gave fits here, right? So here the foreign currency rate, the exchange rate is $1 is 20 rupees. Whereas in nominal currency, suppose today's rate, $1 is equals to 77 rupees. For all the daily day-to-day transactions and all, we use $1 is 77 only, but the real exchange rate is 20 rupees. All right. So that's how you need to see nominal and real exchange rate. How do you arrive the nominal real exchange rate? Nominal exchange rate into domestic price index divided by foreign price index. So with this, you will arrive real exchange rate. It is a real exchange rate considers the price changes. Real effective exchange rate. There is a concept called real effective exchange rate. It is the nominal effective exchange rate, measure of value of currency against weighted average of several foreign currencies divided by price deflator. This is slightly complex, but here you will consider weighted average of different foreign currencies. You will not consider one. That is called real effective exchange rate. All right. After that, what we have? Changes in exchange rates, appreciation, depreciation, devaluation. Let us quickly see what is the next topic. Appreciation and depreciation, right? So what is appreciation of currency and what is depreciation of the currency? After that, we also have concept called devaluation. There is a difference between depreciation and devaluation. Even in accounts, you must be knowing what is depreciation and what is devaluation. So though you can't take as is meanings, what is there in the accounts, similar here. Assume $1 is equals to 66 rupees in 2018. Now $1 is equals to 77 rupees. So what happened? Currency, the Indian rupee is depreciated or appreciated against the United States dollar. The example that I gave, $1 is equals to 66 rupees in 2018. Now $1 is equals to 77 rupees. If someone asks you, the currency is depreciated, Indian rupee is depreciated against United States dollar, is it depreciated or appreciated? Certainly, the Indian rupee is depreciated. Now, if you want $1, earlier you only need to give 66 rupees. But now if you want $1, you need to pay 77 rupees. So that is why rupee value is depreciated. This depreciation is natural due to the market forces of, as we said, demand and supply. When its value increases with respect to value of another currency or basket of currencies, that is called appreciation. On the contrary, currency depreciates when its value falls with respect to value of another currency is called depreciation. What is the effect of depreciation? Exchange rate depreciation lowers the price of countries' exports. So depreciation is good or bad for the exports? Is it good or is it bad? First question, depreciation is generally good for exports. It helps. Suppose someone entered into a contract when dollar was 66 rupees, but now dollar is 77 rupees. What happens? When the money they receive more money, right? So that really, they receive more Indian rupees. So rises the relative price of imports, whereas imports will become more expensive, right? Imports will become more expensive, isn't it? Next. The depreciation also increases demand for domestic import competing goods and services. Why? Because the imports becomes expensive. So importers would stop buying products from outside and they start buying products locally only, as the products can get at a comparatively cheaper rate. So because of the depreciation in currency, the imports will become bit expensive and it leads to output expansion because the domestic industry demand has increased, and it says increases economic activity, competitiveness, all of it. Yeah. What are the effects of appreciation? Appreciation makes imports cheaper, but exports will lead to change in import and export volumes, causing changes in import spending and export revenue. Export revenues will come down, whereas imports, imports will be benefited positively. Adversely affect the competitiveness of domestic industry, cause larger deficits and worsen the current account. That is true, right? Next, what is the concept of devaluation? Impacts of currency appreciation is discussed. What is the effect of devaluation? Depreciation versus devaluation. What is, difference between devaluation and depreciation? The question is already asked from this. So devaluation is a monetary tool used by the countries deliberately that have fixed exchange rate or nearly fixed exchange rate regime and involves discrete official reduction in otherwise fixed par value of a currency. So basically, certain countries, they officially decrease the value of the currency. Certainly this happens in exchange rate regimes of fixed and nearly fixed exchange rate regimes. Floating cases may not be possible. So what they do, they reduce, officially they decrease, officially reduce the exchange rate. Why they do this? Generally, if we say appreciation is good, but why depreciation is good? Depreciation is good for the exports. Countries like China, they do it frequently. They depreciate their exchange rate. Why? Because they are export oriented countries. So when they depreciate their exchange rate, automatically the exports will be more and more competitive, right? So that is called devaluation. Devaluation is deliberately, officially decreasing the value of currency. That is called devaluation. The classic example is generally these guys, Chinese do this, and revaluation is also there. Revaluation is opposite to devaluation. All right. That's about exchange rate. All right. That's about exchange rates. How the foreign exchange market works. The market, as I said earlier, over the counter market, it is not a physical place. Rather, it is an electronically linked network bringing buyers and sellers together and has very narrow spreads. Okay. So generally the bankers are the dealers who deal with Forex, and there will be a buyers and sellers, and based on the demand and supply, the Forex rate is determined. All right. What are the different types of transactions in the Forex market? Spot market, forward market. Like spot market, we all know the rate at as on date. Forward market or future market means rate after 3 months, agreeing with contract with bank to give currency at so and so rate after 3 months. That is called forward market. All right. So with this, we are through with unit 4 in the chapter 4. All right. Let us start with unit 5, international capital movements. Take a quick break and sit. What is international capital? The movement of international capital. International capital or foreign capital is nothing but, investments coming from a country other than home country. Inflow of capital into home country from abroad, in simple terms, is foreign capital. Say US company investing in India. US car manufacturing company Tesla investing in India is foreign capital. The capital that they bring to establish manufacturing plant, all of this, the money that they bring in is FDI. Say startups getting a funding from so and so venture capitalists, foreign venture capitalists. That is inflow of capital. All right. So there are two ways, international capital can be classified. Those are FDI and FPI, foreign direct investment and foreign private investment. What is foreign direct investment and what is foreign private investment? So what is FDI? What is FDI? FDI is defined as a process whereby resident of one country acquires ownership of an asset in another country, and such movement of capital involves ownership, control, as well as management of the asset in the host country. Here, acquiring asset, it means not just investing and being a shareholder. Foreign direct investment says you are acquiring ownership as well as control, as well as management. Who's going to manage that company that you acquired? Say a US company, say Google acquired one startup in India. Now Google will have say on everything, where the office needs to be. I mean, this is the management, the board at Google USA, having control over who should be the board members and having almost 90% control over the shareholding. If these, 90% as an example I gave, if this happens, that is an FDI. That is an FDI, right? So here there are two important things. One, asset has to be acquired. Second, even the ownership, along with ownership, even the control as well as management of assets should also be with the host country. In that example that I gave with the Google. All right. So FDI may be categorized into three types. Those are how much percentage of ownership, all of that we will discuss later. FDIs are of three different types. We were not open earlier. I told you, earlier about, in India, after 1991 only, we allowed FDIs into various sectors. Earlier, foreign direct investments are prohibited into the country for most of the sectors. Even if someone wants to invest in India, they have to first get a license from the government of India, and then only they'll be able to set up any business here. That's how it used to be before 1991. But after that, we had come up with automatic approval. If someone wants to invest in India, they can straight away do the investment, barring few sectors where you need to get first approval and then invest. Otherwise, FDI now is fairly smooth process in India. So FDI can be classified into three types: horizontal, vertical, conglomerate. Horizontal, vertical, conglomerate. What is horizontal investment? Horizontal FDI means investing in the same business in foreign country. Suppose Tesla investing in electric car manufacturing company in India. One of the electric, say Ather Energy, they are investing in that. So that is horizontal investment. It means investing in the same business but in other country. That is horizontal investment. Vertical investment is, in a way, it is different from the main business activity. For example, say Suzuki investing in India, but they are investing in tire manufacturing company, say MRF. Here, it is different from their main business activity, but some way it supplements their major activity, right? Some way it supplements their major activity. That's called vertical investment. There is another type, conglomerate type of foreign direct investment, wherein business that is unrelated to its existing business in its home country. Investment is in some other business which is not related at all. Say Google investing in, say we can't take Google as an example. Google is in so many industries. Say Suzuki is investing in, say for example, in a software company. Here Suzuki is a transport vehicle manufacturer, but they are investing in software. That is called conglomerate type of investment. This question is asked in the previous year. Important, it could be asked once again. What are the different types of FDI is there? All right. So that's about FDI. What is FDI limit? So how do you determine whether it is FDI or not? The IMF and OECD has given certain guidelines. Acquisition of at least 10% of the ordinary shares or voting power in a public or a private enterprise by a non-resident investors makes it to be eligible and categorized as foreign direct investment. Basically, FDI main characteristic is acquiring the ownership at least bare minimum 10%, and it is long-term orientation. It is not short-term. The FDI has three components. One, equity capital, next reinvested earnings, and other direct capital in the form of intra-company loans. It could be any way, right? So FDI is kind of long-term orientation. Suzuki investing in Maruti is kind of long-term orientation. They are working together for last 25 to 30 years. That is FDI, right? So FDIs are real investments that helps to generate employment opportunities, growth, help in increasing GDP. There are so many benefits with FDIs. So many technologies would come into the country, right? That's about FDI. Now let us talk about FPI. FPI. It is more of financial capital rather than the real capital, because it doesn't involve ownership or control, and it is not even long-term orientation a lot of times, right? Basically, the investments in the stock markets by the foreigners is FPI. What is not FDI? What is coming from the foreign? If it's not FDI into any company, if it is not even 10%, it is called financial capital. It is FPI, foreign portfolio investments. Example of foreign portfolio investment are deposit of funds in India or a British bank by an Italian company, or purchase of bonds of a Swiss company, right? Or Swiss government by a citizen of a company based in France. In simple terms, FPI is, say, Google investing 6 to 7% stake, say, Facebook investing in 6 to 7% in Reliance Jio. Example I gave, it is small portion and it is not for long term. Unlike FDI, portfolio capital moves to the investment in financial stocks. Generally, the investment is in stock market, bonds, and other financial instruments, and is affected largely by individuals and institutions through the mechanism of capital market. Basically, the stock market. Main capital market we have is stock market. So the singular intention, I know for FDI also to earn profit, but singular intention, the sole intention in FPI is to earn good returns through the portfolio moves, right? So it is like earning returns on the stocks, right? That is FPI. So you will hear a lot of times in news, especially when you are reading the newspaper, foreign portfolio investments Foreign investors have taken their money back, say $2 million from the Indian stock market. It is nothing but foreign portfolio movement. Portfolio investments are, as I said, less than 10%, and it is a lot of times short term in nature. When they earn profit through their stocks, they might take it back. So that is the difference between FDI and FPA. So let us see quickly what are the differences between FDI and FPA. FDI cases, it creates physical assets, creation of physical assets. In this case, no physical assets. It's all simply financial assets. It is really difficult to withdraw and it is easy to withdraw. It is not speculative FDI. It is speculative in nature. All right. This is very simple. If you understand the basic ground rule, it is easy. What is FDI? What is FPI? All right. So next we have, what are the main reasons for FDI? Why people invest, US companies or say Chinese companies invest in India? First and foremost, profits and higher rate of returns, access to the markets, large scale operations, economies of scale, risk diversification, business continuity planning, capturing the emerging market. Of course, there are various benefits. Countries investing in other country, where if someone is investing means there is some potential, that's why they are doing, right? So cost effectiveness, all of these, there are many reasons for companies to make investments, especially countries like India, which are emerging countries, developing countries, right? There is a lot of human capital. India is one of the top countries in attracting the foreign direct investment. So foreign direct investment, how this happens, as an example, it can be through opening a subsidiary and starting business afresh, or equity injection, or through acquiring controlling stake in existing company, or through mergers and acquisitions, or through joint ventures. All right, that's how the FDI comes into the Indian companies. What are the benefits? What are the benefits of foreign direct investments? And what are the problems with foreign direct investments? Please change this. Should be problems. Here, what are the benefits? There are so many benefits, as I said. Efficiency, higher efficiency, right? As something is coming here, higher efficiency. It increases the domestic output and income, brings high wages. What all we are achieving in India, a lot of the employment that we are having, because there are many investments that have come from outside of India. As we are not capital rich country, we are labor rich country. We don't have required capital. Once we got that capital, there's so many companies formed and so much of employment opportunities, right? And so many people are traveling out of country. All these happened through FDI only, because of FDI. Allowing FDI into the Indian market made wonders. The current generation, the opportunities that current generation is having in terms of employment are fruits of allowing foreign direct investment into the India. Undoubtedly, for our parents' generation or before, it wasn't an easy task even after they complete graduation and they are really good at their studies. Getting a say a good job used to be a difficult task, but that is not the case now, right? Now we have so many employment opportunities. All this credits needs to be given to the foreign direct investments, right? Better access to foreign markets, controlling the domestic monopolies, right? We can control by getting new products from outside. Suppose Ola cabs is domestic, say Uber is from outside. Assume Uber is not there. What happens? So more monopoly will be there, right? Increase in regional disparity, crowding out of domestic investments. These are problems also. Let us quickly see from the notes what are the benefits of FDI. Cost reducing and quality improvement innovations, right? FDIs can accelerate growth and foster economic development. Example is India. FDI involves setting of production base, factories, plants. It generates employment, right? There's so many greater possibility for promotion of ancillary units. Foreign investments also would act as a resource of new tax revenues for the government. FDI has favorable impact on the host country's balance of payments, especially the balance of payments, nothing but exports and imports. What are the problems associated with FDI? It is generally, FDA is likely to concentrate on capital intensive methods of production is inappropriate because they a lot of times automate things and they will not be able to address unemployment, and it creates a lot of regional disparity. Assume they come and invest only in areas where there is good facilities, where there are good facilities. For example, they come to only metros like Bangalore, Hyderabad, and they invest there, and the regional disparities do come in, right? And various important things, and their high profit orientation a lot of times create issues. They act anti-ethical and they do illegal activities, right? And sometimes they damage competitive local industry. All these problems are there with FDI. You remember, say 10 benefits and 5 problems, right? 10 benefits and 5 problems with FDA, that is more than sufficient. And the growth of FDI in India is phenomenal, and the post-reform phenomena after 1991 is too good. Government has different stages: liberalized FDI, increased sectoral caps. Like earlier, they used to be 51% only, 49% eligible in a lot of sectors. Now 100% FDI is allowed. All right. So that's how FDI is also grown in India, and it helped for India to grow and become, world power, or world power in terms of economy. The major reason also FDI. All right, we are a bigger market, so anybody would love to come and invest in India. That is our strength, more than our military strength, more than anything. The countries, sometimes right now, you know, don't get into an argument with India because of our trade, because of our readily available market in India. All right, US don't mess with us now because we have a lot of businesses of US in India, and there is huge trade that is happening between the two countries. All right, with this we are done with the chapter 4 unit 5. It means chapter 4 is complete. Quickly I'll cover overseas direct investment by FDI. We are only talking about US companies investing in India, but there are also things like Indian companies investing in outside of country. In US, UK, there are many companies, especially the bigger groups like Tata's, Infosys, Wipro, HCL, Mahindras. All of them have investments out of the country, and even FDI space, out of the country. Our investments also taking good growth, especially we are good in the IT. TCS, Infosys, Wipro, they are giants and they are having global contracts, and they are investing a lot out of the country. All right, so even FDI for India, investments going from India to outside also decent. All right, with this we are done with chapter 4 unit 5. So with this we are completed with chapter 4 international trade. Right, thanks. Right, let us start the new chapter, that is chapter 3, money market. Money market, it is something that determines or defines every person. Money, vitamin M is something, we all need it, and there is no one who can survive without this. So we need to talk as economists on the money, the availability of the money in the market, and we need to understand how money flows in the economy, right? who controls the money, what are the trigger points that central banks look into, and how money flow is regulated or managed by the central banks. We study in this money market chapter. In the money market chapter, we have 3 units. First one is concept of money demand. As we know, demand for money and the concept for money supply, second one. And the third one, monetary policy. The policies, monetary policies of especially the central bank, that is RBI, we're going to discuss in the monetary policy. First unit, let us pick up the first unit. First unit is the concept of money demand, right? What is the concept of money demand? So let us have a quick overview of the unit. The money market, the concept of money demand. First let us understand what is the different functions of the money and why there is a demand for the money, and the different theories of demand for money. And in that theories only, there are pre-Keynesian theories and there are post-Keynesian theories of demand for money, right? So we are going to discuss a lot of theories of demand for money under this. All right. So first, what are the functions of money? Money performs many functions. We all know. We can buy what we want. We can do what we want in love. A lot of times, 90% of things that you need, in this world, material things, you can get it, right? So define the term money, explain the nature and characteristics of money. Very basic thing, right? Money refers to asset which are commonly used and accepted as a means of payment or as a medium of exchange or of transferring purchasing power. 3 words are there. Money refers to first asset which are commonly used and accepted as a means of payment, a medium of exchange, or for transferring purchasing power. Very important thing, commonly used and accepted as a means of payment. Here, they didn't say money means currency, which is printed. They did not mention simply money means currency which is printed. Say 10 rupees notes, 50 rupees notes, 500 rupees notes, not this. Assets which are commonly used and accepted as a means of payment or a medium of exchange or for transferring purchasing power is called money. Gold can also be money, or precious metals could also be money. As we progressed, earlier the currency concept was not there. Initially, people were transacting by exchanging in the barter system. Then they started using the precious metals like gold, right? Then the sophisticated thing came up as coins. Now we have, in fact, currency notes, right? So the currency notes that we have now. So it has changed. The money definition has changed over the period in the human life cycle, right? So for the policy purposes, money may be defined as set of liquid financial assets, right? The variation in the stock of this will have impact on the aggregate economic activity. If there is more money in the economy, there is going to be huge activity in the economy. There is demand for the goods, right? And there will be inflation, all of this, right? Quite vice versa also. Anything that would act as a medium of exchange is not necessarily money. As you know, anything that would act as a medium of exchange is not necessarily money. For example, bill of exchange may also be medium of exchange, but it is not money since it is not generally accepted as a means of payment. For example, gold right now, it is not money. It is not generally accepted as a means of payment. So what are the characteristics of money? Money should be generally acceptable, durable, effortlessly recognizable, right? If someone sees it, they'll be able to recognize. Difficult to counterfeit, relatively scarce, portable, possessing uniformity. All these are the characteristics. Remember 4 or 5 characteristics. All right. Okay. The next question, the important question, and it is asked already. Money performs many functions in an economy. What are those functions, boss? You're talking about so many things. We know a lot of things money performs in personally, but how money performs many functions in the economy? Here the question is, we talk about economics. So in the economy, how money performs many functions, right? Money is a convenient medium of exchange, and it is a unit of value or unit of account. Anything, suppose the worth of this pen cannot be told easily in, say, 10 grams of gold. It is very difficult to say that. It is easy to say it is 100 rupees, right? Money is explicitly defined unit of value. It is a measure for value. Measuring the value of a product, it can be easily measured, and it is convenient to measure the prices of all commodities in terms of single unit, right? So anything can be anything in this world. Most of the products can be measured in terms of money. Money is also a store of value. We all know. We store all our efforts. For example, people earning salaries, where they're going to save their efforts. Suppose they put day and night efforts, and they, in return, what they're getting? Their return is money, which is stored. Their efforts are stored in form of money. It is a store of value. And money is only asset which has perfect liquidity, right? So if you give to someone, they'll be able to give you what you want. What if they have it provided? So that's why it is a perfect liquidity. It is a store of value. It is a unit or standard for a deferred payment as well as standard payment. Deferred payment means for something to pay in future, how much you need to give, then you'll be able to determine now with measure of money, right? So that's how money functions. Money performs many functions. All right. Right. Next, let us discuss the concept of demand for money. Here, you might say demand for money is unlimited. What are you talking? Everyone need it. How much ever it is there, I am ready to take it if it is given. But here in the economics, demand for money means the demand for people desire to hold money. It means people desire to hold their own money, their own, you know, value or asset in the form of money. Say for example, for now we'll say in the form of physical currency. It could be in their bank savings account, or it could be in their homes. How much they wanted to hold money, right? Why they wanted to hold money? Those all determines the demand for money. If you might have 100 crores, but you wanted to keep with you only to say 50 lakhs in your bank account, and in your hand another 50 lakhs. It's too much, but yeah, 1 crore only you wanted to keep. So now the demand for money is that 1 crore only. We are talking about that 1 crore. We are not talking about your 100 crore assets. All right. So if people desire to hold money, we say there is a demand for money, right? So the demand for money is the nature of derived demand, right? It is demanded for its purchasing power. We all know demand for money is actually demand for liquidity. Obviously, why we wanted to hold money? Liquidity. We want to give that and get something what we want. Demand for money has an important role in the determination of interest. If there is a huge demand for money, obviously the interest rates will be high. During the slowdown, people don't take loans and there is less demand for money. So that time banks reduce the interest rates, right? That is situation where there is less demand for money, right? So the quantity of nominal money or how much money people would like to hold in liquid form depends on many factors such as income, education levels, rate of interest, GDP, and the level of financial innovations. For example, now if we talk about the current scenario after we got these, UPIs, we in fact really not holding too much of money, right? We are having little money in their in our savings accounts also a lot of times, right? Higher the income of individuals, higher the expenditure. That is obvious, right? Rich people will have more money to spend. So innovations such as internet banking, all of these also reduce the need for holding money, isn't it? So demand for money, holding money in the form of physical currency reduces, right? If you are putting in, if you are having high financial innovation, isn't it? Let us discuss different theories of demand for money, how the demand for money is calculated. We discuss what is demand for money. All right. So let us discuss what are the different theories of calculating demand for money. The first one is quantitative theory of demand for money. Second is the Cambridge approach. The most important ones are these two: neoclassical approach, or also called Cambridge approach. The third one is the Keynesian theory of demand for money. This is more latest. As I said, as you know, these theories, classical came up in 1800s and this one later, and this one is latest, Keynesian theory in 1940s, 1930s. So let us see how the demand for money, theory, quantitative theory of money, so how this is um, you know given. Fisher is the economist who gave this. The equation of demand for money is MV is equals to PT. It means M is total amount of money in the circulation, total amount of money that is in the circulation into the transaction velocity of the circulation is equals to average price levels and to number of transactions, PT. Simple. Money transactions, actual money in the circulation into the speed at which that money flows is equivalent to price levels into number of transactions. MV is equals to PT. Later, Fisher extended equation to include bank deposits. Demand deposits is nothing but savings accounts and their velocity also. So this is one is actual currency in their hands, and this is in money in the savings accounts. The speed at which these flows determines the PT. The price levels and transaction determines the demand for money. All right. So that's how it is explained. Fisher extended later even the currency, that is, actual currency printed, along with that currency that is, or the amount that is in the savings deposits. Demand deposits is nothing but savings accounts. Next, we have classical approach. It is also called Cambridge approach. Cambridge approach. So what in this approach, neoclassical approach, the Cambridge approach says is money increases liquidity in two ways. People hold money for two purposes. See, these two purposes are very, very important. And because of these two purposes, people hold money in the physical form, right? First one is enabling the possibility of split up of sale and purchase of two different points of time rather than being simultaneous. For example, why we hold money in the either our savings bank accounts or with in the physical form in our hand? Because our requirement, suppose we earn salary on say first of every month, whereas our requirement, say you earn 10,000, but there is 4,000 requirement throughout your month. Every day you need some 100 rupees, right? So like that you need 3,000. So the time that you earned, the time that you spend is different, right? So that's why you need to hold money, isn't it? So that is one reason for which we hold money with us. Next, being hedged against uncertainty. This is like precautionary measure. Like we keep money for emergency purposes. Never know, you need to go to hospital. Never know, there is some emergency came up for a friend. So you keep certain money as a reserve for hedge against insecurity. So that's why you keep it in your home, right? These two are the main purposes people hold money. The demand for money is due to these two purposes. Who said this? Cambridge, right? The Cambridge equation says MD is equals to demand for money is equals to KPY. What is K? K is proportion of nominal income that people want to hold in cash balances. For example, the one that I said, say 60% of the money people use it for their day-to-day transactions and for emergency. So here K is 60%. 4,000, never know. He invested in some stocks or somewhere. We are talking about demand for money means holding money in the either their savings account or in the physical form. So P is national income. PY is national income. Proportion of it is nothing but the demand for money. P is average price levels and Y is income. So PY is nothing but national income, PY. So proportion of your income is what? Demand for money. Proportion of income that you keep it for yourself to face these two. One is for your day-to-day transactions and second is for emergency purposes. Right? In an example, if I say someone who's earning 10,000 rupees, keeping 6,000 with them, 3,000 for daily purposes and 3,000 for as a reserve for, as an emergency. So the 6,000, 60%, 6,000 is the demand for money now for someone who's earning 10,000. 4,000 he might invest somewhere. He might be paying for his EMI or whatever, right? So 6,000 is a demand for money. That's what the Cambridge approach is saying. Next, what we have, the most important, and this has been asked in the exam also, Keynesian theory of demand for money. So the Keynes, who's in 1940s, he gave 1936. He extended neoclassical. He said people desire to hold money, rather than securities or long-term interest-bearing investments. People hold money for three different motives. In fact, two we covered earlier. Those he gave a clear-cut form. One is for transaction motive. It means for day-to-day transactions, for next 15-20 days, you need money. So you will keep it, some money. Second is precautionary motive as an emergency. Third is speculative motive. For example, speculative motive means they hold money to invest in a better opportunity. So they keep, holding money a lot of times to invest in a better opportunity which is gonna come. So these three purposes why people desire to hold money. Assume demand for money here. We only speak about money which you wanted to hold in your, hand or in your savings account, which you can deposit at any time by going to ATM. Right? These three purposes determine how much money you keep it. So transaction money purpose, precautionary purpose, and speculative purpose, all three if we combine is what is demand for money. We know transaction motive. It means for day-to-day transactions, right? So that is LR is equals to KY, ratio of earnings which is kept for transaction purposes. An example that I gave, 3,000 is what? For transaction motive. And the precautionary motive, as I said, emergency purposes, another 3,000. Now you are waiting for another investment to make it. So you wanted to accumulate, say you wanted to buy house. So you are accumulating every month 3,000 rupees in your account for certain EMI. So for basically to have certain amount to invest in certain thing in a asset. So in those cases also you hold money, right? So speculative purposes. So for example, interest payments and the capital gains. So to achieve better interest rates, those times we use, you know, what are the traditional investment channels? Investing in bonds, investing in fixed deposits. So people hold money to wait, they wait and invest in bonds who give better interest. So that's why speculative demand for money also matters. So combining all three, transaction motive, precautionary motive, and speculative motive, determines what is actual demand for money. All right. The aggregate speculative demand for money is nothing but the combination of all three. All right. There are various post-Keynesian theories also for demand for money. Those are not so important, but yeah, we'll just briefly cover it. All right. There are few, post-Keynesian theories. One is Friedman's restatement of quantity theory. He says demand for money is affected by same factors as demand for any other asset, namely permanent income and relative return on assets. These two determines how much money that people would like to hold, how much income that you are earning, and how much return on assets that you have. These two determines the demand for money. All right. And also there is something called the demand for money as a behavior towards risk. The demand for money a lot of times is also depends on our risk taking ability. A lot of times this is given by Tobin. Even this was asked in the last year, in the previous years. Optimal structure is determined by the risk reward characteristics of different assets, the taste of individual in maximizing his utility consistent with existing opportunities. An individual would hold portion of his wealth in the form of money in portfolio because rate of return on holding money was more certain than the rate of return on holding interest earning assets, right? It is riskier to hold alternative assets service holding interest just money alone because government bonds and equities are subject to price volatility while money is not. So a lot of times it also depends on the risk taking ability of the individuals. All right. That's what the Friedman's statement of quantity theory says. You please go through it. Not so important, but the most important ones that you need to learn here is Keynesian theory of demand for money. All right. Keynesian theory of different demand for money. What are the different motives? Transaction motive, precautionary motive. Question can be asked. Explain the precautionary motive of demand for money. Explain the transaction motive of demand for money. This has been already asked. So prepare so well each of it. Okay. The Keynesian theory of demand for money is very, 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 very important. All right. So with that, we are closing the concept of demand for money. All right. Next, we have the concept of important supply. The concept of money supply. We spoke about demand till now. Let's talk about the concept of money supply. Who supply the money? So how much money should be supplied in the economy, right? Right. All right. Let us discuss now the concept of money supply. Unit 2 in chapter 3. We have studied about the concept of money demand. Similarly, we need to understand the concept of money supply. How much money should be circulated in the economy? What is the ideal money that should be circulated in the economy? And how do we measure the money supply in the economy? Right? So all those things we will be discussing in the unit 2, the concept of money supply. So let us quickly see the overview. The concept of money supply has 4 legs. The sources of money supply. How do we measure the money supply? What are the determinants of money supply? What determines the money supply? And the concept of money multiplier. Very, very, very important. The concept of money multiplier is very important. Questions are being asked from this area. All right. So let us understand first what is the meaning of the term money supply. What is the meaning of the term money supply? we discussed the meaning of money demand. What is the meaning of money demand? Demand for the money to hold in physical cash or in the savings bank accounts. That is the demand. All right. So out of the assets that we have, how much money we would want to hold with you readily available? That is money demand. Similarly, the money supply denotes total quantity of money available to the people in an economy. Look at this. Total quantity of money available to the people in an economy. All right. How much money is available to the people in an economy? Does that mean how much money that is printed and circulated in the economy? Say in India, isn't it so simple that RBI know the value of money that they have printed and how much money is in the circulation? So is it so simple, right? If we say the quantity of money available to the public in an economy, no, money gets multiplied a lot of times. So we need to see how much money got multiplied also. So let us see. The supply of money is a stock variable. It varies, right? It keeps varying. The stock of money always refers to stock of money available to the public as a means of payment and store of value. This is always smaller than the total stock of money that really exists in an economy. All right. So basically, the quantity of money available to the public is always smaller than what really exists in the economy. All right. So let us understand. The term public defined includes all economic units, households, firms, institutes. The government in this context includes central government and state governments. The banking system means Reserve Bank of India and all the banks that accept demand deposits. All of this total stock of money always refers to stock of money available to the public. Here, look at the word public. As a means of payment and a store of value. It's two. As a means of payment and store of value. Public includes all economic goods, households, firms, institutions, government, central and state governments. All right. What is the rationale for measuring money supply in an economy? What is the why we need to measure? It facilitates analysis of monetary developments in order to provide a deeper understanding of causes of money growth. It facilitates us how do we the money growth happens, that we can study if we know the quantity of money supply in the economy. Central banks all over the world adopt monetary policy. The next unit is monetary policy to stabilize price levels and GDP growth by directly controlling the supply of money. If you remember, the entire monetary policy revolves around this point. Second point, central banks all over the world, they adopt monetary policies. For example, increasing the interest rates, decreasing the interest rates, various benchmark rates like repo, reverse repo. Why they do that? To change the money supply in the economy. Just by changing the money available to the public, you can in fact work on the inflation levels. Suppose if people are having so much of money readily available with them, generally the inflation levels are high. To reduce that, government and central bank RBI take various actions and they take out money from the public in different ways. One of it is open market operations, if you remember, wherein money is collected by the RBI by issuing bonds, and they will take money which is available with the public and for bonds. So they issue bonds and they collect money. All right. By doing that, you can reduce the money supply in the economy. Same vice versa. Whenever there is a shortage, governments do? RBI, what RBI do? RBI redeem the bonds. When RBI redeem the bonds, people get money in their hands. All right. So that's how the money supply is worked on by the RBI. So this point is very important. Stabilization, the monetary policy revolves around the money supply. You know, how much money is available to the public. Success of monetary policy depends largely on the controllability of money supply and the monetary base. So these two, monetary base, we will discuss what is monetary base. So controlling the money supply, the success of RBI various monetary policies depends on the controllability of money supply. All right. Let us see the summary. This is summary notes. The sources of money supply, measurements of money supply, determinants, we discussed this. So, all right. Explain different sources of money supply in an economy. We all know. What is the money supply in an economy? Absolutely RBI in India. They are the one who print and issue, right? The decision of the central bank based on the authority that they have through the parliament. So monetary authority in whichever country, for example, in India, RBI, in US, Federal Reserve, right? And here you need to understand what are the different sources of money supply. Not just RBI, not just RBI. Even the banking system creates money supply in the economy. We will discuss how it happens also. The money that is with the bank is for rotating. The money will be given, banks take money and they borrow, they collect in the form of deposits and they lend money to the people. In this process of lending and borrowing, the money keeps on multiplying. We will have that with an example also. All right. Central bank is the primary source. High powered money issued by the monetary authorities is the source of all other forms of money. This is nothing but the printed currency. The currency issued by the central bank is called fiat money, also called high powered money, right? The currency issued by the central bank is in fact a liability of the central bank and the government, right? Government is issuing a value of currency, right? It is a liability. Corresponding to that, why governments are RBI? Obviously RBI is representative of government, though we speak they are independent. In the functioning they are independent, but RBI works in coordination with the government of India. All right. So it is a liability. Whenever RBI is printing money and distribute money to the people, they can't do, to make everyone rich. What if RBI print and give money to everybody? What happens? The value of money will fall, isn't it? We'll also become like some hyperinflated countries like Zimbabwe, where there is no value for the money. All right. So those things cannot be done. So what RBI can do, how RBI can issue, is only whenever RBI issues even a 10 rupees note, it is a liability to the RBI. It is a liability. In fact, it is a liability. Corresponding asset should be there with the RBI. Corresponding asset should be there. Corresponding asset should be there with the government RBI, both. So I consider the asset is with the government. So if something is printed, corresponding asset, some asset also should be with the government. All right. Therefore, it must be backed by an equal value of assets, mainly consisting of gold and forex reserves. What else will be the value? other than currency. So if RBI is printing 1,000 crore rupees, they should have either forex reserves or some precious metals like gold as an asset. Get it? But in practice, most of the countries have adopted for a minimum reserve system wherein central bank is empowered to issue currency to any extent by keeping a certain minimum reserve of gold and foreign securities. But this entirely like asset liability match is practically not possible sometimes. So now the banks, earlier they used to follow, now there are certain calculations wherein they cannot print beyond a certain value. Now most of the central banks are not following as is asset liability system, where they are printing, they're not having corresponding reserve, but they do maintain certain minimum reserves against the printed currencies. All right, that's how it works. The second major source of money supply is the banking system. As we studied, banks multiply the money through the lending and borrowing activity. The amount that they lend is 100, but they get back 110, right? And again they lend. So that's how they multiply the money. Banks create money supply in the process of borrowing and lending transactions. Money so created by the commercial bank is called credit money. Very important. The money created by the commercial banks is called credit money. The money issued by the central bank is called fiat money. Fiat money plus credit money is money supply. All right. So that's how you need to remember. Explain the different concepts of measurement of money supply in India. Similar to money demand, there are different ways money supply is measured, especially in the context of India. RBI has a policy from the beginning. RBI established in 1934. From 1935, RBI has been calculating the money supply in the economy. You will understand by looking at the formulas what exactly is the money supply. Let us see. M1. There are different ways that they do. Very important. Questions are asked like multiple times on these just simple 3 formulas. Okay. You need to have these 4 formulas in your fingertips. Like even in sleep, you should be able to tell. All right. Even in sleep, you should be in a position to tell. That's how you need to remember these 4 formulas. Very, 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 very important. I cannot tell you how much important. If any question is asked in this unit, question would directly come from these or about the 4th leg that we discussed, money multiplier. Either question comes from the money multiplier or from these 4 formulas. Please remember properly. So let us understand what is the money supply formulas. The RBI divided the money supply in the order of liquidity M1, M2, M3, M4. There are 4: M1, M2, M3, M4. So let us look at M1. What is M1? What is M1? Currency notes and coins with people. Just observe properly. Currency notes and coins with people plus demand deposits with the banking system is nothing but current and savings deposit accounts, which are readily available to withdraw. Whenever you want, you will be in a position to withdraw. Plus other deposits with the RBI. There are various deposits that are kept by banks with RBI, right? So those are available thing. So if you see this M1, 3 components are there: money printed, currency notes and coins with the people. You need to see, not the entire money. That is, if money, currency, printed money is with the RBI, we are not going to consider it. Here people is there, right? So currency and coins with the people plus demand deposits with the banking system plus other deposits with the RBI. That is M1. Next, M2 is equals to M1 plus savings deposits with post office savings banks. Earlier, this used to be a lot of relevance, but now it lost relevance. But yeah, still RBI has not changed the formulas. M2 is equals to M1 plus savings deposits with post office savings banks. All right. Earlier used to have so much of post office savings. All the rural and semi-urban people used to save only with the post office. Before the banking system, post offices were most accessible thing. So that's why it is important. The saving deposits with the post office. Next, M3. M3 is the most important thing. They generally ask M3. M3 gives the overall money supply. M3 is equals to M1 plus net time deposits of banks. It's nothing but fixed deposits with the banks. All right. Then M4 is equals to M3 plus total deposits with post office savings. Total deposits with post office savings, excluding national savings certificates. The national savings certificates are kind of bonds, so that is why it is not considered. They're not in the form of liquid. All right. So M1, M2, M3, M4, very important. You need to have this in your fingertips. Just a correction. Here I wrote M2. It has to be M1. It has to be M1. M1. My bad. There's a very big mistake that from my part. All right. So I didn't change because it was there in original notes. It has to be M1 plus net time deposits. All right. So this is how the money supply is measured. These four formulas. Okay. New monetary aggregates also came up with RBI, but these are all almost similar. So you read NM1, NM2, NM3. It's almost similar, but you're not going to get too much questions from here. Generally, M1, M2, M3s are asked. So you don't need to worry about it. Next, what is reserve money? Reserve money is also known as central bank money, base money, or high powered money, which determines the level of liquidity and the price level in an economy. Basically, money issued by the central bank. All right. M1, M2, M3, M4. New monetary aggregates and M1 and M2 and M3. I'm not going to spend much time. It's not so important. So I'm not spending. It's similar to M1, M2, M3. So just have a look at it. Okay. So what are the determinants of money supply in the next leg that we have? What are the determinants of money supply? So there are two alternative theories in determinants of money supply. According to first view, money supply is determined exclusively by the central bank. So basically, money supply is determined by the central bank. So who determines how much money is required to be there in the economy? One is how much money central bank puts in. That's what revolves around is one theory. Second view is holds that money supply is determined endogenously by changes in economic activities which affect people's desire to hold currency relative to deposits rate of interest. A lot of times it depends on the people desire to hold currency, how much they wanted to hold. Based on that also the money supply determines. So the approach to determine the money supply is called money multiplier approach. We'll understand now what is concept of money multiplier. This is also very important. Very important. Money supply. How money supply is determined? M into MB. Here small m stands for money multiplier. We'll understand what is money multiplier. I already explained to you once, but yeah, I'll explain it to you again. MB is nothing but monetary base. It is nothing but how much money. Monetary base, we just had a discussion. What is reserve money? Reserve money is the money that is printed by the RBI. So the monetary base, the original money that is there with the public, which is in the printed form. So money multiplier is equals to money supply. It is simple. The formula money supply M divided by MB, monetary base. So money multiplier is equals to capital M by MB. M stands for money supply. What is the difference between money supply and monetary base? I already told you money supply is not actually what is printed. Money supply consists of also credit money. You remember? Banks multiply the money, right? And the actual money that we have also gets multiplied. But banks take major proportion in multiplying money. So if we have 100 rupees, banks must be doing say 1000 rupees of business, because same money gets rotated with 10 people, right? Someone, you know, bank give as a lending and someone comes and deposit, and then bank again give lending to someone else. The same money gets rotated, right? So through that way, money gets multiplied in the banking system. That is called credit money. We discussed earlier, credit money. So you need to remember the difference between credit money and fiat money. Currency issued by the central bank is fiat money. The money created by the commercial banks is credit money. Credit money is not actually printed. If you go and ask bank to, give all money that we all have deposited, banks will not have it, right? Because there is no such huge requirement for all of us. So the money gets multiplied. Most of the times bank will not have how much ever that we have in the form of deposits. They will not be having in their cash holds all that money, right? So money gets multiplied. So the formula that you need to remember here is capital M, money supply is equals to money multiplier. How many times it gets multiplied? The monetary base is the money that is issued by the Reserve Bank. How many times that gets multiplied? Suppose 8. Say 1 lakh crore is issued. 1 lakh crore is issued by the central bank to the public, in circulation. That is monetary base. That gets multiplied 8 times in the system. We will understand how this money multiplier is important. So if we say 8 times, 8 lakh crores is the money supply in the economy. 8 lakh crores is the money supply in the economy. But originally printed currency is only 1 lakh crores. You get it? So simple understanding, there is no complexity here. All right. So this is the money multiplier approach. This is, let us understand, how, what all are considered in the money multiplier. It considers 3 factors as the immediate determinants of money supply in the money multiplier approach. One is stock of high powered money, that is monetary base. Next, ratio of reserves to deposits, how much people are keeping it and how much they are depositing it. Ratio of currency to deposits. Ratio of currency to deposits. All of these factors determine the money supply in the economy. Get it? This you remember, very important. The formulas are very important in this unit. All right. I will explain these 3. So here, 3 factors determine the money supply. Here, even here you can see, one is money multiplier, and there are various factors determine the money multiplier impact, and monetary base. So monetary base, we all know who decides this. Monetary base is generally decided by the RBI. So here, the behavior of central bank matters. So the behavior of central bank matters. Different countries treat differently. So the stock of high powered money, how much stock of printed currency should be there, is decided by whom? RBI, right? So this is behavior of RBI that determines ratio of reserves to deposits. So how much reserves to be kept and how much should be lended, how much should we do that is all decided by whom? This is decided by commercial banks. All banks, they take how much money they should lend. Banks cannot lend entire money that they have, right? So similarly, we need to understand this is depends on the ratio would depends on based on the behavior of commercial banks. It all depends on a lot of times the decisions of these people determines the money supply. So the behavior of commercial banks. What about this ratio of currency to deposits? This currency to deposits, how much money people keep with them and how much they deposit with the bank. This is determined by the behavior of public. How public behavior is that? This I can give you an example. The ratio of currency to deposits. For example, I have say 1 lakh money. Depends on my financial knowledge, depends on my risk appetite, depends on my requirement. I will decide how much money that I should keep in my current account and how much money I should deposit in the form of fixed deposit or whatever. So this depends on the behavior of individual, that is behavior of public. This depends on the behavior of commercial banks. This depends on the behavior of RBI. The stock of high powered money, how much should be there is determined by the RBI. So money stock is determined by the money multiplier and monetary base. It is controlled by the monetary authority, that is RBI. So you please go through it. It is easy. Next, behavior of commercial banks. Why behavior of commercial banks is so important in determining the money supply? Behavior of commercial banks in the economy is reflected in the ratio of their cash reserves to deposits, known as reserve ratio. How much they keep as a reserve out of money that they received from public. Suppose from the public, they collected, assume 100 rupees, how much they wanted to keep as a reserve, say 20 rupees. 10 RBI asked to keep as a reserve, 10 they keep buffer, and 80 only they will lend, right? So how they would decide is depends on the bank. So the behavior of commercial banks matters in determining the money supply, and the behavior of public also matters, because the public, by their decisions in respect of amount of nominal currency in hand, how much they wish to hold it as a cash in position to influence amount of nominal demand deposits. So all these three factors determine the money supply. So if you see the one which we discussed, determinants of money supply. So who all determine? Commercial banks determine. First RBI determine, and even the public determine how much money. What are the, who are the determinants? Commercial, RBI, that means central bank in any country, and the behavior of commercial banks and behavior of public. These three determine money supply. If someone asks you, you must say these three determinants are these three. Of course, these three are the market participants in the money, right? So certainly they are the ones who decide how much money should be there in the economy, right? The concept of money multiplier also we briefly discussed in this discussion. So I hope you got it. So credit multiplier also I explained how much money that banks multiply through this credit system by lending and borrowing, how this gets multiplied. I gave you with a nice example in class, but in the interest of time, I will not be able to cover. But remember this formula. Credit multiplier depends on how much reserve that banks do maintain. So 1 by required reserve ratio. Suppose banks are required to maintain 10%. Suppose banks are required to maintain 10% as reserve and they should not lend it. Okay. So how many times that credit multiplies is 1 by 10. It is 10%. Sorry, 10 times. Credit multiplier is 10 times. Suppose for 1 lakh rupees that gets multiplied in the banking system to 10 lakhs. All right. That is called credit multiplier. This formula is also very important. So credit multiplier tells us how much new money will be created by the banking system for a given increase in the high powered money. High powered money is issued by the whom? RBI. It reflects banks' ability to increase money supply. So how the banks will have ability? If the people have good banking habits and the required reserve ratios are less, generally the credit multipliers are high. Suppose countries like US, or some of the European countries, they have good banking habits. So the credit multiplier and the money multiplier both are very high. Suppose 1 lakh rupees, 1 lakh crores is in the banking system. It means in the actual money supply would be more than 15 lakh crores, 20 lakh crores. You get it? So in India, we don't have, because we have a lot of under the table transactions and unaccounted transactions. So our credit multiplier is not much. And so much of people who are not having still access to the banking system, they deal directly in the cash. So you get it? So that's why banking habits of people is very, very important. That determines how much money is available to the public. Though it is 1 lakh crores, but in terms of availability, it could be 10 lakh crores if we have good banking habits. Get it? So you go through this example, I'm sure you will understand. If I pick this example, it will take almost half an hour to 1 hour to explain this example alone, how the money gets multiplied. You just read this example, I'm sure you're going to get it. Okay. So, yep. Deposit multiplier, credit multiplier, both are same. Deposit multiplier, credit multiplier. It is also called deposit multiplier. The deposit multiplier and money multiplier, though they are closely related, but they're not same. Generally, banks do not lend out all their. Why it is different is, generally banks do not lend all money that they have, right? So the deposit multiplier is different, and generally banks do not lend all money that they have, but instead they maintain certain reserves above the minimum required level. If RBI asks for 10% reserves, say in the form of CRR, SLR, they maintain additionally some, say 10% or 12%. So they will only be able to lend another 18%. Similarly, the borrowers, whatever the money they got, they don't entirely spend. They'll keep another 5-10% and then they spend. That's why you'll have difference in the credit multiplier and the money multiplier. All right. Next is we have chapter 3, unit 3, monetary policy. Monetary policy. Very important. Monetary policy, we speak specifically in the context of RBI here. Every central bank, along with the government, they do have certain policy with respect to money supply, the flow of money in the economy. If there is excess supply in the money supply in the economy, it will lead to a lot of problem. If there is shortage of money supply in the economy, there will be a different set of problems. If there is a excess money supply in the economy, what are the problems? With your specific generic knowledge by now, you should be knowing if there is excess money supply in the economy, what happens? There will be high levels of inflation in the economy. If money supply is excess in the economy, there will be high levels of inflation. So there will be a big divide between rich and poor. So poor will not be able to afford anything. So that is very dangerous. On the other side, what is the problem if there is a shortage of money supply in the economy? It is a typical case of COVID times. What is the problem with the shortage of money supply? There will not be growth. If there is no money for investment and creating new opportunities, how the country will grow? How people will get employment opportunities? All of these matters, right? So if there is a shortage of money supply, growth issues will be there. If there is excess money supply, higher levels of inflation issues will be there. So there has to be a right balance, right? So the monetary supply, the monetary policy revolves around making policies with respect to the money supply. Okay. So we have monetary policy, which is with the control of RBI in coordination with the government. So monetary policy, how the monetary policy committee is there, we're going to discuss what is a monetary policy framework and how the organizational structure for monetary policy decisions is there. Okay. So we're going to discuss that. We'll understand first what are the objectives of monetary policy. Next, what are the different analytics that are applied in the monetary policy and operating procedures and the transmission mechanisms. All right. So organizational structure, we know who all are consists of monetary policy committee, which is a decision making body. What is a monetary policy framework agreement? This agreement is with whom? RBI and government. We'll discuss the organizational structure, that is a separate thing, and what is a monetary policy framework we'll discuss. So what is monetary policy? Right. Let us understand the meaning of monetary policy. What is monetary policy? I gave you in layman's understanding, but let us see the monetary policy definition that is given in the book. So for whom this monetary policy is framed is something that we need to understand. This is for banks and the RBI. RBI and the government. I'm extremely sorry. RBI and the government. So they need to have a complete control, regulation on the money supply in the economy. If there is no government or central bank, suppose anywhere, are not able to control the money supply, means that country has gone bankrupt. In simple terms, that country has gone bankrupt. The classic example is Sri Lanka that we are seeing nowadays, right? So where they're not able to pay their debts, first thing. Second, there is a huge inflation that is there in the country. Why? These all are typical monetary policy failures. Monetary policy failures of the government and the central bank. So let us understand with that in your mind, with that example of Sri Lanka in your mind, let us understand the definition of monetary policy. Monetary policy refers to the use of monetary policy instruments. So we should know what are the monetary policy instruments. We'll discuss those later, which are at the disposal of the central bank, which are at the disposal of the central bank. It means which are readily available at the central bank to regulate what? To regulate what? The availability, cost, and use of money and credit. Availability, cost, and use of what? Money and credit to promote obviously what is the objective of government? To promote economic growth, price stability, optimum levels of output is nothing but GDP, and employment, balance of payments. Balance of payments are forex, inflows and outflows, balance of payments equilibrium, stable currency, or any other goal of government's economic policy. In simple terms, monetary policies aims to serve the economic goals of the government. So what are those economic goals of the government? All of these, in fact. Regulate the availability, cost, and use of money and credit money. These four: regulating availability, cost, use of money, normal money as well as credit money, to promote what? Economic growth, price stability, optimum levels of output, employment. You can write whatever the objectives, economic objectives of government. balance of payments, stable currency. Six most important. What are those? One, you need to remember these. You need to remember these. Promote economic growth, price stability, optimum levels of output, employment, balance of payments, stable currency. Six, right? And any other goals of the any other economic goals of the government. So these are the ways to achieve these objectives. The use of monetary policy instruments with the central bank. So what are these monetary policy instruments? So different instruments are with the RBI, central bank. We'll discuss those. So what are the objectives of monetary policy? We briefly covered here also. Price stability. Any government in this world, they have these objectives: price stability, growth, ensuring adequate flow of credit, creation of efficient market for government securities. This is also important. Creation of efficient market for government securities. These are the objectives of monetary policy. You need to remember this. Even this is also important. What are the objectives of monetary policy? All right. And next we have, what are the different analytics of monetary policy? It means what are the different, I would say, different channels through which RBI works on the monetary policy. Different channels that RBI has. One, and the most important, interest rate channel. How this works, I'll explain it to you. RBI has certain control over, or say a lot of control over banks, how much money that they can lend, what are the rules of reserve requirements, how much money banks should keep with the RBI, CRR, cash reserve ratio, statutory liquidity ratio, all of those, right? So the changing in the cash reserve ratio, statutory liquidity ratio requirements changes the interest rates in the economy. Obviously, it changes money supply in the economy, and the interest rates also do vary, right? And one channel is interest rate channel. The monetary policy, decisions are transmitted through these channels. Next, exchange rate channel. Exchange rate channels also works. How much exchange rate? One rupee is how many dollars? $1 is how many rupees? This also determines the monetary policy decisions. Next, asset price channels. How much the asset is priced? Even this determines monetary policy channels. If there is a high inflation, what happens? The money flow changes. Next, quantum channels. How much of money, quantity of money is available? Changing the quantity of money directly, right? These are called monetary policy transmission mechanisms. These four: interest rate channel, asset price channel, exchange rate channel, quantum channel. These are monetary policy, monetary transmission mechanisms. Transmission means, electricity transmission. So electricity first comes from the main grid, comes to the, from the central grid to the local power stations to individual houses, or say factories, right? So similarly, the transmission happens, the decisions of RBI, the results or the actions taken by the RBI, the effects of it transmits through these four channels. You get it? The classic example that I gave of electricity. So from RBI, it flows to banks. From banks, it flows to individuals. The effects of the decisions taken by the RBI, those are called monetary transmission mechanisms. The process are channels through which change of money aggregates are nothing but money supply and demand, affects the level of product and prices, is known as monetary transmission mechanisms. Therefore, as we discussed, interest rate channel, exchange rate channel, quantum channel, quantum of money available, basically money supply and credit, asset price channel, equity and real estate prices. These are, so these determines how the money supply transmits. How interest rate channel works, let's go with an example. You remember we discussed about the expansionary monetary policy. What is the expansionary monetary policy? Whenever there is economy is in slowdown, generally governments take up expansionary policy, expansionary fiscal policy, we discussed in the unit 2. Similarly, expansionary monetary policy, it means expanding the money supply. To make it, what RBI do, they need to decrease the interest rates. By decreasing the interest rates, availability of the money increases. To make it, you need to reduce the interest rates. So basically the cost of capital will reduce, as well as for cost of borrowing for households will reduce. Whenever there is slowdown in the economy, RBI approach expansionary monetary policy. Expansionary monetary policy, one of the ways it can be done is reducing the interest rates. Reducing the interest rates will ensure the availability of money supply for the public, and that is in fact increases the consumption in the economy, right? So the interest rates increasing, decreasing is one of the way through which monetary policy decisions or money aggregates are changed, right? Money supply is changed. That is about interest rate. Next, we have exchange rate channel. The exchange rate channel works through expenditure switching between domestic and foreign goods. So decisions taking related to appreciation of domestic currency makes domestically produced goods more expensive compared to the foreign produced goods, right? So appreciation in our currency will make what will happen? The imports will become expensive, due to which the um, sorry, when there is an appreciation in the currency, the local goods will become bit expensive and compared to foreign goods. Whereas when there is a depreciation in the foreign currency, what happens? The exports will become cheaper, imports will become, foreign goods will become, imports will become expensive, right? So due to this, so when there is an appreciation in the domestic currency, when the appreciation is there, when there is an appreciation in the domestic currency, the foreign goods will become cheap. It's simple. When there is a depreciation in the thumb rule, when there is a depreciation in the foreign currency, exports will become cheaper, imports will become expensive. When there is depreciation, when there is appreciation, when there is appreciation, exports will become expensive, imports will become cheaper, foreign goods will become cheaper. That's what it told. Appreciation of domestic currency makes domestically produced goods more expensive compared to foreign goods. What this makes exports to fall. Correspondingly, domestic output and employment also fall. So through these channels, exchange rates affect, the monetary policy mechanisms gets transmitted. Similarly, by making availability of credit to firms and households, the quantum of money availability, the money supply can be changed. The asset price channel, even the prices of equity and real estate prices, even these determines the money supply, right? What are the operating procedures and instruments? As I just go, this is more important in this unit. What are the different instruments that are available with the RBI? Briefly, I'll cover the most important ones. One is cash reserve ratio. Very important. It was asked in the recent exams. What is cash reserve ratio? So basically, cash reserve ratio is the fraction of total net demand and time liabilities of banks, which needs to be maintained with RBI as a cash deposit. That is cash reserve ratio. Say, for example, bank have collected 1 lakh crores of deposits, right? 1 lakh crores of deposits. In that, 50 crores is savings accounts and current accounts, 50,000 crores, and 50,000 crores is time liabilities. It means fixed deposits. So 1 lakh crore, on this 1 lakh crore, RBI asks banks to deposit, say 4%. It means how much? 4,000 crores. Banks in the hard cash, they need to deposit 4,000 crores with RBI. It has to be directly transferred to RBI. RBI is not going to pay any kind of interest on it. So that is called cash reserve ratio. By doing this, RBI is cutting the money supply, right? This requirement applies uniformly to all scheduled banks, irrespective of size. You need to understand the difference of this. Higher the cash reserve ratio requirement with RBI, what happens? Money liquidity in the system will be less. If RBI asks banks to deposit more, the liquidity in the system will be less, right? If RBI reduces the CRR rate, the liquidity in the system will increase. You get it? So that's how you need to understand how the increase in CRR affects the liquidity in the system. Liquidity means availability of money, money supply. All right. So that's about CRR. In fact, all the students must and should, they have to understand these 7, 1, 2, 3, and 1, 2, 3, 4. These 7 different monetary policy instruments you should have in your fingertips, right? Cash reserve ratio, statutory liquidity ratio, right? And repo, reverse repo, open market operations, standing facilities, all of these you should have in your fingertips. Very, very important. Whatever I highlighted in yellow have asked in the previous year. In 1 year, they asked cash reserve ratio. Another year, they asked statutory liquidity ratio. Another year, they asked liquidity adjustment facility. Another year, they asked repo rates. Reverse repo, they asked. Marginal standing facility, they asked. Market stabilization scheme also, they asked. See, open market operations, they asked. In fact, every point has been asked in the previous year examination. This is a very, very, very favorite area for the examiner because this fits into the exam requirement of 2 marks, 3 marks. So that's why most of the questions in this unit are picked from here. What are the different monetary policy instruments that are available with RBI? In that, cash reserve ratio, statutory liquidity ratio, right? Liquidity adjustment facility, all these very, 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 very important. I have highlighted in yellow means they were asked in the exam. I spoke about cash reserve ratio. We discussed cash reserve ratio. Let us see statutory liquidity ratio. This is also similar to cash reserve ratio, but here they need not deposit the original cash, but banks are required to maintain certain portion, say 16%. 16% of their net total demand and time liabilities, cash, mix of any of these, cash, gold, investments in government securities. These all can be clubbed as government securities. You can detail in detail. You can study in detail. So they have to maintain Like if they say banks receive 1 lakh crores, they cannot lend, say, cash reserve ratio, but they cannot lend entirely to the public. What they need to do, they need to invest certain portion, say 12%. They should keep in these highly liquid assets. They should keep in these highly liquid assets. What are those? Cash, gold, investments in government securities. Here they given state development loans, central government treasury bills, all of it. Okay, any of these. Okay, similar to CRR, the movement of SLR also impacts the liquidity in the system. Higher the SLR, statutory liquidity ratio, lower the availability of credit, or say lower the liquidity. RBI plays with these. They maneuver these CRR, SLR, depends on the economic situation. All right. Next, let us understand the term liquidity adjustment facility. What is liquidity adjustment facility? See, banks also need money time to time. Sometimes they might not have. For short-term liquidity requirements, as a business also we do face short-term liquidity problems, right? Similar to that, liquidity adjustment facility is also provided by the central bank to all the commercial banks. Why? Banks also need some money. So for that, the bankers bank is RBI. So RBI give them certain money as an adjustment facility for a temporary purpose. How? This is for overnight with collateral of government securities. For example, as part of SLR, they bought certain government securities. RBI says it's fine for overnight. You can give me those. You can give those bonds as collateral and take money from me. That is called liquidity adjustment facility, right? That is called liquidity adjustment facility. As part of this liquidity adjustment facility, RBI charge certain interest on the loan that they have given, short-term loan, right? Short-term, loan. So the rate that RBI charge is called repo rate. Repo stands for repurchase option. Repurchase option. It means when you have money, I'll give you money now. Whenever you have money, just pay me back and I will give these government securities back to you. So you are repurchasing the government securities back. That is called repo. The rate that RBI charge to the commercial bank is called repo rate, repurchase options rate. Sometimes RBI need money. Whenever there is excess liquidity in the banking system, RBI take loan from banks. That is called reverse repo. The interest rate for reverse repo is generally, because boss is boss, RBI takes less, RBI pay less interest, say 4%. That is reverse repo rate, but repo rate is generally 2% higher, say 6%. Okay, so generally reverse repo rate is less than repo rate. Reverse repo rate is the rate at which banks lend money to RBI. Yes, banks lend money to RBI. That is reverse repo. Even for this, RBI give government bonds, government securities as collateral. So that's called reverse repo, repurchase option. Next, we have, in the order of liquidity, marginal standing facility. What is this? Marginal standing facility. So after exhausting everything that is available, banks sometimes exhaust even this liquidity adjustment facility. So after that, still RBI give certain facility to the banks. That is called marginal standing facility. So under this marginal standing facility, RBI can borrow, commercial banks can borrow additional amount overnight from central bank. But certainly this is not at normal repo rate. This rate is generally higher than the repo rate. So by dipping their statutory liquidity ratio to an extent, they can take certain short-term money for liquidity adjustments. That is called marginal standing facility. For this, RBI generally charge higher interest rate. That is called marginal standing facility. And next question, what is market stabilization scheme? Market stabilization scheme is done through an MOU between RBI and the government. What they do, under this, Government of India borrows money from RBI and issues treasury bills. Government of India, what they do? They borrow money from RBI. They borrow money from, as I said, RBI and Government of India are independent, though they are, work with a common objective, but they are two independent organizations. All right. Sometimes government borrow money whenever there is a liquidity, high liquidity, they issue bonds and they take money, absorbing excess liquidity from the market. All right. So then we have open market stabilization. Sorry, open market operations. In the open market operations, RBI go directly to the public and they take bonds. They issue bonds and they redeem bonds whenever there is liquidity issues in the economy. Suppose there is excess liquidity in the economy. What RBI do? RBI issues government bonds and they collect money from the public so that the liquidity in the economy is managed, balanced. All right. So those are called open market operations. Cool. Next, we need to talk about monetary policy framework. As we are speaking so much in detail as I wanted to cover, because this is very important unit also. So we have monetary policy committee. So who takes the decisions of this monetary policy, increasing the reserve, say statutory liquidity ratio, increasing the CRR or decreasing the CRR, increasing the marginal standing facility? All these decisions are taken by monetary policy committee. How the monetary policy committee works? Monetary policy committee consists of 6 members, out of which they determine the policy rate to achieve inflation target through debate and majority vote. So basically, monetary policy objective is to ensure inflation target is in control. Monetary policy framework agreement is an agreement reached between Government of India and RBI on the maximum tolerable inflation rate of 4% of consumer CPI. So it with 2% plus or minus, it means inflation can go 6% maximum in a year. 6% plus or 6% minus. All right. So choice of monetary policy action is rather complicated in view of the surrounding uncertainties and the need for exercising complex judgment. Definitely the decisions of monetary policy is very complex. The 6-member committee acts on it. Okay. So read this. This is self-explanatory. I'm not spending much of time on the role and structure as there's not much of concept involved. So please read in the interest of time. With this, we are through with chapter number 3, unit 3. So let us quickly summarize what we have studied in the chapter number 3. First is money demand, money supply, and monetary policy. Monetary policy related to different monetary policy instruments. All the monetary policy instruments are important. Let us quickly name all those. Cash reserve ratio, statutory liquidity ratio, repo, reverse repo, open market operations, marginal standing facility, right? Market stabilization scheme, all of these. Very important, all of those 6, 7 that are listed, you need to be master in those. Question is gonna come from there. All right. So with this, we are done with chapter number 3. All right. Fine. Hello, students. Welcome. We are going to cover the first chapter, that is determination of national income. I have purposefully kept this chapter for the end, as I believe the understanding of public finance, money market, international trade would give you much more, help in understanding the chapter 1. So my preference for this is the last chapter. So ideally, if you are studying, you must study public finance first, international trade, money market, or in this flow, and then you can come to this. So that your understanding would be better. Okay. So national income chapter has 2 units. One is national income accounting, and second is Keynesian theory of determination of national income. Overall, if we see the weightage of this chapter, most of the times problems questions are asked. I have compiled the previous year questions chapter wise. In that, if we'll just have a quick look, how many marks this chapter is being asked. 2 plus 5, 7, 7 plus 3, 10 marks. Minimum 10 marks questions are being asked from this. So 10 marks. Out of that, generally standard one question is asked as problem solving question, wherein you will just have to apply application question. This is with your existing knowledge, you need to apply a formula or whatever, and you need to arrive the answer for it. For example, here examiner asked calculate the national income using income and expenditure method. So if you know what is the formula for income method, national income under income method, and national income and expenditure method, then you will be able to answer this. So for this, you need to have a complete idea of what is income method, what is expenditure method, what if there is any other method. So we are going to discuss quickly national income in the first chapter, determination of national income. First unit is national income accounting. All right. National income accounting. In that, we will understand first different concepts of national income and how do we measure national income in India, and what are the limitations and challenges in computation of national income. All right. So, why we need to talk about national income? First question. Why we need to talk much about national income? So we hear a lot in news. GDP, India's GDP, world's GDP. India's GDP has grown compared to previous year by say 4%, 6%. You hear news. What is the use of this? Right? Why we need to calculate? We need to have that basic question, right? See, the performance of any economy, be it growth or slowdown, it all depends on the output of goods and services produced by it. So it means people should work and produce, right? Based on that, the performance of economy is determined. Similar to our normal accounting, which measures performance of business, there are various principles of measuring and analyzing performance of national income. Similar to accounting, for a company, we do a normal accounting. Similar to that, for a say for a country, we need to do a national income. So who's owning is not, no one is owning, not the government who is owning the everything, but we need to account. In fact, we need to understand which sector is doing well, which sector is not doing well, which sectors are having higher growth rate, which sector needs some push from the government. All of this, how you will know? Unless the government do the accounting for the national income. So this is a basic idea that we need to have, that every government, every country should have accounting for national income. So when we are doing accounting for national income, certainly there will be principles, right? Just like our accounting standards for business. Similarly, for national income calculation, there are various principles, formulas that are there. All right. So understanding those principles, formulas are very important to calculate the national income. All right. Right. What is the significance of national income? Why do we need to calculate and keep it handy? Why the governments needs to keep this? One, it is an indicator of development. I'll just briefly cover it because these are all self-explanatory. Indicator of development, forecast future demand, basis for economic welfare, right? This is a basis for your economic welfare, how the economy is moving, and source for governments in fixing development targets, how the governments will be able to fix the development targets, like which sector to cover, which area to cover, how you will know unless you measure the progress of amount of goods and service produced in the particular industry or a particular place, how you would know, right? So for the economists and for the policy makers in the government, national income estimates are very, 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 very important, right? With that base, let us understand what is the concept of national income. What is the national income? Briefly, what is national income is the question. There are so many jargons used, but you're going to get meanings for all of this. First, net value of net all economic goods and services produced within the domestic territory of a country in a given accounting year plus net factor income from abroad, right? So basically, it is a formula that you need to arrive. How you will arrive, we will understand. We will start with the known word called GDP, and then we will arrive national income. There is a flow how you will arrive. That's when you will understand the meanings for net value, economic goods and services, domestic territory of a country. In accounting year is simple. You don't need to know the meaning for it. Plus net factor income. What is net factor income? You need to know what is net value, what is economic goods, what is domestic territory. You need to understand meaning for these 5 highlighted words. You know accounting here, but yeah, these 4 highlighted words, you need to know the meaning. How you will arrive the national income. Let us understand first the different concepts of national income. Park this wordings aside. You will understand meanings for all of these at the end when you arrive, right? When you arrive this meaning. Okay. So to arrive this, you need to understand certain basics like GDP, GNP, NNP, NDP. If you understand this, what you arrive at NNP at factor cost is going to be your national income. NNP at factor cost is going to be national income. That is here. NNP at factor cost is going to be your national income. Okay. Let us understand some of the keywords. Gross domestic product. Very important. What is gross domestic product? What is GDP? What is GDP? Just read all the highlighted words. It is a measure of market price, market value of for all final economic goods and services, gross of depreciation produced within the domestic territory of a country during a given time period. is a measure of market value of all final economic goods and services, gross of depreciation produced within the domestic territory of a country during a given time period. Basically, it is just addition of all the companies, right? All the individuals, their economic goods means something that they sell. So who sell? Basically the sole proprietary firms, partnership firms, private limited companies, public companies, all of these, right? So the product or the service that they sell to various people, right, at the gross level, right, without deducting the depreciation, is what called GDP. Here, the term gross implies it is measured gross of depreciation. Domestic means domestic territory. Territory means within the country limits. GDP excludes transfer payments, financial transactions, and non-reported output. What are transfer payments? Government transferring money to poor people into their accounts. Those are transfer payments. For example, someone working abroad, and he sends some money to their parents. These are transfer payments. These payments are not received against product or services done by the parents. I mean, technically. So these all out of love and affection. These are called transfer payments. Those things are not considered in the GDP calculation. All right. So that's called GDP. So I am covering here GDP. Though it is not explained here, I am telling you this is a base word. You need to know this base word, GDP. GDP at market prices. That's what we studied now. Gross of depreciation. All right. Let us understand next GNP at market prices. Here we have domestic, here we have national. So you must be guessing what is the difference between domestic product and national product. See, in the gross domestic product, we don't care whoever is producing within the domestic territory, whether he is Indian or foreigner. Even if a foreign company is doing production here, doing services here, we will consider that as part of GDP. Whereas in GNP, gross national product, here the product of all the nationals we need to consider. So what we are going to do in the gross national product, GDP plus net factor income from abroad. What is this net factor income? What is this net factor income? See, you need to understand each and every word. If you understand, if the problem question comes from this area, you will be able to answer in 3 to 4 minutes. You're going to save a lot of time. Generally, a question is asked for 5 marks. If you write, because it is a simple plus or minus formula. If you do it, you write formula and put the numbers and arrive the final number. That's it. You're going to get 4 or 5 marks. It's such an important, concept, and it is very important for you even in the real life. So understand and get the juice out of it completely and beat the basics. Understand it. If you're not understanding, read it, reread it. There are various sources that you can understand, with the current set of resources that you guys have. If you're not able to understand from one, in case if you're not able to understand what I told, you must refer to something and get a clarity of it. So the clarity is going to remain for a long. If you read without the clarity of the concept, you're not going to retain your memory for a long time. right? So clarity, having the clarity of thought, clarity of understanding the concept is very important. Coming back, net factor income from abroad. What is net factor income? Basically, here in GDP, we have gross product and service produced by the foreigners, right? And for GNP, we need our nationals, say some of the employees of Infosys gone to US and they're working there. Okay, they're our nationals. So the gross value of economic value of products and services produced by our nationals in US is going to be added to the GDP to arrive GNP, and foreigners production in India will be deducted, right? So foreigner production in India will be deducted. So net factor income is nothing but value of goods and services produced by Indian nationals abroad is added, plus minus value of goods and services produced by foreign nationals. So the net of it is net factor income from abroad. All right. So that is how you need to understand. So when you add that to GDP, automatically the net of it is going to come. Net product of our nationals, Indian nationals will come. So if we add to GDP, the net factor income is going to be gross national product at market prices. All right. I hope you understood what is GDP first and then net factor income. Let me write here. Probably I don't have pen to write. Net factor income is value of goods and services produced by the Indian nationals abroad minus value of foreigners goods, value of goods services produced by foreigners in India. All right. The net of it is net factor income from abroad. Okay. So if we add that to GDP, we're going to get GNP. Next, we understood GNP at market prices, right? Then what we need to understand, let us understand first at market prices. Okay. Then we'll understand what is this factor cost. Net national product. What is net national product? We have here GNP minus depreciation. GNP minus depreciation is going to be net national. Net, wherever you have net, is net of depreciation. The word per se net stands for net of depreciation. All right. So NNP, GNP, gross national product, minus depreciation is net national product. All right. Net national product can be arrived through NDP plus net factor income. So net domestic product that we have is basically GDP minus depreciation is going to be NDP. So understand these formulas, and I'm sure is not a rocket science. These are basic formulas, much easier than your financial reporting and other formulas. You work on it, and I'm sure you will be able to get it. I have listed here all of those formulas. Please read it and understand it. Okay, I explained you the basics. Okay, and next let us come to factor cost. What is factor cost? We are talking here GNP at factor cost, NNP at factor cost, GDP at factor cost. What is this factor cost? At the end, I hope you got it. At the end, NNP at factor cost is the national income. Okay, so now let us understand what is this factor cost. Everywhere factor cost. We know GDP, we know NNP, we know GNP. What is factor cost? There is a formula for it. We are considering only market prices at market prices, but originally there is indirect taxes, right? A lot of times the products that are sold inclusive of GST and other taxes, net indirect taxes. So we need to reduce the indirect taxes. Next, a lot of times governments give subsidies to various people, for example, in the agriculture sector, if we see, there is so much of subsidy that government gives. If we, if the market value is considered, most of the times the subsidy offered by the government is not reflected in the market price, right? So that is why you add subsidy to the market price. So by doing so, you will get the factor cost. Factor cost is nothing but factors of production cost, right? So the market price minus indirect taxes plus subsidies is going to be market prices minus indirect taxes plus subsidies is going to be the factor cost. So we have here, when we spoke about GDP, gross value of domestic products, final value of economic goods and services produced within the domestic territory we spoke. So final value of economic goods, we need to reduce that value with indirect taxes and add if any subsidies are given. Then you will arrive the factor cost. I hope you got it. Read it, you are going to get it. So if you are going to come to GDP at factor cost, you will just minus indirect tax plus subsidies. Suppose in the net domestic product at factor cost, this is NDP, net domestic product at factor cost is NDP minus indirect taxes, right? Plus subsidies. So that's how you're going to get NNP at factor cost is going to be this. So let us see what is NNP at factor cost. NNP at factor cost is national income, is defined as factor income accruing to normal residents of a country during a year. It is sum of domestic factor income and net factor income from abroad, right? So whatever that you have, NNP at factor cost is national income. Now let us come back to the meaning of the word national income. Net value of means reducing after depreciation. All final value of economic goods, it means no charity, no love and affection, works that we have done is consider only the amounts that are sold, right? Those produced within the domestic territory of a country in an accounting year plus net factor income is going to be your national income. Right. With those basics, I'm going to cover few other. See, these you study on your own. Per capita is income is nothing. Whatever that national income is there divided by number of people, you're going to get per capita income. Personal income is amount that each individual on net of is personal income, right? So disposable income is income available for the consumption or savings. Personal income minus taxes is going to be disposable income. All right. So go through that. Next important one is how do we measure the national income? So with these formulas with this understanding, now we need to understand how the national income is measured. It is a very complex thing. For a simple company, we take so many days, so much of effort, so many accountants, so many auditors work to arrive profit or loss, or preparing the financial statements, balance sheet, P&L. If for a simple company we put so many efforts, imagine for a country how much of efforts needs to be put in for arriving the national income, because no one has complete control over these things, right? So how do we measure the national income? This is very important. Very important. Questions come from this area only. In this, if you need to categorize something, ABC, different concepts of national income, this is an A category question where question can come like once in 2 years. What are the different methods of calculating national income? All right. So you people should have print out of this summary material to review or refer it before the exam or for your revision purposes. But the main material you always should refer it whenever there is information not completely available in this. Okay. So what are the different measurements of national income? Measurement of national income. First one is value added method or production method. We spoke about this here a lot. Whatever this we calculated here is mostly come here. Under this production method, we need all of this. Product value added method is also called industrial origin method, net output method, and entails consolidation of production of each industry. Less intermediate purchases. You need to understand something. Even here, for that matter, when you consider GDP, it is always value of goods that you sold minus value of goods that you purchased. The value added at each step. For example, GST is charged on the final product, but you can take GST input credit for the products that you used, right? Similarly, you're going to pay net GST value. Similarly, when you're calculating national income, one method is value added method or production method, where you will take up the value, gross value of the product that you're going to sell at the final market minus value of inputs that you used. Value of inputs used, that is going to be the value. For example, car manufacturing company, they sold car at 8 lakh rupees. But the value of inputs that they've taken from various people, say tires or say body parts, car body parts, say the rooftop, say the, for example, the glass, windows, all of these are purchased from subcontractors, right? So in that scenario, net value added for the car is 8 lakhs minus value of inputs that they have used. That is going to be the value added. You get it? So sum of all these value addeds is going to be value added method or production method. So here is a formula: gross value added, value of output minus intermediate consumption, all right, is equals to, how do you arrive that in accounting terminology? Sales plus change in stock minus intermediate consumption. Sales plus change in stock in your year-end inventory that you've bought minus intermediate consumption. Change in stock, sorry, your year-end inventory that you've manufactured, which is with you, that is also part of production, right? Along with sales, which is already moved out, plus change in your final stock minus intermediate consumption. That is going to be under production method. The formula for calculating the national income. So adding all firms, sole proprietors, partnerships, individuals, the private limited, public limited companies, all of it, if we add their, gross value add, that is under production method. Next, we have income method, slightly complex. This method is not slightly complex. It works for certain industries, it won't. Next, we have income method. This is very easy. Here, all the incomes, all factor incomes are added. What are the factors? Land, labor, capital, entrepreneurship. So all the returns people have got on these factors is added. You're going to get national income under income method. Under income method, national income is calculated by summation of factor incomes paid out by all production units within the domestic territory of a country as wages, salaries, rent, and interest and profit. So salaries are for labor, rent is for land, interest is for capital, profit is for entrepreneurship. So all these together is a summation of all of these is national income under income method. So here what you're going to do, compensation of employees plus rent. This is called operating surplus, rent, interest, profit, plus mixed income or self-employed. For example, certain individuals are self-employed. They're doing on their own. So certainly, in that case, you need to add that plus net factor income abroad. This is a standard thing, net factor income from abroad. So basically we remove the foreigners incomes and output, and include Indians earning abroad, right? So this is more sophisticated method. Income method is more sophisticated, provided all sources of incomes are disclosed by the citizens. So the income method is more popular, and it has been asked in the last year also. Developed countries, which method is used? Income method is used by the developed countries. Country like India cannot use income method exclusively because most of the times people don't disclose their income, actual income. Very few people, especially people working in organized sector to an extent, disclose their income. Otherwise, we don't get the actual income. So in that case, following income method may mislead us. So that's why developed countries follow the income method of national income, because there 90% of the people, 95% of the people disclose the actual incomes, as there is no scope for leakage. So for developed income countries, income method is suited, simply adding all the incomes. Next, we have expenditure method. These are very important. These formulas, questions are asked on these. Next, expenditure method. Under expenditure method, also called income disposal method, national income is the aggregate final expenditure in an economy during an accounting year, composed of final consumption expenditure, gross domestic capital formation, and net exports. There are three words: final consumption expenditure, whatever that people consumed, whatever that people use towards capital, gross domestic capital formation, and this is revenue expenditure, this is capital expenditure, and exports. So to understand it easy, private final consumption expenditure, all the private people, individuals, government consumption expenditure, plus gross domestic capital, net domestic capital plus depreciation, basically all the gross domestic capital formation plus exports. If we add all of this it will become national income under expenditure method. All right. So these three are very, 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 very important. Please read it, reread it, and understand it again and again. Product method, income method, expenditure method. Questions are asked so many times on this, asking direct questions and asking you to calculate. Let us understand a concept called circular flow of income. It is very important. Basically, the income that one received will have to spend, right? Suppose I earned as a salary, I need to spend on purchasing my essentials, or I need to buy something, say real estate. I bought a house. So then I will pay that to somebody, right? In that form. I'm going to keep it in my home. I'm not going to do puja for the money that I earn, right? So again, I'll put it back in the market. Most of the times, it will go back to the market in some or other form. So production of goods happen, and distribution of incomes comes, and people buy, those, and it keeps on revolving, right? So production, distribution, disposition keep up going simultaneously and enable us to look at national income from three different angles. Those are product income, if it is under this, and this is income method, and this is expenditure method. You can calculate at any stage in the cycle. So you are going to get the national income, right? So whatever we get, it has to get tracked at one or other place. So that's why if it is under production method, if it is under at this stage, production method or value added method. If it is at this stage, national income is calculated under income method. Disposition stage, expenditure method. Okay. So with this, you understand different methods of national income. And next we have, what are the limitations and challenges in national income computation? I will take an example of India. So India, how they calculate? Question is asked. India cannot take one method as a single method for calculating national income. India, such a complex country, we use mix of all the methods, all three methods. For certain industries, we use, for organized industries, we use product method. For certain individuals, we use income method. For certain industries, we use expenditure method. So we use mix of all of these. Okay. So the way it is performed in India is mix. So national income estimates significance we already discussed, and then we have, what are the limitations or challenges in the national income computation? There are so many challenges, of course, due to income. So can we take question that came up in previous years is, can we take national income as a basis for measuring the welfare of the state or welfare of the country? State means country in the general context. Certainly not. Just because India is the fifth largest economy in the world doesn't mean India on the people in India are so rich and their quality of living is so good and it is a proper welfare state. We have a lot of issues. There is a lot of poor people in our country, and the rich and poor divide is so huge, right? It is not an inadequate measure of welfare. We can't measure based on the national income. People are living a good quality of life. A lot of productions are hidden from government authorities. We said in a lot of things are stay away from the actual calculations. All these bettings, all these you know activities stay away from these standard so-called GDP, NDP calculations, national income calculations, and voluntary works and the services rendered without remuneration. All of those are not considered, but it's not correct. These contribute indirectly a lot to the economy, right? But we don't consider those things. And non-productive services are included. For example, police services, all of those are included. And then there is conceptual difficulties. Understanding itself is difficult. Agreed definition of income that varies from one to another. Issue of transfer payments, durable goods, valuation of government services. All of this is a big problem. Production for self-consumption, this is not considered. Presence of non-monetized sector, lack of proper occupational classification. All of these are problems in handling, calculating the national income. All right. So with that, you understand. See, let me tell you the important ones. Read the formulas, keep all these formulas in your fingertips and understand, do practice the previous year questions, calculating income under income method, national income under income method and expenditure method. You're going to get good marks if you know how these works, income method and expenditure method. Okay. What is next? Take a quick break. We're going to get into next unit, that is Keynesian theory in determination of national income. This is loaded with a lot of concepts, in fact economic concepts which go beyond your head sometimes. Don't worry, you understand certain important concepts in this unit. You will be able to answer any question if that comes. The basis for this should be the previous questions that are asked from this unit. For example, let me show you the question. This is the important one. The equation of consumption function C is equal to 450 rupees plus 70y, 0.7y. Calculate the following. So this question comes from this unit. Keynesian theory of determination of national income. Okay, let us discuss this. So please listen carefully. Listen carefully. What is this Keynes theory of determination of national income? We understood till now how do we calculate the national income. All right. So now this famous economist Keynes, he came up with certain theories in determination of national income. The concept called equilibrium national income. The concept is called equilibrium national income. The Keynes spoke about equilibrium national income. What is meant by equilibrium national income? What is meant by equilibrium national income is something we need to understand. What is meant by equilibrium national income? Basically, equilibrium means we can say that in layman terms, balance, right? Balance. It is very hypothetical scenario, but he says equilibrium national income is the real potential of the country's national income, any country national income. It means actual national income could be lower, but Keynes has come up with certain formulas wherein he said you can have certain equilibrium income, potential national income a country could achieve. That is called equilibrium national income. How we mention that equilibrium means, it means whatever we produced is consumed. There is nothing called wastage, inventories, or written offs. All right. It is hypothetical. So what is the meaning of word equilibrium here? Equilibrium, it occurs when the desired output demanded in the economy, basically how much demand is there in the economy, for example, for laptops, for pens, for whatnot, for everything, is exactly matching with the amount produced. Basically, demand is equivalent to supply. It is very hypothetical. Still we are studying. So where aggregate demand is equals to aggregate supply, that is called equilibrium state of national income. All right. For this, Keynes has further complicated it by telling in 3 different models. That is 2-sector model, under 3-sector model, and 4 sector model. So basically, let us discuss what is it. two sector model. In the two sector model, it's all hypothecation. Okay, you just hypothetical. You just think about it. There's nobody. Households are there, firms are there. I mean to say private companies or individuals, households. Transactions are happening between these two. Most of the times, transactions happen between these two. So households receive factor incomes. Basically, individuals at the end they receive right from the firms. Even if a owner, he'll receive as an individual only, right? His profits, his interest. So they receive wages, rent, interest, profit. In fact, households again spend in buying goods and services, right? And firms make profit, and again they pay factor payments in the form of wages, rent, interest, and profit. It is a circle, right? We consume and we buy and we receive revenues from the firms, right? So it is a circle, right? So in this case, he says aggregate demand is equals to AD is equals to aggregate supply. Okay. So supply can be in this way. AD is equals to aggregate C plus I. Here C stands for aggregate demand for consumer goods, like what all we consume. And next, aggregate demand for investment goods, various capital goods that we invest in. Consumer goods like all the revenue expenditure that we incur, various household expenditure, family expenditure, all of this, right? Health expenditure, all of this. Aggregate demand for investment goods. For example, buying a house, that's for investment good, right? Investing in bonds is investment good. Now, aggregate demand is equals to supply. Now, let us understand here C. What is the demand for consumer goods? C is equals to A plus BY. Very important questions are asked from this. You understand this consumption formula? This question is based on this only. C is equals to A plus BY. If you know this, you just have to simply replicate these numbers at the right places and close it. So C is equals to A plus BY. I'll explain you with the graph. See, consumption of anybody will have certain bare minimum expenditure. Even if you are not earning, suppose you are a student, despite that, you're not earning, but you will have certain minimum expenditure to incur, right? So that is called A. Constant term, that is constant. Say, for example, you are getting 5,000 rupees. In that, 1,000 rupees is your minimum expenditure. Just without doing anything, you will have to incur minimum 1,000. And plus BY. Here, Y stands for your income. B stands for proportion of income, marginal propensity to consume, proportion of income that you are ready to consume. Basically, your minimum expenditure plus proportion of your disposable income you are ready to consume. B stands for marginal propensity to consume. If you look at it here, Y is on x-axis, C is consumption axis. Sorry, consumption is on x-axis. Bare minimum you will incur expenditure of A, whatever it is, 1,000 rupees. So bare minimum it will start from here. Even you don't have income, you will have certain consumption, and then as your income grows, as your income grows, as your income grows, your consumption or expenditure also grows. It is simple. Someone who's earning 10,000 rupees, his consumption levels are different. Someone who's earning 100, say 2 lakh rupees per month, his consumption levels are different. After a point, consumption levels are directly proportionate to your income. If you are earning high, you will spend more. If you are earning low, you will spend less, right? But to a point, certain consumption expenditure is common. That is called A. And then proportion of your disposable income is BY. Get it? That's how you need to mention this. If you have been asked to present the graph, you need to present this. B is slope, C is equals to Fy, function of your income levels. So A plus slope BY, right? A plus Fy also can be written. Okay. So that is called consumption function. Next we have savings function. So whatever is from your income, if your consumption is taken out, rest will be savings, right? So savings is equals to Y, income minus consumption, right? So consumption and saving functions you need to understand. So now let us understand two sector model of national income. What is the equilibrium state of national income? At equilibrium point, C plus I, demand, is equals to C plus S, consumption plus savings. Demand for consumer goods, demand for industrial goods is equals to humans consumption and their savings, right? S is equals to I. Saver plan is equals to investment plan. No tendency for output to change. So whenever there is demand is more than supply, what happens? If actual demand is more than the equilibrium, excess demand makes business to sell more than what they currently produce. Unexpected sales would decrease inventories investment, rising production by hiring extra workers, which will increase aggregate income. All right. So you need to know certain bare minimum things of these formulas, right? AD is equals to C plus I. This is important. C is equals to A plus BY. So these formulas are very important. Questions are asked from that only. When here C plus I, calculate the equilibrium level of national income at equilibrium level of national income, consumption expenditure. C is equals to 200 plus AY. I they have given, right? So you need to calculate this. So knowing these formulas are very, 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 very important. Read this, you will be able to understand, you know. Next we have something called investment multiplier. Important. What is investment multiplier? Investment multiplier explains how many times the aggregate income increases as a result of increase in investment. How much change in the delta I leads to how much change in the aggregate income. So if there is increase in the investment, obviously there will be an increase in the income. But how much changes? Just like money multiplier, you need to understand investment multiplier. It all depends on so many factors. Like if it is high taxed, certainly your investments will be less. You have liquidity, you need to maintain high liquidity, then investments will be less, right? So various factors that determine the investment multiplier. Understand? So in the three sector model, government also comes into picture. So transaction with government is also tracked. So again, you will have here on the demand side, we will add C plus I plus G. On the supply side, we will add consumption plus savings plus taxes. Consumption plus savings plus taxes. C plus I plus G is equals to C plus S plus T. Okay. So that is under three sector model. Under four sector model, you are going to add another one, that is rest of the world. This includes your exports and imports, X plus minus M. So here under the four sector model, consumption expenditure, investment expenditure, government expenditure plus exports minus imports. Under the supply side, you will have same consumption expenditure, consumption plus savings plus taxes. The formula of AD is equals to AC, AD, aggregate demand is equals to aggregate supply, is going to be your equilibrium income under four sector model. You need to remember four formulas here. Very important. I'm not sure whether you remember all of these graphs and all. Till now, questions are not asked on these graphs. No need to worry, but you remember these formulas. Need to remember these formulas. What is the formula? Under two sector model, AD is equals to C plus I. Important. AD is equal to C plus I. C stands for consumption expenditure. I stands for consumption goods. I stands for investment goods, because here government is not there. All the individuals demand for consumer goods and investment goods is considered. And next we have AD is equals to AD is equal to AS, right? So under the equilibrium point, we consider towards supply side consumption plus savings, individuals consumption plus savings. C plus I is equal to C plus S. All right. Next we have under three sector model C plus I plus G, because third function is added, that is government. C plus I plus G is equals to supply side C plus S plus T, taxes. And a four sector model, rest of the world also comes into picture. So C plus I plus G plus X minus M. Okay. So that is how equilibrium in state of national income is calculated. It is very hypothetical. My suggestion is don't dig too deep in the entire economics for finance book or syllabus. Chapter 1 unit 2 is heavily loaded with lot of concepts, but my suggestion to you is understand these formulas, make a logical understanding. It is easy for you to remember. If you remember these formulas, more than sufficient, you will be able to answer. Look at all the previous questions that are asked in the chapter 1 unit 2, then you will be able to prepare accordingly. If you start reading and doing research on every topic, you are going to waste a lot of time for 4 or 5 marks. Understand these formulas and prepare well, and that is more than sufficient. C is equals to A plus BY. If you understand the logic for what is this A and what is BY, then more than sufficient, you will be able to answer this question. Then C plus I plus G. Why IG is added? Government expenditure. C plus I plus G, demand for consumption goods, consumer goods, investment goods plus government goods, is equals to C plus S plus T, supply side. So if you know three sector model, and then four sector model, C plus I plus G plus exports minus imports one side, C plus S plus T is other side. All right. So that's how you will be able to arrive equilibrium state of national income. With this, we are done with chapter 1 unit 2. In fact, I would suggest all of you to look at the chapter 1 at the end in your preparation, because this is so overwhelming. And let me know if you want to reach out to me for any clarification or any suggestion on how to prepare. And with this, I'm ending the quick revision class of economics for finance. Chapter 1 unit 2 is over, and happy to get feedback and get your thoughts. If you have any questions, reach out to me and I'll be able to help you guys. Thank you so much. Thanks a lot. And I would suggest your basis for the preparation of economics for finance should be previous year questions. Previous year questions will give you a lot of clarity on which areas to prepare, which areas you can avoid it. You, without reading previous year questions, it is very difficult to get a complete grip on the economics of finance. Read thoroughly all the previous year questions first, and then it is easy to categorize the concepts into important, fairly important, and not important. Classify your book. I have done already. Wherever I have highlighted in yellow, those are asked in the previous year. You can take this also as a base and prepare for it. I told you wherever it is asked in the previous year, so prepare in and around those areas. I'm sure economics for finance is easy thing. It is not so difficult to crack if you understand the pattern and the philosophy of the examiner and where he's testing us. All right, so this is a must read material for all of you. Must refer this previous year questions chapter wise. Before you start reading the chapter, look into the questions, or after reading the chapter, at least look into the questions and understand whether you are able to answer those questions. If you can do that, you will be able to easily score 30 to 35 out of 40 from the economics of finance. Thank you. Thank you so much. We'll meet later in some other class. Thank you. Bye.